Right, buddies, very good morning. Yes, how are you doing? All good? Okay, so today we'll start an interesting topic, very important again. So either it will come as a full-fledged question or 100% lot of adjustments will be coming. So there again there is no question paper in income tax without questions on capital gains, PGBP, assessment procedure and all those things. And the fact that why capital gains is very important is Madam has changed most of the things in Finance Act 24, which means some of the provisions which can come for the last time would be this. She has changed the rates. In fact, predominant changes have been in capital gains itself. So deadly changes. So what are the changes and all we will not see, but of course it is very important. So in the new Finance Act 24, the old provisions also exist for up to a certain date and the new provisions exist, just like assessment procedure. So there is a cut-off date. Till the cut-off date, old provisions also exist. But then in the going forward in the examinations, only the new provisions will be asked. I mean, maybe in May 25 there will be a mix of both, but then going forward it will be only the new provisions. So it is very imperative for us to study for the last time the old provisions, right? So rates have changed, many things have changed. That's the reason why this chapter is important for November 24 point of view. Cool. So, I mean, any type of marks, any number of marks can come, we do not know. Predominantly around 6 to 10 marks generally used to come, but sometimes 3 marks come, sometimes 10 marks come, so you never know what they'll ask. But since they have changed the rates, etc., obviously the weightage for November 24 will be more, is what I feel. Same with assessment procedure also. So, these are the chapters that I want to do properly so that there is no confusion. I mean, if you had studied in inter properly this chapter, then this will be little easy, but then I would assume that we have not studied anything in inter or final, whatever the case may be. So we'll do it properly from the basics quickly, of course. Cool. So in the capital gains, what we need to understand is there has to be online people. Are you there? Good morning. Right. In capital gains, what we need to understand is very simple. It is, first of all, there should be a capital asset. So first part of discussion is what do you mean by a capital asset? And then that capital asset has to be transferred. So one is capital asset and the second is transfer of a capital asset. And when you transfer the capital asset, there is something called as full value of consideration, FVOC is what you will get. And then you will subtract the expenses of the transfer, and finally what you get is your capital gain. So capital asset, transfer, full value of consideration, and what you will get is after expenses you will get the capital gain. So now we need to understand what do you mean by a capital asset, and then of course the tax will be based on the type of gain. Will be based on the type of gain. Two types of gain are there, that is short term capital gain, long term capital gain. Whether it is short term or long term totally depends on the period of holding. So in our chapter we need to understand for which asset what would be the period of holding, and different natures of nature of assets, what is the period of holding, everything we need to discuss. So of course it will take considerable time, but we need to do it slowly. There are many things to be covered. And even the examiner's comments, if you see, they have clearly mentioned that students are not able to understand, especially for example, even the compensation received by government on compulsory acquisition. So they had commented that students are unable to understand the taxability of compensation also, which is actually a CA inter syllabus. So the thing is, we cannot avoid anything here. That is the reason why we have to do everything. So this is a very important chapter from November 24 point of view. And of course the rates also have changed. That's why I am saying, so we need to do everything. And there is a new section which has been inserted called 50AA, which came in Finance Act 23, and actually not much has come in May 24. So that also we need to see. So there have been amendments also in Finance Act 23. And given the fact that in 24 also they have amended stuff, so this becomes a very important chapter. So period of holding, right. So basically 45(1) speaks about what? Any gain or profit arising from the transfer of a capital asset. It shall be taxable under the head capital gains. Very simple question, when will you charge capital gain? In which year? In the year in which the transfer takes place. Correct. So I have an asset. If I sell the asset today, that year the transfer takes place, and that is the year when I have to pay tax. However, there are exceptions to this rule. So what is the general rule? In the year in which the transfer takes place. Now if I am selling, assuming this is a capital asset, if I am selling this asset this year, then this year then it is called the transfer, and this year I will have to calculate the gain, assuming this is a gold bottle. So what I'm essentially trying to get is taxability will be only in the year of transfer, not otherwise. However, there are 4 exceptions to this, 4 to 5 exceptions, where even though the transfer happens some year and some other year something else happens. So in that case also the capital gain calculation is postponed in a few cases. We will see that, no problem. So ultimately what is it? It arises in which year? The year the capital asset is transferred, except a few exceptions where even though transfer happens some year, something else happens some other year, your what do you say, capital gain will be postponed to that other year. Cool. So now coming to capital asset. So ultimately, as I told you, if you understand these things, what is capital asset, what do you mean by transfer, what is expenses, what is capital gain, what is the tax, whether it's short term or long term, what is the period of holding, what are the rates, over, chapter is over, that's it. So each of these things we need to discuss step by step. So first point, that is, what do you mean by capital asset? 2 clause 14, capital asset means property of any kind. Property of any kind. Any kind means what? Movable, immovable, tangible, intangible, anything. Held by the SSE, right? Held by the SSE, whether connected to business or not. So unlike PGBP, where everything had to be connected to business, in capital gain, there is no need to be connected to business, right? However, there are certain things which are excluded. What are excluded? It very clearly says what excludes the following. First one is stock in trade. Obviously, because stock in trade will be directly going to PGBP. After having solved PGBP, now we know that stock in trade will be PGBP income. So, when everything is capital asset, people thought about what about this bottle, for example, as I already told you. This bottle, I mean, that time I told, assuming this is a capital asset. But is this an actual capital asset as per income tax? No, because it's a movable personal asset. So, movable personal assets are not capital asset, clearly given. However, they told, what if the same bottle was a completely gold bottle? I am a Dubai Sheikh and this is a complete gold bottle. What do you think? In Dubai and Arabian countries, they have golden toilets and all. I am not even joking. You just do a simple Google search, you will be shocked, right? So it's what you say. This is a movable asset, but it is fully made of gold or platinum or a precious metal. Then would that be a capital asset? Yes. So if you see, except jewelry, drawings, painting, sculptures, archaeological collection, or any other piece of art, all these things would be capital asset. So if I draw this and sell it for 10 rupees, it's a capital asset. The same drawing Virat Kohli had drawn, it will fetch 1 crore because he drew it. So ultimately what I am trying to tell is, any drawing, you would have seen some famous artist drawing, when we probably don't understand, we don't know what it is. He'll put one line and then say abstract art, and they'll sell it for 1 crore, 2 crore, you would have seen, right? So it's crazy. So the thing is, here for us, we don't know what it is, but anyway, you would have seen many famous artists, M.F. Hussain, Yusuf Farakal, I mean, they really paint well. But the thing is, you would wonder, is it worth 1 crore, 2 crore, 10 crore? But the artists, of course, the people who love art, they'll see something in that, that's why they'll buy. So what I'm saying is, all that, is it a capital asset? Yes, it is a capital asset. Movable personal asset is not a capital asset. That's why they have clearly given except. So what about your mobile, your fridge, your chappal, your bottle? All these would not be called as capital asset unless it is, what do you say, gold mobile, gold fridge, golden chappal. Just saying, those things would be what? Capital assets. So basically utensils also, normal utensils that which I showed you, that is not a capital asset unless it is what? Gold. So if you see something which is sewn into the garment, something like a gold phone, gold studded camera, gold studded watch, all this will be capital asset. So as far as utensil is concerned, this steel utensil definitely is not a capital asset. But if this were to be gold, definitely it will be a capital asset. Now let's say this is silver and this is a family heirloom. My great grandfather was using this bottle, is what my mom told, right? And then I am getting this. She said, if you use this, it's very lucky for you. It's a silver utensil, but assume, is this a capital asset? Actually, yes. But the thing is, there was a court decision, Supreme Court judgment, which said it's a personal effect because it's a family heirloom. So that's an exception. Ideally, yes, you're 100% right. Silver is what? Silver utensil is capital asset. But then there's an exception. If you buy it off the shelf, then it's capital asset. But if it's a family heirloom, it's coming from generations. You would have had in your house, no, an old plate. Which in my house, it's there. My grandmother had used a plate. That is not silver plate though, normal plate. That is anyway personal effect. But if it were to be a silver plate, what do you think? Is it a personal effect or is it a capital asset? Actually, it is a capital asset because it's silver. But Supreme Court told it's a family heirloom. You cannot charge everything like that, so it's fine. So you see the notes, I'll show you. So in the notes, first of all, guys, there should be a capital asset as discussed. It should be transferred and capital gains business. So if you see, first of all, I'm just talking about this. Capital asset means property of any kind. Property of any kind is what we are discussing, but does not include these things. Personal effect also we saw. Yes, see this. Madras High Court. And there was this Maharaja Rana Hemant Singh Ji, another Supreme Court case law, which actually explained what is a capital asset and what is not. What is capital asset, what is not. So this guy in this Ramanathan Chettiar case, Madras High Court, they told silver utensils held for personal use are not capital asset as per a Supreme Court judgment. One more Supreme Court judgment was there. That is this only, Maharaja Rana Hemant Singh Ji, because there they gave the two different distinctions. In Maharaja Rana Hemant Singh Ji, what happened? He had brought some 40 kg utensils and he had kept it in front of the goddess. And then he is telling it is a family heirloom. 40 kg, and I am giving it to the goddess for the puja. And he called income tax officer for the puja. Correct? He is seeing there. It's like so many silver items. And he is actually selling that silver item to various people and telling it is family heirloom, one piece you can keep and this much money. And then when they sent a notice, they said no, it is a personal effect. So that's why Supreme Court gave the distinction between what is personal. One item is okay. If you have so many things, can you call it a family heirloom and call it a capital, not a capital asset? No. Next point, if you see, silver bar, silver coin, bullion are not considered to be personal effects even if they are placed before the goddess Lakshmi at the time of puja. They said in such a quantity it is not allowed. If you see, C and D will seem to be contradictory, but it's not. C says one or two utensils, okay, was silver utensils, fine. One old plate, one bottle, that and all, it's okay. But you are carrying like some 100 plates here and then telling it's personal effect. I will not allow that. Right? So simple silver utensil, capital asset is not a capital asset. It's a personal use, personal asset. Whereas silver bar, silver coin, bullion, and then you cannot call it as a personal effect is what they said. That is what it is. Again, see, if gold utensils are being used for display or showcase, only then it cannot be considered as intended for personal use. Correct? So I have in the entire one chamber, that fellow had all gold utensils, gold plated, gold studded thing, and then he's calling personal effect. No. So nothing doing. Right. Now, what about motor car, guys? Motor car. Motor car is not a capital asset used for personal use. If it is used for business, anyway, it is added to the block. We have seen in PGBP. Right? But if it is used for personal purposes, it is not a capital asset. That's why if you buy a car and sell it off later, that amount that you get is capital receipt, not taxable. So I had a Celerio in 2014. I had bought a Celerio, 5 lakh rupees. I used it for 1 lakh kilometers. In 2021, I sold it off. I bought it for 5 lakh rupees. I thought after 1 lakh kilometers, I'll get some 1 lakh rupees. A depreciated value, if you think about it, is almost like 1 lakh. That fellow paid 3.5 lakhs, some stupid guy. Correct? So because in Bangalore, it's better to have a automatic car, automatic transmission, and it was an automatic transmission, and it's city, small car, better to use in city. That fellow paid 3.5 lakhs. Correct? Biggest bakra I've ever seen in my life. So 3.5 lakhs. I didn't even quote. I was not even expecting anything. I thought 1.5 lakhs I'll get. 3.5 lakhs he paid. So now actually for me, depreciated value, if you think about it, is 1 lakh. I'm not using it for business, personal use, but I got 3.5 lakhs for that. 2.5 lakhs gain. Is it taxable? No. It is a capital gain. I mean, it is a, what do you say? It is something which is not taxable. Simple. Capital receipt, not taxable. We just started, don't worry. Just started. 2 minutes. Right. So, yeah, that's all about it. Motor car used for personal purposes, yes. Immovable property in which SSC resides also is not a personal effect. I am living in this house. Personal effect, no. If he sells his house, obviously capital gain will come. Only car, etc. is not thing. So if you understand this, that's about it, guys. No. So in like non-resident taxation, there are many things which are capital asset, many things are not capital asset, all those things. So first and foremost, what are we discussing? This one does not include. So actually, capital asset has 3 items, 1, 2, 3. But of which I am just talking about 1. 1 excludes certain things, that is these, which means these things are not capital asset. Stock in trade, raw material, consumable, personal effect, and all those things. But in personal effect, jewelry, archaeological collection, drawing, painting, sculpture, they are all capital asset. They are all capital asset. Third one, guys, third one. Agricultural land situated in a rural area is not a capital asset. Agricultural land situated in a rural area. What about agricultural land situated in urban area? Capital asset. So urban agricultural land is definitely capital asset. All this will help us when we are talking about exemptions. Exemptions also will definitely come in the exam in the form of adjustments. You would have seen in PGVP only we solved 2-3 questions which had exemptions from capital gain. 54 EC and all we had seen in one of the questions. So basically they'll mix everything. Capital gain standalone questions may not come, but they'll ask you in MCQs, they'll ask in other areas. So what exactly is urban area or what is rural area? So anywhere if the population is less than 10,000 people, then it is what? Rural area. Apart from that, I'll use this chart, it is better to understand. See, if the land is situated inside, no, here, where the population is less than 10,000, is it a rural area? Yes. Then if the population is greater than 10,000 but up to 1 lakh people, up to 2 kilometers, if it is there here in 2 kilometers, then it is urban area. The moment it goes beyond 2 kilometers here, then it will become rural agricultural land. Within 2 kilometers, urban. More than 2 kilometers, rural. So I should see the cantonment board there and take the entire jurisdiction. 2 kilometers radius, anything that happens within 2 kilometers radius, urban. When it crosses 2 kilometers, rural. Next, more than 1 lakh up to 10 lakhs. More than 1 lakh up to 10 lakhs. So there I have to check 6 kilometers. Within 6 kilometers radius, urban. Beyond 6 kilometers, rural. Next is what? Population is more than 10 lakh. And population is more than 10 lakh up to 8 kilometers, what area? Urban. Movement cross here, like here for example. I have a plot of land here. Population is more than 10 lakhs. Rural or urban? Rural. Because it's going beyond how many kilometers? 8 kilometers. Right? So that is the concept of agricultural land. Within the radius, urban. Beyond the radius, rural. But if it is less than 10,000, anyway it is rural. Yes. Doubt? Then it will come here, no? With the population less than 10 lakh, up to 6 kilometers is urban. Beyond 6 is rural. Everything there is a thing here. You tell the population, you see this chart, that's all. Right? So the population is more than 10 lakhs, up to 8 kilometers is, full 8 kilometer radius is urban land. Beyond that only will be rural land. Got it. So earlier there used to be some different areas. They had only categorized whether it's rural or urban, etc. And things got very dicey. That's why now they have made this like, now this is how it is. Very simple. Tell me. Agricultural land converted to plots, when you do that, no, I just recently gave an opinion on this. Agricultural land, when you convert to plots, you need to go to the land authority, registrar, and get it converted to commercial land. So if you don't convert it to commercial land in the paper, if it is still agriculture, it is agriculture only. So that is the thing. So this was a case, whatever I gave opinion was a same thing. Since that you are asking and it's linked to the subject I am telling. So same thing, it was an agricultural land. They were growing coconuts in Kerala, and after a while what they did was they gave it off to a builder. He converted that land into urban land by constructing it as a JDA, Joint Development Agreement. And he constructed 8 or 10 flats and gave 5 flats to the owner, apart from some money for the land. So the question here was, is it agricultural income or not? That was the opinion. So if you see, unless it is converted in the land records, that it is converted to urban, then it will still remain rural. So in nowhere it says it should be used for agricultural purposes. The land, how it is registered there, I should see. Registration of the land is 2 things. One, I should see that radius part. Second one, I should see in the land records how it is registered. Right. So that is what it is. Car, if you say BMW car, 1.5 crore if I buy personal, it's for personal use, no tension. But if I use it for business, then again it will come anyway in the block, and that will become a capital asset. You have seen in the block concept already. Rural agricultural land in India is not a capital asset. Rural agricultural land outside India, capital asset. Imagine. They'll ask, this fellow has a plot of land in London, in Netherlands. Is it, what do you say, capital asset? Yes. Urban agricultural land in India, capital asset. Urban and rural depends on the radius and also depends on the land records, practically speaking. Then D. There are many bonds, guys. Gold deposit bonds, gold deposit scheme. So all this when Jaswant Singh was the finance minister, he introduced this gold deposit bonds, which was a major flop show. But when Arun Jaitley reintroduced it in 2015, it's called gold monetization scheme. It was a wonderful idea whereby he said, whatever gold you have, you give it to me. And I am the government, you give it to me. I will melt it and I will give you a pure ISO certified gold biscuit, depending on what gold you give me. That gold biscuit, I will not give it to you. I will keep it. I will keep it. And I will give you interest, 3%, 4% interest, just for keeping the gold in the government. What is the benefit for the government? They will have gold reserves, and with that gold reserves, they will get loan from wherever they want. If they want some money, they can keep it as the gold reserve as a security, and they can get money. So ideally speaking, if they just take a loan from outside, it would have been, let's say, 18%. But with the gold reserve, they will get loan at 11%. So 10-11% is their cost, plus they have to give 3% to you. So total cost is 15% as against 18%. Plus they have huge gold reserves, which means our gold reserves of the country will increase. Brilliant scheme. But the crux of the matter was, when you are transferring, and after a few years, I'll give back your gold. So there is a 5-year, 10-year period. After that, you take your gold back, no problem. But for giving your gold, I'm giving you some consideration every year. That is what? 3%. And at the end of it, you will not get a gold chain. You will get a pure ISO certified gold bar, which is of great value. The question is, when you are giving the gold to me, isn't it a transfer? Yes, gold is a capital asset. It's a transfer to me. And I'm giving you consideration also, 3% money, 3% on the value of the gold. It's a consideration. So capital gain should arise. So I said, no problem. No capital gain. That is why they said that is gold deposits monetization scheme. If you gold you give me, no, that is not at all a capital asset, deadly. Plus you are earning 3% income, no, that also is exempt under 10 clause 15. So it's a win-win situation for both. Instead of keeping in a locker, you give it to me. Income I'll give you 3%, fully exempt. Gold you are transferring to me, not a capital asset. After a few years, I'll give it back to you. For me also, it's good. I'm getting a loan at a lesser rate. Plus, gold reserves of the country will increase. Win-win. After I give the gold to you back, if you sell that, that will be capital asset. Then you can't claim exemption. Only the gold monetization scheme is an exemption. Hope you understood. Got it? This is the gold deposit one. Which one? That is not covered in this scheme. Only these schemes. Gold deposit bonds, gold deposit scheme, gold the deposit certificate, special bearer bond, special gold bonds, gold monetization scheme. That's right. These are only the schemes covered. So, not the SGB. Interest on GDP issued under these schemes, that is gold deposit scheme or the gold monetization scheme, etc., are exempt under 1015. Capital asset will also include intangible assets such as copyright, trademark, patent, interest in partnership, leasehold, tenancy rights, route permits, right shares, everything, guys, everything. So, coming back to the crux of the matter, first we discussed what? Capital asset means what? Property. Property excludes 4 items that we saw. Then these two are also capital asset. What is the third one? Any unit, I will come to the second one. First, third. Any unit linked insurance policy to which exemption under 1010D does not apply on account of applicability of the 4th and 5th proviso. We'll see that later. So basically, ULIP, unit linked insurance policy, to which if exemptions under 1010D does not apply, then that will be a capital asset. A unit linked insurance policy is nothing but you will give money to an insurance company. Normal term life is very simple. They will take the money and they will invest wherever they want. That is how they earn their money. And if you die, your family will get a lump sum amount. Unit linked on the other hand is they will buy units, mutual fund units or any units. And it's like a growth plan whereby because of the investment that you have made, you will also be getting a return. So that is like trading in shares anyway. That's the reason why they say it is a capital asset. If exemption is covered under 1010D, then it's not a capital asset. But where there is no exemption under 1010D, then it will become a capital asset for you. That is what it is. Then, foreign institutional investors, that is foreign portfolio investors, etc., they were investing in the country and of course they were buying, selling shares and all those things. So, since share is a capital asset, they were taking it as at a lesser rate with indexation, 10%, 20%, all that they were paying. But the assessing officer said, boss, you are a foreign investor and for you it is a business. Since it is a business, you will have to pay, and you are a foreign company, you have to pay 40% tax. So this issue went to court. Assessing officer also is correct, no? It is 40% because you are doing business. But the foreign institutional investor is telling, I am investing in shares. But what is the main source of business? What is the main objective of business? Investment. So you are an investment company anyway. So actually PGBP will come. Then the foreign fellows said, if you make it PGBP and 40%, nobody will come to your country. That's true. So that is the reason why, to put this issue once for all, because it's better if it's capital asset. Why? I'll pay 10%, 20% like that instead of paying 40%. So to put this issue once and for all to rest, they changed the law and said any security held by foreign institutional investor which has been invested in the market as per SEBI regulations will be a capital asset even though their business is investing deadly, right? So that they can claim lesser rate. So these are all the capital asset. That's all, nothing else. It's an exhaustive definition. Means exhaustive. Nothing else apart from these three is capital asset. So once you know the definition, other things becomes easy. Property of any kind. This is like a huge wide section. Property of any kind, whatever you think, except the exclusions. Exclusions you have already seen. So this is what? Property of any kind, right? You guys can have breakfast, man, no problem. You've got breakfast, no? You can eat whenever you want. Don't wait for the break. Yesterday I saw you were eating at 11. Don't wait for all that. If you are hungry, eat it. Everybody else also. Whenever you feel like eating, you eat, no problem. Just concentrate in class, keep eating. No issues. I have no problem. That much respect and all not needed. Let sir give break, all that don't want. Eat. Because you need to, hunger is something which you should not control. So that's why I'm telling eat, no problem. Whenever you feel like eating, I have absolutely no issues. It's not disrespectful at all. I'm only telling you. So feeling hungry, eat, no problem. Cool. So this is all done. All these things are done. Yeah. All this is over. Yeah. So it's come to C4. Maybe yours is 1 or 2 pages here and there. There's one extra thing here. This explanation, you see. The expression property includes any rights or in relation to an Indian company, including rights of management or control or any rights whatsoever. So property, if some foreign company controls the Indian company, for example, there was one company here under which one more company was there. This controlled the full rights here. Some other company did not buy this company actually, but some other company bought this company, because of which this entire thing got shifted under this. Correct? So there was one company, subsidiary, one more subsidiary. Company A, subsidiary B, subsidiary C. Some random company C had one more subsidiary, sorry, D had one more subsidiary E. This company E, assume, bought A company, shares of A company or control of A company, because of which this entire thing got split and came under this only. So the question was, would it include indirect right of an Indian company? This is only Indian company, everything else is foreign. So would it include the right of, in relation to an Indian company, does it include the right of management or control or also? Yes, because property of any kind did not include those rights. Why I am telling all this is nothing but the gist of the Vodafone case. In Vodafone case, they said it is not a capital asset, hence capital gain will not come, withholding tax also will not come, no TDS, nothing, 195 also will not come. So many amendments came. One of the amendments was this, to say that even if anything else happens, this will be part of the deal, right? So that is what they said. To give a gist of the story, I'll quickly just go through. I mean, later also again I'll explain quickly, but yeah. So if you see, this was the structure actually. Hutch, which was in Cayman Island, Hutch, British Virgin Island. In one more company, Hutch, Cayman Island, then multiple entities through which Hutchinson India was controlled. So what happened was, only that Cayman Island, Cayman Part 2 was sold to Vodafone, which is in Netherlands. Ultimately, what is getting affected? Hutch India. So ultimately, once all this sale happens, ultimately what happens here? This is sold, no? Automatically it will come under this. Hutch came into, then multiple entities, then India. And then obviously this will be now called Vodafone Cayman and Hutch became Vodafone India. So the question was, is it capital gain? Supreme Court said no, it is a bona fide investment in India and hence it is not the scene. This fellow said it is, what do you say, the route is for tax planning, tax avoidance, but it was not to be. Supreme Court said absolutely there is no such thing here. It is not a transfer only. 195 will not come because indirect transfer was not covered in section 9. It was not even a capital asset covered there. So there so many changes came. So many changes came because of that, because of this particular section. Anyway, just to structure is this. So, now it is definitely. Now it is. They have changed the law. Supreme Court, to overthrow the Supreme Court judgment, they have changed the law. That's why now it is indirect control. So that was a slap on the income tax department. That was in running into crores. very landmark judgment back in the day, 15 years, I guess, 12, 13 years ago. That was the case, 2012, yeah, 12 years ago. 2012, 13, that was the case that time. Came from 2010 actually, it's been so many years now, right? So, but they have changed the law. And now, so in that case, some other company is holding the rights of an Indian company indirectly. Indirect transfers are not covered in section 9, deemed to accrue or arise in India. So, they changed that law, they changed this law now. Right now it is covered. Okay, anything like that if you do, which eventually leads to Indian company getting controlled by some other foreign company, will be what transfer. Because they said Hutch didn't transfer anything. Did Hutch transfer anything India? No. The holding, the transfer happened somewhere else outside India, but it impacted India, no? So that is also transfer, right? If I have earlier, I mean, even now I can hold stock exchange trading cards. And a trading card, I am an agent, I am a stockbroker. So I'll have a right to invest in the, or rather, invest somebody else's money in the stock market. Is that a capital asset? Yes. See this point number 5. Stock exchange membership card is a capital asset. When the SSE holding this card defaulted on payment of dues, the stock exchange terminated the SSE's membership and sold the card in an auction. SSE was held liable to capital gains. PJ Matthew. So, membership in a stock exchange is a right and intangible asset which is liable to depreciation. Yes. So, we have covered all these things. But what is you mean by a transfer is the next thing. So, we discussed, if you see here, initially we were saying, first of all, I need to understand what is a capital asset. Now, we have understood what is a capital asset. Next part of the story is what? What do you mean by transfer? In a transfer, some things are called transfer, some things are not a transfer. So, what is transfer, what is not transfer is what we need to understand. First, what do you mean by transfer? Let's see. Sale of a capital asset. So, yes, if I sell a capital asset, that would be called as a transfer here. Transfer of ownership in exchange for a price paid or promised. Sale is a transfer. So, but what is the date of sale is what we need to see. If I am selling a house, I'll enter into an agreement to sell first, and I'll have the basic terms and conditions mentioned, and later I will enter into the sale deed. What is the date of transfer? Agreement to sell or the sale deed? Sale deed. But later cases we'll see the stamp duty value. Should I take of the agreement to sell date or the sale deed date? That we will see later. But ideally speaking, when is the transfer happening? The moment you sell the share, what do you say, house, where? On the sale deed date, not the agreement to sell date. Exchange of asset. Mutual agreement or arrangement, two persons exchange ownership of an asset with the ownership of other asset, it constitutes exchange. So, I will give you one asset, I will take back your asset. So, the cost, how to calculate capital gain we will see later, but that is also a transfer. There is no money exchanged, asset is exchanged. So, that is also a transfer. Means I am giving my services for which I am asking for a share. Is it a capital gain? Yes. Let's say once you become a CA, you will provide some services to the client, and the client doesn't have money to pay, but the company has good value. Will you take shares of that company? Yes, you can take shares, no problem. But are you providing the services? Yes, that's a consideration. Exchange, right, of asset. Let's say you are giving your know-how. It's not your service, your know-how you are giving for that particular company. Is that an asset, capital asset? Yes. And in exchange, you are getting shares of that company. Is it a capital asset? Yes. Exchange of assets, capital gain. No money exchanged. So what will be the gain for you? What will be your consideration for you? Not what you have given, but what you are getting. And for the other person, whatever he is getting, that value of the know-how will be the sale consideration. That is what we need to look at. The valuation part we'll see later, but the basics I am telling. Third one is what? Abandoning or giving up an asset, relinquishment of an asset. Relinquishment of an asset. It's a case of an owner abandoning the same while the asset continues to exist even after such abandoning. So, basically giving up an asset. For example, I have an agricultural land, I am giving up the entire rights of the land so that the joint development agreement can be formulated. So, that is also called what? This thing. Where the SSE, thank you. Thank you, boss. This also you can take, so thank you. Where an SSE, owner of the land, entered into an agreement with a builder to develop the said land. However, later the agreement could not be executed. Compromise deed was executed between the parties where the SC became ready to relinquish its right of ownership after receiving certain sale consideration. This also constitutes transfer. So, all the Supreme Court judgments you need not remember, but you remember the facts of the case so that they will ask in adjustments. So, all this whatever I have added here is all part of your adjustments. So, as you saw in PGVP you are able to solve questions because we did all the adjustments one by one. So, our idea only is to do adjustments, and same with assessment procedure. I will take you to such a depth that probably you never would have seen, and we will do it like that because any question that comes we will be in a position to answer. As I said, there is no point in simply finishing the syllabus and not covering the hidden adjustments. That is what I believe in. Next time I will be smarter and take 15 days. I didn't know actually, so my mistake. I thought, generally fast track batch is a different thing, but nowadays I need to understand that fast track now means students will come with a clean slate. Now we have to change with the times. Genuinely I did not know. The next time onwards we will keep little extra days for sure. I will be coming here every attempt or at least once a year for sure, and we will do that 15 days, 16 days, so that everything we can cover. That will be a better thing actually. Because I also believe face to face matters. I would have extended, but I really have other work. Unfortunately, I need to rush back. Otherwise, we would have definitely extended those 5 days. And you guys also have other classes, other things are scheduled. No problem. Next time. But I will ensure that whatever we do not do, everything I will give you videos. That is my promise. So there will nothing will be left out. So don't worry. Yes. So because whatever money you have invested should be complete, recovery, return on investment. So, if you see, it relinquishes its right of ownership after receiving certain sales consideration. Yes, that is also transfer. As I told you, other chapters doesn't require so much depth. There is no point in going so much in depth. These chapters you are seeing the questions. Yesterday we solved PGVP. If we had not discussed discount on issue of debentures at such small point, would not have been able to solve that question. So, like that, so many you only saw. So, whatever we are doing is very much required for the exam. Next is extinguishment of a right therein. So, as I told you, Reliance actually issued right shares in the year 2020. For every 15 shares held, they gave 1 share. Right to buy 1 share, not 1 share. Right to buy 1 share. So, let's say you have a bunch of shares and you actually now get a right to buy 100 shares of Reliance. I don't want to buy. So, the Reliance market value was 1600, they were issuing at 1300. You are interested in buying the shares. If you want to buy the share in the open market, 1600. But if you buy from me, that is the right shares, 1300. But I will say, boss, since I am selling the right, for that right alone, you give me 200 rupees per share, per right rather. So, for you, overall cost will be 1500, which is very much less, 100 rupees less than the market value, and you will be saving 100 shares into 100 rupees, 10,000 bucks you are saving. So, please go ahead. So, this one, by collecting 200 rupees per right to buy a share, I am actually giving up or extinguishing my right to buy the share. Is that also capital asset, capital gain? Yes. Is it transfer? Yes. Right anyway is a capital asset. But is it a transfer? Yes. That is called extinguishment of a right there. destruction, annihilation, extinction or termination of an asset. Right in an asset. Rights in an asset. If you see other terms, relinquishment, exchange, sale talks about asset. Here if you see, this is the entire thing. Sale, exchange, relinquishment of an asset. Extinguishment of any rights in an asset. Correct? So in a right share, do I own a share or the right to buy a share? Right. So if I am giving that up, abandoning that, that is what? The extinguishment of the right. The previous example I told you, land. I gave up the land, title, that land only I gave up. That is why it's called relinquishment of a capital asset. Yeah. Correct. Renounce, yeah. But will you get any money for it? No. Since there is no capital gain. 100%. Extinguishment of any right is, let's say I didn't act only on it. 15 days time that given, I didn't reply only. Correct? For example, me, I had also got that letter. That's why I know. But I have only 2 shares in Reliance. I buy one share just to get AGM letters. For company law, I wanted to show everything. That's why. So the thing is, I also got a letter. They said for every 15 shares, you will get 1 share. I held only 2 shares. Which means to get the right share, I have to first buy 13 shares. And then buy 1 right. So I ignored it. I mean, anyway, I am not eligible. But let's say I held 15 shares. I would have got the right to buy 1 share. I did not bother replying only to that. What do you think? Yes, it's a transfer, but at what consideration? Nothing. So where capital gain? Nothing will come. Is there any sale consideration? Nil. Nothing. So there is no calculation. That's also definitely extinguishment of a right. Did I do anything about it? No. Right? So that's what. Here if you see, everything should go hand in hand. There should be capital asset, transfer, there should be some consideration. There is no consideration, what capital gain will come? Nothing. But then if the consideration is nil also, capital gain will come in certain cases. For example, gift. Capital gain may not come, but something else will come. We'll see that later. If I have a property worth 1 crore, I have gifted it to you fully like that. Right? Gift is not a transfer, it is gifted to relatives. Right? I have gifted it to my relative. Is it a transfer? No. But then like that, people were transferring to many, for example, Jayalalitha was transferring to so many people. Even Mayawati also, she had transferred to so many people. Lalu Prasad Yadav. That's why they changed the law in IFOS. Gift taxation 56(2)(10) was introduced. So like that, you have to read together. So when I do capital gains, I will also have to touch upon IFOS. So capital gain and IFOS should be completed together. IFOS, other points you can do on your own, but the main things is this only, related to capital gain, then your deemed dividend, all those things. The basic level of inter and all, they will not ask now. They will ask only these deemed dividend, 222A, B, C, D, E, 56(2)(10). Those are only the important things in IFOS. And other small things which you study in inter, they will not give. But capital gain, unfortunately, though we studied this in inter, we have to study at a higher level now, and other things are there. So that's why it will take some time. And basics, once it is structured in our brain, whatever they do, we can easily do it. So of rights. Next, conversion of capital asset into stock in trade. One second before that. You see, in Companies Act, there is something called reduction of share capital. Reduction of share capital would be subject to what? Capital gains tax also. So, reduction of share capital, they will come to you and they will say, sir, please reduce your capital. You assume that something, I will give it to an account called capital reduction account. So, you have purchased shares worth 1 lakh, I will show it as only 90,000. 10,000, I will show it as capital reduction account. Internal reconstruction, you would have heard. So that 10,000 that you reduce, no, that is also what? Capital gains. If you get any consideration for that, capital gains. If you didn't get no consideration, then no capital gains. Simple. So when you reduce the share capital now, directly you will go to a section called 222D, which we'll see later. See, right issues. Exact your same question. Point number 4. Supreme Court judgment. Kodai Distilleries, Bangalore company it is, Kodai's, famous guy into liquor. Exact same question, see. Will you get capital gain though? No. Sometimes you may feel why these things should go to Supreme Court, but it goes because it's all about interpretation of each of those lines. And this only they will see, institute doesn't have so much time also to sit and do may adjustments. They will pick some few Supreme Court cases and they will give. So case study booklet is also getting ready, some 60-70 pages. I will share it with you as a soft copy. You can go through that. These case studies are what? Your MCQ case studies. So they'll give you a case study and give 3-4 questions. That will have mixture of many chapters also. Sometimes it can only be one chapter. They'll give you with answers. It's getting ready. 1 or 2 days. Send it to you. Right. Next. So solve that also, guys, very important because you will be getting integrated case studies in the exam. Standalone MCQs also you will get, integrated MCQs also you will get. Integrated MCQs also you need to study, and either way it will also help you in IBS for sure. So because those things are there both. So for both put together I have made that. So you can, but it's actually predominantly from DT syllabus, DT this thing only, previous year's questions. Please go through that. Next. Compulsory acquisition. Acquisition of any capital asset under any law for the time being in force shall be, yes. So, any involuntary, compulsory acquisition, do you want to give away? No. So, in Bangalore, they are doing this left, right, center for metro. Correct? So, half of one mall also went, and there are 4 complexes in one flat. Complex A went. Compulsory acquisition. They have the right to do so. So, yes. Such transfers are not voluntary in nature, but shall be deemed as a transfer. And this one, conversion of capital asset into stock in trade. So, you have some capital asset with you, you will convert it into stock in trade. For example, you had a jewelry in 2021 at home, capital asset. Now, after 2 years, you bring it into business. Cost was 1 crore, FMB as on bringing it into business was 2 crore. You made it into stock in trade. And then you sold it. So basically, guys, the day you sell it off 2 crore FMB, sold it for 2.5 crore FMB, 50 lakh rupees that you get, it would obviously be PGBP. But what about this? You didn't do anything. You just took from home and kept it in the shop. But there's a difference of 1 crore here. Is that capital gain? Answer is yes. So, conversion of capital asset into stock in trade, the date of conversion, that is in my example 2023, that is the date of transfer. But I told you one thing, when is the capital gain paid? Always date of transfer. So, should I pay capital gain in 2023 even though the asset is actually sold in 2025, it converted in 2023. Did I get any money though? No. I just from home I've got it into the shop. Nirmala madam says that is transfer. But should I pay capital gains on that day? Generally yes, but I told you no, there are exceptions. There are exceptions where year of transfer is not equal to year of tax. Year of tax is postponed. One of the examples is conversion of capital asset into stock in trade. So logically speaking, in 2023, I just got whatever from the home, I got it and put in the shop. It's a transfer. Very clear, it's a transfer. But should I pay tax? Why will I? There's no money. What will I pay? I'll tell Nirmala madam, when I sell it, no, that time I'll pay both. I'll pay PGBP also, I'll pay capital gain also. Yes, no problem. So in those cases, the, capital gain payment is postponed to the year in which that asset is sold. not the year of transfer. What is the year of transfer? 23 only. Should not get, year of transfer should not be taken as what? 25. What is year of transfer? 23. After it is transferred to stock in trade, then it is PGBP income. That is not capital gain income. Yes. Loss. Loss. Yes. The moment capital gain ends here only, over. Capital asset nature only ends. We saw, no? Capital asset excludes stock in trade. Yes or no? So when it becomes stock in trade, is it a capital asset anymore? No. So whatever happens after is loss or gain under PGBP. Whatever happens before is capital gain. Let's say the FMV is less, just saying it won't happen. If it's less, then it's a capital loss. Here this FMV happens to be, instead of 2 crores, 50 lakhs. That's a capital loss. Compulsory acquisition, yes, done. Next. So all these are transfers, guys. So 16th July, guys, you entered into an agreement for sale of a house, 50 lakhs. Then you are telling him, boss, let's register. He's still constructing the house. Then what will I do? I'll say I will take the possession of the house. On 17th November or September, I will take the possession of the house and I'll pay 20 lakhs that time. But unfortunately, the registration happens only on 22/2/2025. When is the actual date of transfer? Legally, it is the day you register the sale deed, not agreement for sale. So you are the owner of the house on 22/2/2025, right? But you started to live in the house on 17th September. Now tell me, when is the transfer happening? 2025 or 17/9 or 16/7? This was a valid question raised. So that's why we have something called as the Transfer of Property Act. If you see, generally, possession of the immovable property is handed over to the purchaser, sale consideration is paid and registration is done. Sale is complete. Means what? I told you, when is it legal? The last day, registration day, because that time registration is done. However, 53A of the Transfer of Property Act contemplates a situation where in a contract for transfer of immovable property, owner hands over the possession upon receipt of a sale price without sale deed. It's not registered also. Such a situation, transfer is deemed to have been occurred, and the same shall be considered as transfer in the context of capital gain. So, when will I take it into account? 17/9. Yes, part performance. It's called part performance of the contract. So, as per capital gains, for capital gains purposes, the day you take possession, that will be the day the transfer has happened. And tomorrow, can you sell it off if you want to? Yes. So the date should be taken from 17/9, period of holding, right? Period of holding should be taken from 17/9. For you, I have already taken the house. Now I am the owner, though I am not the legal owner. When is the legality comes? 22/2/25. But on 17/9, as per capital gains, I am the owner. So period of holding will come from 17/9/22. But my next question is, what value of the house should I take? Should I take the value as on 17/9? Should I take the value as on 22? Tomorrow when I am selling it, I have to take the cost, cost of acquisition. Cost of acquisition should I take on 16/7, 17/9 or 22/2? That we will see later. That also there is a change. Ideally, I should take again on 22.2. But then I am already, if you are giving me the possession and ownership on 17.9, why not take on 17.9? Some people went to the court and said, sir, but 16.7 only I had paid, sir. Assume this is okay, only the same year. Assume it is 16.720. So 2 years ago only I had paid, sir, at a lesser rate. Please allow me that to be the cost of acquisition if I want. I can, it's my choice. Give me that. Or give me this 17.9, whatever it is. And for the other party, he has to take the sale consideration. No, let's say I'm buying it from somebody else, not from the builder. From that somebody else, I got some money today. I got some money here. So when will he take as a sale consideration? Two different parties are there. For him also capital gain will come. That part we'll see later. But when is the transfer happening? 17.9. It is called 53A of the Transfer of Property Act. Lot of confusion used to be there, which date. That is why they inserted that thing as transfer will be deemed to be on which date. 53A of the Transfer of Property Act, part performance of the contract. Clear? I have the asset with me and it's just appreciating in value. Is it a transfer? No. Like gold, I had 1 crore, now it is 2 crore. Is it a transfer? No. The moment I bring it into business only, then it will become a transfer. That's what they are trying to tell. Is gift a transfer, guys? Generally, yes, I'm transferring the ownership of the asset to you. Consideration may not be there. I'm not even talking about is it a transfer? Yes. But there's a section 47. Even though it is a transfer, it is deemed not to be a transfer. That is the next part of discussion we'll have to do. There are only 3 items in capital gain: capital asset, transfer, consideration, rates. If four items. If these are done, the chapter is over. But there are so many iterations in each of those things. That is what we need to see. Period of holding also changes with different things. Got it. So it would not attract capital gains, as such instances are given in 47. Now there are certain instances also. You see, for example, here it says relinquishment of an asset, that is abandoning or giving up an asset, or extinguishment of a right of the asset, total destruction of the right. I have a building gets destroyed by fire. Is it a transfer? I have a building gets destroyed by fire. Transfer? As per definition, 100% yes. 100% yes. But what is the consideration that I get? 0. If I had insurance on the building and I get insurance money, 1 crore, is it consideration? Yes. Right? So is insurance compensation also valid consideration? Yes. So you see. Please read note number 3, guys. Note 3, please read. Done? The insurance company received in lieu of destruction shall always be subject to tax under that capital gains, even though there is actually no transfer of asset. Did I give the asset to somebody? No. That is why there is that dialogue called extinguishment. That is why they have inserted. So though there is no real transfer, they have inserted a thing called extinguishment, which makes it a transfer. Did I actually physically give the asset to somebody? No, it got destroyed. That is why it's a transfer. That's why the definition is very, very important. Now, hold on there. So you are saying it's in the business. So it's in the business, that building is in the block or not? Block. In block, we saw one dialogue. Minus money is payable. Money is payable will include insurance compensation. So the moment it is in business, capital gain will not come. Yes, then capital gain will come. Whatever amount you received, no, for that capital gain will come for sure. Now again tell me, today the building got partly destroyed or whatever it is. Compensation I have claimed from the insurance company. Building got destroyed today. Investigation etc. happened later, and 1.5 years later I got the money. So according to you, the day building got destroyed, that's a transfer for sure. That day only I have to pay? No, first of all it's destroyed, what I will pay? So I went to Nirmala madam and said, let the insurance money come madam, then I will pay. No problem. If it's a gain, I will pay. If it's a loss, then nothing. So yes, this is one more exception where though transfer has happened, the payment of capital gains is postponed, right? So there are exceptions. One exception was what? Conversion of capital asset into stock in trade. Just because I put it in the shop, that doesn't mean I have to pay you. I will pay you later when I sell it later, don't worry. Similarly, asset is destroyed. You are asking me to pay now only. I will pay later. Compulsory acquisition. Government came and took away my entire property. When they are taking away the property, unfortunately as per law, transfer. Visualize a scene when the government is taking away my property. Background music, that slowly, there is a, zoom in. Nirmala madam is waiting. She is saying, transfer happened, pay money. First of all, compulsory acquisition. I didn't even want to, give away this property. Now you are asking me for money. In that case also, postponed. So I will tell, madam, first you give me money. Reverse Uno card. Right? First you give me money first, then I will pay. You took it away from me. I didn't want to give only. You took it away. First you give me money, madam, and then I will pay in that. So in that case also what? The capital gain payment is transferred. It's very easy, guys. Capital gain is very easy chapter. But common sense is needed. Concept if you understand, that's all. Nothing else is there in this chapter. Done. Then you may have seen, what do you say? How many of you live in Chennai generally it's rare, I have not seen, but how many of you live in apartments? One. Do you have an association in your apartment? No. It's just, how many buildings are there? How many flats? 4 or 5, that's why in Chennai it is not, I don't see that. In Bangalore, like there are 300, 400, in one place bloody some 1,000 apartments are there. It's like living in a fish market, right? It is true, some 1,000, 2,000 apartments and all, their entire complex, gated community, crazy. So 4 and all is good, man, very nice. It's actually like an independent house but in a flat. So in Chennai I don't see that concept that I see in Bangalore. So in Bangalore there will be associations. So that house will be some 70, 80, 100, 200 homes, association will be there. So this association, when I have an entire building of so many, this entire association, entire building will be run by a association of person. And this association of person should be registered under something. Otherwise what? AOP, is it required to be registered? No. AOP is simple stamp paper, you can create an AOP. But you need to register this association somewhere. And most of these apartment associations will register in Societies Act. Cooperative Societies Act. It's a cooperative society or a normal society, building society. Now the question to you is, when you register it as a society, each owner, let's say there are 100 homes, the society will have 100 shares. Each owner will get 1 share in the association. In the society, they will get 1 share. So the best part of the society is the entire asset, it is transferred in the name of the society. And in exchange of that, you will get what? 1 share. And each share will have a value. And the value will be value of your house plus the common area. That's called the undivided share, UDS. So that's the money that you will get. Tomorrow, when you are selling the house, can you sell the house? No, because you don't have the house only. Who has the house? Society. So tomorrow you are the buyer, you will come in front of me and say, sir, I want to buy the house. Sir, house is not in my name, society's name. Then you will ask, okay, sir, give me that share. That one share you have in society, no, you give me that. What is the rate of that share, sir? The cost is 1 crore, but now the market value of that share is 2 crore. Because that's the value of the house. So when you transfer the share, is it deemed to be transfer of the house? Yes, that is the next point. Point number 8. Please read. Point number 8. Read that. Got it? Then we saw the ZCB, zero coupon bonds, right? So we saw it in PGBP yesterday. So if it's a 100 rupee bond, I issue it at 70 rupees, and that 30 rupees will be, whatever I'm getting. So we saw from PGBP from the company's point of view. A company's point of view in PGBP, 30 rupees is the discount. That will be prorated according to the number of months. And we saw if it is more than 15 days, considered to be 1 month, all that. From that company point of view, we saw. From investor point of view, ZCB. First of all, I purchased it for 70, but the value of that is 100. Is there a gain of 30? Yes. But I may say there is no actual gain because I didn't get any money. So to clear all the confusion, I inserted that point. When you sell a ZCB, at 30 rupees will be a gain. So when is the transfer happening? When the ZCB is getting redeemed. When it is getting redeemed, now you purchase for 70 bucks. 2 years later or 1 year later, they'll give you that ZCB, they'll redeem at 100 rupees. So for that 2 years, the value will be increasing at 100, but you will get the money 100 later, no? That 100 rupees will be transferred. To clear confusion. Actually, there is no confusion, but in case. So that is the thing. So we discussed what is a capital asset. We discussed what is a transfer. We need to discuss what is not a transfer, that we will see later. Third part is types of capital asset. This is very, very, very important. Everything has changed in this in Finance Act 24. In the sense, this entire structure, no, it has been completely shifted somewhere else. This is the last time ever this structure will be followed in the November 24 exams. Because she has made some changes in such a way that this 1 year, 2 year, 3 year is no longer there. So please study this very, very carefully. This is the last time ever November 24 exams. This will come. And for you, it is good because if you study this, no, that shifting to the new one will become easy. Those who are writing in May 25. But November 24, guys, just stick to this. First, I have written it very carefully and with the highlights wherever needed. Let's go slowly. Any security other than units listed in, I'll give you time to write this down, don't worry. Any security other than units listed in a recognized stock exchange in India. So any security other than the units. Units means which one? Units of mutual fund, whatever it is. Any security. Security means equity share, preference share, debentures, anything as per the Security Contract Regulation Act. But it will not include units of mutual fund, etc. It should be listed though in a recognized stock exchange. In India, NSE, BSE, that's all. Second, since units are not covered in one, units are covered here. Units of Unit Trust of India only, not mutual fund units. Units of Unit Trust of India. Third, units of, that's why mutual fund was excluded. I already told you, they added that third one. Units of equity oriented mutual funds. Units of equity oriented mutual funds. Fourth one, zero coupon bonds. This is the type of capital asset. Period of holding for this will be 1 year, which means what? If it is less than or equal to 1 year, 2 years, 3 years, in all this 1, 2, 3, then short term. More than 1 year if you hold it for long term. This is the entire overall structure. Next, immovable property. Any immovable property, 2 years. Shares, that is equity or preference of company other than that covered in Part A. It is other than got covered in Part A. Part A, what is covered? Listed is covered. So here will be unlisted shares. Private company shares and all will come under Part B. How many years? 2 years. Any other asset apart from this? See, units of Unit Trust of India is there. What about units of a business trust? Will come under Part C, other asset. If it is listed, then yes. But in listed also, if you see other than units is there, no? Which one? No, units will be any units. I told you, mutual fund units, units of business trust, units of anything, units of UTI. Right? So if it's a listed business trust unit, again, if you see, is it listed in a stock exchange? Yeah. But then is it a security? Yeah. But it includes very clearly other than units. Correct? So listed business trust units, unlisted business trust, whatever you do, where it come? Part C. These things have fully changed in 24. That's why I am repeating again and again. Right? So that's why business trust is also an important chapter, because their capital gain will change because the period of holding is changing. The nature of capital asset is not changing. Period of holding is changing going forward, which means all these type last time they can ask in this exam. So I repeat again, first one, you remember this chart more than, I'll give you time to write down. Any security, because in the notes or wherever it may create confusion, just stick to this, more than enough. That's why I have highlighted also. Any security other than units listed in a recognized stock, NSE, BSE. Units of UTI, units of equity oriented mutual fund, then ZCB, 1 year. Immovable property, shares, equity preference of a company other than that covered in A. We'll see examples later. I'll give you one list, then you only write down the answer for that. Third one, other asset. Right? So, yeah, copy it down. Copy. Once you write, no, it will be clear. There is an important chart. The context of our exam. November 24. So ZCB is 1 year, guys. I mean, this one is 1 year. So if it is less than or equal to 1 to 3, short-term capital asset. More than 1 to 3, long-term capital asset. Any security other than units listed in a recognized stock exchange in India. Every word is important. Units of Unit Trust of India. Units of equity oriented mutual fund. Zero coupon bonds. Immovable property. Shares of company other than that covered in Part A. Other asset. A and B, if you remember, other things will be C. Actually, A is the most important thing. Other things are all fine. Are we done? So, write down these examples, guys. First, write down these examples. Then you only need to tell me the period of holding. Just write down first all the examples. First, house property. Against it, you can write the answer. House property. Again, these examples last time ever in this exam. House property. Second one, jewelry. House property. Second, jewelry. Third one, equity shares of Reliance Industries Limited. Equity shares of Reliance Industries Limited listed in BSE. Next, preference shares of Infosys listed in National Stock Exchange. Fifth one, shares of PJ Private Limited, unlisted. Unlisted units of UTI. Seventh, unlisted units of unit. Sixth, seventh, debt oriented units of Sheela Mutual Fund listed in Bombay Stock Exchange. Shares of Tesla Incorporated listed in US Stock Exchange. All examples. Ninth one, ADR of Infosys Limited listed in NASDAQ. American Depository Receipt, ADR. It was actually listed. Narayan Murthy had gone and he had rang the bell there. I remember, NASDAQ. Ours was the first company, Infosys was the first company to be listed that time, many years ago. Equity oriented mutual fund. equity oriented mutual fund of KSA mutual fund. Eleventh one I can say units of business trust. Units of business trust. Any business trust. Write the answers, guys. Write down the answer. Try. Then we will discuss. You can see the chart obviously and you can try and answer the question. It's either 1 year, 2 year, 3 years. Done, guys. So let's see one by one. Tell me, house property, 2 years. Why? Because it's immovable property. Jewelry, it will not come anywhere here. Other asset, 3 years. Equity shares of Reliance Industries listed in BSE. So it is again security listed in a stock exchange. Hence it is 1 year. Sorry, 1 year. Next. One second. Online people, are you able to see? Yeah. Preference shares of Infosys, again guys, it's a security listed in recognized stock exchange, hence 1 year. Shares of PJ Private Limited, since it's a private limited, it's not a it's a security, but it's not listed in any recognized stock exchange in India, hence it will come under point number 2, that is 2 years. Unlisted units of UTI, units of UTI, whether listed or unlisted, I don't care, it is 1 year. Debt oriented units of Sheila Mutual Fund listed in BSE. Guys, it is because it any security other than units it says. So any unit listed in BSE 3 years. Unless it is units of equity oriented mutual fund or unit trust of India. I am talking about debt oriented mutual funds. Debt oriented fund listed in BSE. Shares of Tesla Incorporated listed in US stock exchange 2 years because it is recognized stock exchange in India. Right, and ADR of Infosys listed in NASDAQ. It may be a security. ADR is a security for sure, but is it listed in India? No. Hence 3 years. Equity oriented mutual fund of KSA mutual fund. It's unlisted. So that's what it's an unlisted company. It's only very clearly units of equity oriented mutual fund here. Here it is mutual funds of an unlisted. It is an unlisted mutual fund, not listed. So what will come? How many years? 1 year. Lastly, units of a business trust, 3 years. Business trust, is it covered anywhere? No. Got it? Yeah. We will come to that. That's why 50 AA has come. Hybrid 50 AA. Hybrid funds 50 AA. Cool. So that's the reason why this, this is the entire thing. Anyway, it's given here also, long term, short term, all those things. What about this? On the land of 10 years, I have constructed a house last year and I sold it. Both land and building I sold. Is it short term or long term? Land of 10-year-old land, which my father had bought, he gifted to me. I constructed a house, sold both. Sold the house properly to you. There is no joint development and all that. Just constructed the house and sold it off. Okay. Major portion. So if you see note number 1. Land is held for more than 24 months, but the building considered less than 24 months. Land becomes long term, building is short term. It should be calculated separately. So you need to do the valuation and do it. You have to do it separately. So whether you receive bulk money or separate, you have to do the valuation and do it separate. So you are getting this right. Note number 1. Which page in your material? 8. Here and there, same. Period of holding includes fraction of a day also. Interesting point. Period of holding would begin on the day when the SC became the holder and end on the day before the completion of 12, 24, 36. This is one thing which you always miss out. If the land was first held by an SC on 18/11/2019, it will be long-term capital asset by the end of 17/11/21. One day before we should take always. Sorry? Oh yes, like that. So one day before. The asset is transferred on 18/11/21. It shall be considered as long-term capital asset even if the land is held for a fraction of a day on 18/11/21. So when is that 2 years getting completed? One day before. It's a very simple point, but when we are writing the period of holding, etc., we should write one day before always. Note number 4, business trust means a trust registered as an infrastructure investment trust or a real estate investment trust, and their units are listed on recognized stock exchange in accordance with SEBI regulations. For short term capital gain, period of holding, whatever, for unit business trust shall always be 36 months. This has changed. So last time ever in November 24, it is always 36 months. So this part you will not get in the notes, later we will draw the chart. This is that hybrid that he was asking, 50 AA. Later we will see. So whenever I say equity oriented fund, what do you mean by that? 90% of the total proceeds of the fund is invested in units of the other fund, or it is invested in 90% of the total proceeds in the equity shares of domestic companies. So where fund invests in the units of another fund which is traded in a recognized stock exchange. So you have a fund, and that fund you are investing in another fund, and that fund is trading only in, that fund is listed in a recognized stock exchange. On the other hand, basically if I am only the fund which is directly investing in domestic companies, so there is already a fund which is investing in domestic companies. If I am investing in that particular fund which is investing in domestic companies, which is listed already, so then 90% should go. But if I am that company which is directly investing in equity shares, like a normal fund manager, right, 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. 65%. So if there is an instrument where 70% is equity and 30% is debt, if there's a plan which a portfolio management service gives you, that is not a hybrid fund. That is a equity oriented fund. Alright, so what do you mean by hybrid? We need to see. That's why 50AA is there. Minimum of 65% of the total proceeds of such fund is invested in the equity share of domestic company listed. So why am I doing all this? You may ask. You see, I'm not even kidding. There is in recent times they are asking that question. So we will see that later the question, but I want to show you the depth at which they are asking. Come to capital gains, I'll just show you that one question. Nowadays, they are asking such questions. Page number 55. Question number 11. May 24 RTP question. Mark that as important, later we'll solve it. See, he had an impressive investment portfolio in various mutual funds, redeemed his entire mutual fund investment and bought a villa in Lonavala to spend the rest of his life there. Details are as follows: growth fund, strategic fund, mid cap fund, SBA growth fund, date of investment, date of redemption, amount invested. And they are given here, see, fund 1 will have invested in 30% in equity, 3 and 4 have invested 70% in equity. So 3 and 4 is equity or debt? Equity. If you didn't know this, gone, right? Whereas 1 and 2, is it debt oriented or hybrid? We'll have to, for that we have to read 50AA. We'll see that later, okay? That is little advanced. Later we'll come to that, 100%. So the thing is, this is the way they are asking questions. The recent crop of questions are based on this. So we need to unfortunately do all these things, right? And mind you, there is no question that came as such in May 24 exam, which means November 24 onwards you will get it. And in 50AA also there is a change in November in the Finance Act 24 with respect to the definition. Slightly they have changed it. So it will all, boil down to our exam now. We'll see this 50AA later. Now, if I receive an asset on dissolution, it is a asset belonging to the partnership firm dissolves and I am getting the asset. For me, period of holding is when? The day I get the asset or date of dissolution? So, there is a dissolution of the firm and the firm's asset is projector. I got the projector later, I bought it, dissolved. So for me, that's a capital asset. Period of holding for me would be date of dissolution or date I got the asset. So this was an issue. Went to the Kerala High Court. See, PP Menon. What is it? Period of holding shall be taken from where? Date of dissolution. Listed in US stock exchange. Since it is listed in US stock exchange, it was 2 years. No, 2 years is not just unlisted. So he is asking one doubt here. This one. How is it 2 years? He is asking. I told example as unlisted. says shares of a company other than that covered in Part A. What is Part A covering? Listed shares in India. Other things will come here. Unlisted, private company, foreign company shares, all that will come. Is that clear? Anyway. Okay, with that, later now comes the capital gain as such. This you already know. Quickly we can go. Computation of non-depreciable asset, and section 50 provides for computation of depreciable asset. Section 50, computation of depreciable asset, already discussed. Where in the block it is there, if it is sold beyond the block, where block becomes 0, there should be 2 assets at least, and there should be at least 1 asset and there should be some value. If either of the things is not there, then it will become capital gain or loss, as the case may be. Predominantly gain. Whereas for a non-depreciable asset is what we need to see, section 48, computation. Full value of consideration, expenses incurred in the transfer, net consideration, you have cost of acquisition, cost of improvement. Whatever we will see later, and ultimately capital gain, less all the exemptions short term. Here you will not get indexation. Whereas long term capital gain, which is like more than 1 year, 2 year, 3 year in that chart, then you will subtract the expenses. 2 things you will get: indexed cost of acquisition, indexed cost of improvement, less exemption. Now this indexation is from the year in which you, what is indexation? The year in which you basically bringing, if you bought 20 years ago an asset for 100 rupees, today this value will not be 100. So cost of, if I am selling it at 10,000 rupees and I am taking the cost at 100 rupees, it's a skewed figure. I should bring this to current market trend, for which there is something called indexation. So this indexation, index value will be given cost inflation index. So to the year of transfer divided by the year of purchase, if you do, it will bring to cost. Then 10,000, let's say it comes to 1,000 rupees. So instead of 10,000 minus 100, a skewed figure, I should do 10,000 minus 1,000. This is called indexation. Finance Act 24, concept of indexation has been removed after a particular date. Hence, it is very important for us to understand indexation. This is the last time ever it can come. Afterwards, what has happened in 24, you leave it. But yes, indexation has been removed. That anyway, everybody knows. It's a open news anyway. But there are some iterations. Let's not go there because we are not discussing Finance Act 24. For this, whatever we are doing, indexation is there. For everything, any long term, we have indexation, except shares. We'll see that later. Even for our attempt, I am not seeing what is there in November 24 at all, in Finance Act 24 at all. So full value of consideration, whole price you should take, and then all these things. That is the simple part. Now if you see the indexation chart is given. C13, yours will be here and there, 9, 10, 11. In that you maybe for 23, 24 you write down, it is 348. Our main thing for our exam, 348. Write down, put it down. This is irrelevant for us. What is our assessment year? 24, 25. Financial year 23, 24. What is it? 348. Even if you don't remember, it's okay. They'll only give you, but I'm saying 348. So if I bought an asset, let's say in 13, 14, I'm selling it in 23, 24. Excuse me. I should bring it to cost in what way? Cost of acquisition into 348 by 220. Bring it to cost. So this is released by the central government every single year. So we don't have any say in this. You just have to not to remember anything. The indexation came for the first time ever in 2001, 2002. So anything before that, should I ignore it or should I assume it is from 2001, 2002? So we'll have to see that. So should I assume it's from 2001, 2002 or should I ignore it? This is the question. So yeah, benefit of indexation, yes. If an asset is acquired before 2001, 2002, should I do the indexation or should I do that? We will see this. So, for all properties acquired before 1/4/2001, what is the scene? If it's after 1/4/2001, no problem, we do the indexation. So, there they say, very simple, indexation is nothing but bringing it to the market. So, if I bought something in 1981, I cannot start from 100. I should understand what could have been the market value as on 2001. Then only makes sense. If I tell the market value as on 2001, that will give me like the indexed value only actually. So, very nice provision they released. It is either the cost of acquisition or the FMV as on 1/4/2001, whichever is higher. Right. So, if it's bought in 1981, you bring it to the market value as on 2001. And from there, what will you do? Take the indexation. So, if I bought it in 1981 and sold it in 2023, or if I bought it in 2001 and sold it in 2023, I would have done 348 divided by 100. But if I bought it in 1981, take the cost or the FMV as on 2001, that makes sense. And once you get the, obviously FMV mostly will be higher only than the cost. So, take that FMV as on 2001, which is like bringing that asset from 81 to 2001. And from 2001, you drag it on, 348 divided by 100. Makes a lot of sense, very, very logical provision. So, cost of acquisition or FMV, whichever is higher. We are Indians, when they make the law, we break the law. Correct? FMV, who will decide this FMV? Valuation officer. You will not get some chart where you can see FMV. There is a valuation officer, you should go to him, he will decide the FMV. So, I have a family property of 1981. I am selling it today for 10 crores. That my great grandfather bought it in 1981 at 1 lakh rupees. Now, I have to bring it to 2001 FMV. Right? What do you think? If the cost is higher, my capital gain will reduce, or if the cost is lower, my capital gain will reduce? Cost is higher. I have understood that actually the FMV is only some 10 lakh rupees. That's all. And from 10 lakh in 2001. So, that 10 lakh I have to bring it to 2023. So, I will do 348 by 100. But I want to increase that 10 lakh. I will go to the valuation officer, pay him some bribe and say, make it 40 lakhs bro. I will give you 5 lakh rupees, make it 40 lakhs. He will make, it was happening. So, the beauty is FMV can be manipulated. So, they used to manipulate it by making it 40 lakhs. So, 40 lakhs into 348 by 100, imagine. It will increase the cost to such a manner that the capital gain will reduce. People were doing this mercilessly. But when the government checked that exact land value in that area for which you have claimed 40 lakhs, that is showing 10 lakhs. How did they get 10 lakhs? That is something called as a stamp duty value. Each area will have a sub-registrar's office and they will have the land records from 20, 30, 40 years ago. If you see the land record in 1981 for that particular area, it was whatever, it was amounting to 10 lakhs or 8 lakhs, 11 lakhs, whatever. So, my question is, boss, in and around that area is okay. But the stamp duty value as per the sub-registrar's office, which is actually a government record, is showing 10 lakhs and you are paying bribe and making it 40 lakhs. So, these people said, sir, but SDV is not given only here. What does it say? Cost or FME, whichever is higher. To curb this from happening, amendment came in the year 2020, quite recent. What did they say? Dialogue. FMV as on 1/4/2001, that 40 lakh cannot be more than SDV. Cannot be more than SDV, 10 lakh. But then it's government. Record may be available, may not be available. So they coolly said wherever SDV is available. They knew in some place it was not available. Some place it was not available means that's all. Valuation only will win. No, nothing can be done. But wherever it is available, you cannot claim that extra. So now we should do two steps. Step number 1, FMB as on 1/4/2001 or SDV as on 1/4/2001, whichever is less. 40 or 10, whichever is less. 10. Then cost or step 1, whichever is higher. Cost would have been 1 lakh in my example. 1 lakh or 10 lakh, whichever is higher. Very, very good amendment in 2020. Right. So step number 1, FMB or SDV, if available, on 1/4/2001, whichever is less. What FMB did I make? 40. What is the actual SDV? 10. 40 lakh or 10 lakh, whichever is less. Next, cost 1 lakh or step 1, 10 lakh, whichever is higher. So the practice of claiming higher amount was removed with this amazing amendment in 2020. So in 1/4/2001, I should check SDV also, FMB also, and compute whichever is less first, and from there you can take do the needful. Second question is, what if there is, what do you say, cost of improvement? In 1981, my great grandfather bought the property. In 1990, 9 years later, he went in for some improvement. And in 2001, the indexation starts at 100. Cost of acquisition, I will make the FMB till the year 2001. What about cost of improvement? He bought an asset worth 1 lakh. He constructed one more floor, 1 lakh. What do you think? Cost of improvement before 1/4/81. Should I ignore it or should I take it into consideration? Logical thing, guys. When I am computing the FMB as on 1/4/2001, it is the FMB of the entire property, right? It will also include the cost of improvement. Hence, cost of improvement before 1/4/2001 should be ignored. Got it? Huh? They will take. Stamp duty value is not just for the land, it's for the property. So it's not just the land value, it's a property value. How many floors are there? What have you taken? Everything they will take into consideration. So stamp duty value is always not just for the land, but entire for the area, how much, what is the quality of the construction, everything they will take into account. So basically, second point, cost of acquisition, cost of improvement, done before 1/4/2001 should be ignored because FMB already includes everything. It includes everything. 3-4 minutes and we'll take a break. So that is what it is. We'll stop at a juncture which is relevant. So indexation is done. So I'm going this page by page. Benefit of indexation already discussed. Point number 5 we have discussed with the amendment as well. Then yes, if asset is improved before 1/4/2001, we have to ignore it fully. So again, when I say indexation for 23-24, and let's say I purchased the asset in 2010, does it matter when I purchased it? I may have purchased it on 1st April, I may have purchased it in 1st December. So should I do like that PGBP, 50% depreciation, anything like that? No. So one more interesting thing is, even if I buy it on 31st March also, or if I buy it the previous, that 1st April, beginning of the year also, indexation remains the same. Indexation won't change with time for that particular year, right? Hidden points. Good, you know these points only, but yes. Point number 7. Date of transfer is immaterial so long as it is within the particular financial year. All the assets transferred on any date in the previous year would have the same indexation. So FMV will be price it would ordinarily fetch in the market, and it will be determined in accordance with the rules made under this act through a valuation officer, which is open to lot of, other things. Indexation benefit is available in case of any purchased intangible asset also. Cost of improvement means what? It is basically painting, regular upkeep, these are not allowed. Cost of improvement basically means what? Basically there is a big change in the way asset is, adding a floor, making a considerable material change. Just touching up, painting, that will not be cost of improvement. So you cannot take painting expenses and all those things in the cost of improvement. Yes. So there was one more thing. Goodwill. Goodwill is there. What would be the cost of improvement of goodwill? Is there any cost of improvement? Cost of acquisition also sometimes, if it is self-generated goodwill, you don't know what it is. Correct? And if you buy a goodwill, one company buys the other company's name, then it's okay. You can figure out that's the cost of acquisition. But can there ever be, in any scenario, cost of improvement of goodwill? You improve any goodwill, not possible. So even cost of acquisition of self-generated goodwill, is it there? No. Is it like, nil, or is it indeterminate? Can you determine what is the cost of getting a name for yourself? No. Sorry? Correct, you don't acquire. So is there a cost? So correct. So what happened was Supreme Court judgment. I don't know what is the cost I acquired it for, because I didn't acquire. I generated it on my own. So when I generated it on my own and I sold it to you, I generated on my own and sold it to you, I got 100 crore. 100 crore. So I wrote sale consideration 100 crore minus cost. Is it 0 or indeterminate? Indeterminate. So he made it indeterminate and he said this is a capital receipt, not taxable. When cost only I'll say my cost was 100 crore, make it 0 then. Cost also 100 crore. To build this name, I gave 100 crore worth of efforts. I can tell whatever I want, no? Went to Supreme Court. Supreme Court agreed with the SSC. Supreme Court said, you're right. It is indeterminate. Which means that 100 crore is capital receipt, not taxable. Nirmala madam went mad. What is the only way to ensure that you will pay tax? Change the law. Make cost of acquisition nil. Best, no? What is the cost of acquisition of self-generated goodwill? Nil. The moment I make nil, which means 100 crore minus 0, 100 crore, pay tax. So there was a deadly Supreme Court judgment, we'll see that later, but because of which these dialogues came. Cost of acquisition of self-generated goodwill, nil. Cost of improvement of self-generated goodwill, nil. Cost of acquisition of purchased goodwill is the rate at which you purchase, that's fine. Cost of improvement of purchased goodwill, nil. How will you improve any purchased goodwill? Doesn't make any sense, right? So that is the next point. Goodwill, manufacture, right to carry on business, it's always nil. Cost of acquisition, we'll see that later part. Now the thing is, you have an asset in 1990, you gift it to me in 2010. And I told you there are certain things which is not a transfer. So gift is not a transfer. When did I actually acquire it? 2010. I am selling that asset in 2023. So is it 348 by whatever is there in 2010 or is it 348 by 100? When the gift you gave it to me in 2010 is not at all a transfer. The period of holding will be from when I got it in 2010 or when you got it. Yes. So the thing is, since gift is not a transfer, the period of holding also will come from the previous owner. That's the general rule. That is this point. Specified modes of transfer like capital by way of gift, inheritance, distribution, on partition of HF, amalgamation, demerger, transfer between holding and subsidiary companies. Cost of improvement made by previous owner shall also be considered after 1/4/2001. We'll see that. We'll see that later. Because in goodwill separately I have to talk about it. Done. Cool guys. Let's take a break. After the break, this is the right time to take a break. We'll continue. So we are going step by step. Is the pace okay? Yes, all of you? Right. Cool. Please, let's begin. Okay. Point number G, which will, it's not there in that, but we will do this in business trust. It's an amendment in Finance Act 23. We'll cover in business. Some of the things which we'll have to cover in other chapters. So, one more doubt which happened was, I have taken a loan to buy a house and I am paying interest. The cost of the house is 5 crore and I am taking interest, I am paying interest 1 crore. Is that cost of acquisition or cost of improvement or nothing? The house is 5 crore, value of the house is 5 crore, and obviously if I take a loan and all that, I would have paid 5 crore 50 lakhs eventually, you know that. So is my cost of acquisition 5 crore, cost of improvement 50 lakhs, or cost of acquisition is 5 crore, cost of improvement is nil, or is cost of acquisition itself 5.5 crore? Because actually that's the cost, because I paid that money. Interest portion has to be ignored. Point number F. Interest portion you can claim in chapter 6A or you can claim in section 24 already. You cannot claim it in cost of acquisition or improvement at any cost. These are all like basic points, but sometimes we miss out in answering. So you need to be careful. So coming back to, I told you it is always chargeable in which year? Chargeable in the year of transfer, except I told you exceptions. These are the exceptions. These are the exceptions. 45(1)(a), damage or, which means here transfer happens in 1 year, capital gain happens in the other year. So transfer is happening in 1 year, capital gain is postponed. In all these cases, capital gain is postponed. General rule we saw, capital gain is payable in the year of transfer. Exceptions, these 7 exceptions are there. First one, damage or destruction of capital asset. Second one, conversion of capital asset into stock in trade. Then 45(2)(a), transfer of securities by a depository. Transfer of capital asset by a partner to a firm or member to AOP BOI. Receipt of capital asset or money from partner or member from firm AOP BOI. Immovable property transfer in joint development agreement, and compulsory acquisition of a capital asset. So we'll do the second one, conversion of capital asset into stock in trade. So basically guys, you had jewelry at home. Like for inter kids, I draw these funny things just to make them laugh. So previous year 1-2 cost is 20,000. So when you transfer it as stock in trade, in previous year 18-19, FMA is 60,000. I already told you that same example, 1 crore, 2 crore, same one only. You sold it for 2.5 crore, that example. Here it is 20,000, 60,000 and 80,000. In previous year 23-24, I sold it for 80,000. What is transfer according to the law? Conversion. 18-19 transfer has happened. But actually I have just taken it from home and kept it in the shop. That is, when have I gotten any money? No. In this case, the capital gain is postponed. To which year? The year in which it is sold. So, in 23-24, two things happen. One is PGBP. How much is PGBP? 80,000 minus 60,000. PGBP is 80,000 minus 60,000. And what is capital gain? 60,000 minus 20,000. 60,000 minus 20,000. But what would be the period of holding? Is it 0102 to 23-24 or 0102 to 18-19? Yes. Transfer happens here, there is no doubt about it. Only payment of capital gain is postponed. So, cost of acquisition is 20. Period of holding is 12 to 18-19. Indexation also you will get the same. You will not get indexation till here. You will get indexation only till here. But what is postponed? Payment of capital gain is postponed. Got it? Very simple. Now, one thing they can ask in CA final question, which they can ask now in inter also anyway, but we should know that any adjustments, this is how we should take. It's there in MCQ also, but 2-3 marks they can ask you this. Let's say land was purchased for 10 lakh in the year 2002-2003, land was purchased. It got converted, land got converted to stock in trade on 1/4/2015. And the FMV of the land was 150 lakhs, right? Then flats were constructed. 20 flats were constructed in the year 23-24. I repeat, land was purchased in 2002-2003. It got converted to stock in trade in 2015. And in 2023, what happened? I mean, after converting to stock in trade, flats were constructed, and the year 2023, they constructed flats. 20 flats they constructed. In 20 flats, 15 flats were sold, 5 flats were stock in trade. In the end of the year, 15 flats were sold in the year 23-24. Selling price per flat is 20 lakhs. Cost of constructing each flat was 8 lakh. Is this cost of improvement something? No. Why? The capital gain ends here only. Anything that happens later will be purely PGBP. So, with this data, calculate capital gain and calculate PGBP. Try. This is the data, very simple. 10 lakh land on 1/4/2015. This is an MCQ question they had asked actually for 2 marks in your integrated MCQ. They had given one case study and then given 2 marks for PGBP calculation, 2 marks for capital gain calculation. So, what did I tell you? This is the figures 1/4/2015. You can see the, what do you say, CIA rate. 23-23 rate is what? 23-24 rate is 348. And 15-16 rate you need to, should you see 15-16 rate? Or should you see 23-24 rate? Yes, that is sold in 23-24, but you should see which 2000 to 2003 or 14-15 or 15-16. Or should you ever see 2023-24? No. Why? I told you period of holding is only 15-16. Correct? 15-16 is the year of transfer divided by year of purchase 2000 to 2003. Are you understanding? So, the period of holding is from 2000 to 2003 to 15-16. It is not 23-24. So, that 348 will actually not come. Right? So, they will ask you compute the. So, what did I tell you? 20 flats were constructed, 15 flats were only sold. What is the PGBP? 1,80,000. 180 lakhs. How did you get 180 lakhs? into 15 flats. How did you get the cost? How did you get the sale price? 20 lakh into 15 you did, correct? 20 lakh into 15 is the PGBP. Minus cost of flat, how much? 8 lakh into 15 or 20? 15, whatever was sold. Then how much is the answer? 180. 100% wrong. Why? You missed out one thing. Cost of land you missed out. No, you have taken cost of flat. What about cost of land? Yes or no? What would be the cost of land? $150 lakh is the FMV. But 150 lakh is for how many? 20 flats. Into 15 by 20 I should do, no? Right? Are you understanding? So guys, that is the mistake that everybody makes. Sale price 3 crore. Construction 1.2 crore. Land we do not take. Proportionate FMV of land is how much? 150 lakh into 15 by 20. Why? 15 flats were sold out of 20 flats. So PGBP is actually 67 lakh 50,000. First option will be 1.8 crores. We will tick that and come. That's the mistake. That's fine, no problem. So that is the proportionate FMV. You should take the FMV of land, no? That is also a cost. Capital gain will be simple. Yes. FMV as on date of conversion 1.5 crore. Index cost of acquisition 10 lakhs. Into 1516 by 2000 to 2003 I should take. Should not take that 348 and all those things. Sorry? Correct. So first I will do this and then proportionate. Rather than doing initially, first I will do this and then do proportionate. 1 crore 25 lakhs 80,952 into 15 by 20. Which will give me 94 lakh 35,700. First option would have been this actually. In the MCQ, first option will be this. We will tick that and come. It's not the answer because we have to take the proportionate. 1 crore 25 80 952 if we sell all those 20, but I am only selling 15 now. When I sell the remaining 5 1 year or 2 years later, that time I will have to pay the capital gains. Capital gain is postponed. This is an MCQ question in CA final. Right. So 125 80 952 into 15 by 20. So 94 35 714. So conversion of CA into SIT, compulsory acquisition of a capital asset, damage destruction of a capital asset, joint development agreement. So if you see, page 52 on dialogue. Many examinees depicted lack of conceptual clarity relating to taxability of enhanced compensation received on compulsory acquisition. Assessment year-wise capital gains were not correctly computed. This is in the final suggested answers when they release and the examiner's comments that they release, no? There they will tell where all the people were lacking. So question number 7 was based on compensation. We will solve this after we do the concept. 100% you will be able to solve. Compulsory acquisition of what? Land, whatever it is. So example, in the year 2001-2002, the cost of land was 3 lakhs. And in the year 15-16, that land was compulsorily acquired. So as per 2 clause 47, when is the transfer happening? 15-16. But capital gain is postponed. Why? It is the year in which you get the compensation. So year of transfer is 15/16, but year of tax is the year when you receive the compensation. So let us say you received an initial compensation of 30 lakh rupees. You were not happy with it. You wanted more. So you sued the government. So let's say you got an additional compensation in the year 25-26, 20 lakhs. That depends on the facts of the case. In my example, I got it in 25-26. Initial compensation, I got it in 22-23. Enhanced compensation, I got it in 25-26. Question to you is, when is 30 lakhs taxed? When is 20 lakhs taxed? 30 lakhs is taxed in 22-23. 20 lakhs is 25-26. This seems easy, but in enhanced compensation, they will give another concept called interim compensation and then final compensation. We'll see that later. So first one is easy. 22-23, I'll get 30 lakhs. So 30 lakhs minus transfer expenses, indexed cost of acquisition. I acquired it in 3 lakhs for 3 lakhs. Which year? Which year is the transfer? 15/16. 254 by 100. 100 by 2001, 2002. So overall 7,62,000. 30 lakhs minus 7,62,000 will give me a long-term capital gain of 22,38,000. That's fine. When is it taxed? Which year? 22-23, year of receipt of compensation. So general rule, very simple. Initial compensation, compensation received minus cost or index cost, improvement or index cost of improvement, short-term capital gain. As far as enhanced compensation is concerned, enhanced compensation I am giving for what? For I am not happy with the initial compensation, that's why I am suing. So there my question is, litigation expenses can I subtract? Because I'm getting that 20 lakh only because I'm suing, otherwise I will not get. Legal expenses can I subtract? Answer is yes. So for additional compensation, full value of consideration, additional compensation less litigation charges, short term or long term. For additional compensation, there is no cost of acquisition. Why? I have already taken that in initial compensation. So in additional compensation, I am getting that 20 lakh extra only because I sued. So 20 lakh minus legal expenses will be my capital gain. Why? Because the entire cost of acquisition and improvement I have already taken it in initial compensation. Do you understand this? This only we didn't understand is what the paper evaluator is telling. So they were taking cost of acquisition here also, right? Once you have already taken, there is only additional compensation, right? Period of holding is what here? 1 second. It is what? Date of acquisition to date of transfer. That will not change. That is date of acquisition 2001, 2002 to date of sale. That is 15/16. Compulsory acquisition. Yes, tell me. Yeah. Correct. Correct. Only the period of holding and all will come from the previous time. The rate should be whatever rate as on that date. Rate, because you are paying the capital gain on which date? This date. So in this date, whatever rate is that rate you should keep. Now, correct. What expenses will be there for compulsory acquisition? Will there be anything? Hmm? No, here because here when I do not have any other expenses honestly, they'll just come and take it away as per the law. So that will be whatever I receive will be the income minus the only this cost I can take, or cost of improvement if I have I can take. There will be no transfer expenses honestly speaking, because in compulsory acquisition it's involuntary. I'm not voluntary, because otherwise you have registration charges, stamp duty charges, all that. Nothing is there. No, they are taking it away. So in that case, cost of acquisition only will come. That's why your litigation charges. All this is fine, guys. 1 second. You see, there will be one type of expense. One type of expense will be there. What is that? Just one expense will come. That is in compulsory acquisition. When you take over, as per the law, the registration has to be transferred to the government. So that registration expenses, in the sense the transfer of registration, title deed, that expenses you have to pay the sub-registrar's office. Generally, government will handle that, but in case you are paying, that will be allowed. That is the only thing. Because in other case, because you are paying that, so that you need to take it into account. So only that transfer of title deed, that will be taken into account. This question is actually easy because it doesn't even have the concept of interim order and final order. It was not even taken that into account. It was awarded 18 lakhs in February 23, but amount was received only in May 23. Right? So, solve this question. Then we will do the other areas. We still have some things, something called interim and final. They have not given that, which is the easy question. Question number 7. And what is that one expense I told you? Transfer of the title deed. That is the only expense, nothing else. That generally government only pays. But if you pay, you can claim. If nothing is given in the question, here is it there? Oh, it's there. See, expenses in connection with compulsory acquisition were 30,000. So this nothing is given means assumed to be paid by the SSC only. Tell me. Yeah. Everything can be claimed. Normally, everything you can claim. Any expense related to the transfer, you can claim, no issues. Try this, guys. Easy question. Actually, in this, the other things are not given only. Interim, final, and all that. So, compulsory acquisition, additional compensation. When will you charge the for tax? Year of receipt or year when it was awarded? Receipt or awarded? Receipt. Correct? Only when it is an interim order, final order, that's different. That's what I'm saying. That's why I'm solving this question. Then I'll take you to interim order, final. That's different. So if you do not find any wordings called interim order, final order, simple rule, year of receipt. So first one has got FVO's full value of consideration, compensation received, taxable in the year of receipt. How much? 20 lakhs. Minus expenses in connection with the compulsory acquisition, 30,000, 19 lakh 70. Index cost of acquisition, what should I take? Yes, that is which year? Yeah. Whatever it is the year of compensation, right? When acquired, acquisition, 2003. And when did I buy this? 19. Acquired land, that is 19, and compensation in 20. Land was acquired in 2003. So this is the initial part, 2003, 2004. And when should I take this period of holding? 19, 2003 to 2019. So that comes, they have given. 2003 is how much? 109. 1920, 289. So 289 by 109, 12 lakhs, this much. Long term capital loss. Since land was held for more than 24 months, 12 lakh 11,651. Sorry? Expenses. Your doubt only, right? Yes. Expenses is there. They have, because when expenses is given, assume that you have only paid it. Ideally, government pays it, but all that much depth not needed. You take, you have only paid. That's all. Imagine my house is going, I only have to pay expenses, right? So computation of capital gains is additional compensation, guys. It is taxable in the year of receipt. 23, 24 or 22, 23 or 23, 24. 23, 24. So it is taxable in the year 23, 24. 18 lakhs. Expenses for obtaining enhanced compensation, this will obviously be legal expenses, 1 lakh. 17 lakh is the thing. I can set off this old one, no? Here. Can set it off. Here, cost of acquisition, please don't do. Cost of all that, let's not do. Long term capital gains assessment year 24-25, 488,349. There is no deduction in respect of cost of acquisition. So, examiner is telling that there is no conceptual clarity. Assessment year wise capital gains are not correctly computed. Cost of acquisition, etc. was taken. And actually, this is an easy question. So, what can be a tricky question actually is this. Now, we will see. What can be tricky questions? This 30 lakh initial compensation, what if it is received in installments? 10 lakh in 22-23, 10 lakh in 23-24. Government, no, will they give initially everything? No way. Practically speaking, installment they'll give. So you should tax, let's say they'll give you 10 lakh in 22-23, 10 lakh in 23-24, 10 lakh in 25-26. You should charge it every year or first year only full you have to pay? As and when received or first year? So, initial compensation, right, is a short compensation. There is no dispute, it is undisputed compensation. So, when the government is telling I will give, they will give. Just that timing will be different. So, if 20 lakh is received in 22-23, 5 lakh in 23-24, 5 lakh in 24-25, how much will be taxed in 22-23? Since it's a short compensation, full 30 lakh will be taxed in 22-23 even though 20 lakh is received. Full means they'll eventually give it, but I should tax it in which year? First year. So, always remember, initial compensation is a short compensation. So, when they have given you some amount and they are telling you that yes, I will definitely give you, the moment they give you some amount, unfortunately, you have to tax the entire amount. Which one? Correct. So, when they pay is what? First payment, 20 lakhs. you have to pay, unfortunate. But actually first payment will never be less. They'll give you a bulk amount in first payment, then they'll release in tranches. This is the practical scenario. Bulk payment will come, 60-70% they'll come initially, then they'll do slowly. We are doing a government project, that's why I know. We are doing a government project for the government of Karnataka. So payment and all, first they'll pay 60-70%, remaining they will drag 3 years, 4 years. So yeah, so 20 lakh, 5 lakh, 5 lakh. So definitely that's how it works. But you need to pay capital gain for what? Full first year. Now enhanced compensation. Enhanced compensation, is it sure shot or is it depending on the case? Case. So let's assume in that 20 lakh, no, let's say I'm getting everything, but 10 lakh they give some time, then I'll push for more, build up my case, 6 lakh, 4 lakh, like that. Enhanced compensation is not sure shot. So according to you, enhanced compensation will be taxed in the year of receipt as and when you receive it, or everything 20 lakh in 25-26? As and when you receive it. So it is taxed as and when it is received, since payment is not sure and depends on various facts. So this is taxed as and when you receive. These are the tricky questions. That question was very easy. So here, as and when you receive. So you receive 10 lakh in 25-26, tax that. 6 lakh, 4 lakh, tax it accordingly. For every year of delay, government has to pay you interest. Is that interest taxable? Interest is coming to bank. Nirmala madam is smiling at you. What do you think? Is it taxable? Yes. IFOS. But she is given some breathing space. What? 50% standard deductions is giving. Right? If interest is received on delayed payment of compensation, taxable under IFOS in the year of receipt, not the year of accrual. The moment it is coming to the bank account, 50% standard deduction, remaining 50% tax. This was still okay. So initial compensation, tax which year? First payment, whatever it is. Final, enhanced compensation, as and when. Now in enhanced compensation, no. Initial compensation, no problem. Tell me. Whenever you receive, that's all. Whenever you receive. That is very simple. Now I am telling that other question. They have ordered you to pay something. That I will discuss now. So this, in enhanced compensation, there is something called as interim order. Interim order is a temporary order. So I have sued for 20 lakhs. Government is telling, no, only 6-7 lakh is payable. I am telling, no, 20 lakh is payable. So court does a very smart thing. First of all, your house is gone. Secondly, you are asking for 20 and that extra 20 and you are fighting with the government. So court will ask the government, boss, what, according to you, how much you can pay? Sir, 6-7 lakh, sir. But this fellow is claiming 20. So if I leave this dragging, it will again go for 3-4 years. So what will the court say? Boss, at least you are agreeing for 5 lakhs. No, you said 6-7 lakhs. Bloody pay 5 lakhs first. Remaining we'll see. Let the case go on. 5 lakhs you are agreeing, right? Pay 5 lakhs first. Suppose you are agreeing, 5 lakh you pay, that I will pass a temporary order called interim order. They will say interim order of 5 lakh. Immediately pay. Then you can't pay in installment. I am demanding you pay immediately. 5 lakh right now, one shot. They'll give you the terms in the order itself. First one payment only you should pay. Or if they give you a split, then according to the split. But I am telling you 5 lakh you pay. Final order we'll see later. Now, interim order passed in 1920, received in 1920. Taxation of 5 lakh, is it when the interim order is passed or when the interim order money is received? Here it's easy, 1920, and what if the interim order is passed in 1920, you paid next year. Let's say it was passed in March 2020, you received in April 2020. These are some additional variations. What do you think? So, and then we'll go on, no problem. Final order is passed for 12 lakhs in 22-23. Actually, write down this example, guys. Then we'll do it together. Write down. This is an important example. Other things are all easy, guys. Interim compensation are all easy. I thought this question, I didn't see this question. I thought full heavy duty question, some chiller question this is. This only if we are not able to solve, imagine. These questions are final questions, whatever I am doing. All MCQ. Write this down, write this down. Interim order, temporary order. Okay. 20 lakh, 5 lakh interim order, 15 lakh final order, pending. Interim order is passed in 1920. Compensation granted 5 lakh. Received 1920. Got it? Final order. Passed for 12 lakhs in 22-23. Guys, what do you mean by final order passed for 12 lakhs in 2023? It means I claimed how much? I claimed 20 lakhs. Interim order was given for 5 lakhs. Final order was given for 12 lakhs, which means total only 12 out of 20 they have granted, that's all. Do not get, 12 is not additional, it's not 5 plus 12, 17, no. 20 lakhs I claimed. They said, hey, please give 5, let him also shut his mouth. He'll also be happy a little bit. Let's wait for the final one. Final order is 12, which means what is the additional amount you have to give? 7. Understood? So, final order was passed for 12 lakhs in 22-23. 5 lakh was received in 1920. 6 lakh was received in 22-23. This is CA final material. That question was so easy, right? 1 lakh was received in 23-24. So, in the wordings, look out in the exam. Compensation due to interim order. Interim order is always for additional compensation. Compensation due to interim order, 5 lakhs. Were received 1920. Compensation due to final order received in 22-23. And 1 lakh received in 23-24. Compensation due to final order. What is the taxation, guys? 6 lakh, 1 lakh year of receipt, okay? 1920 receipt. So, you see, I'll explain, then you can write 6 lakh, 1 lakh, you're right, year of receipt whenever you receive it. So year of receipt 22-23, this is 23-24. Only this one, no, compensation received in interim order. Ideally it is year of receipt it should be, but there is a new variation. Variation 3 overrides variation 2. It is taxable when the final order is passed. Deadly. When is the final order passed? 22-23. Beyond this, they will not ask. Got it? Write down. If at all they ask anything with respect to interim order, this is the law. They are saying, okay, I am given you just to shut your mouth, don't pay tax. See, first of all, you are a aggrieved person. I am giving, that's a logic. You are a aggrieved person. I am giving you some money. You asked for 20 lakhs more. First of all, initial compensation you got, that is chapter close. The day you receive, you pay, close it. But now you are asking for 20, you are aggrieved, and I am giving you some 5 lakhs. In that also, if I tax that time only, it will be a problem. So, like, let the final order come, then we will see. This is just a temporary payment. Can I tax a temporary payment in the year of receipt? No. But when I give a final order, as and when you receive it, you tax, just like enhanced compensation. But this 5 lakh initially that I gave, you tax it that year, not this year. Makes sense. Very logical. So, it is taxed in the year in which the final order is passed. These are all MCQ questions. So, which year it is taxable? 22-23. Now, if I have taken away the land, let's say this Ungamakam, this land is full taken over by the government to build a defense base here. What do you think? Compensation they will give you. Is it taxable? So, they are giving you that money for what reason? It is for defense, or they want to build a sports complex, National Games Village. So, what do you think? That is one. If at all they ask like that, be very, very alert. Compensation. Yeah, page number 19. I don't know, yours will be here and there different. Which page? 16. Note number 3. This can be one more adjustment in final. Compensation received in respect of award or agreement which has been exempted from the levy of income tax under 96 of right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act. By the time you tell the law, you will die. Correct? It is right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act. This is predominantly for defense purposes, taking over the land for defense, sports, other things. Take away the land for that, it is not taxable under this right to fair compensation act, and it is not taxable under income tax act. Right to fair compensation act overrides income tax act. So, it is fully exempt. Money that you get for defense, fully exempt. So, even if they compulsory acquire, please hope they will acquire it for defense land, defense purposes. So, it is fully exempt. So, in final they can ask you, they have taken it for defense purposes. They will ignore that and come. Actually, answer is what? It is not taxable. Any amount received not taxable, no problem. Army, Navy, Air Force Base, sports, whatever. So guys, we were doing this. Coming back, we did what? Conversion of capitalization stock in trade, compulsory acquisition. We will do first one. Damage or destruction of capital asset. This is not what is there in the business. This is a normal capital asset that you have. Asset is destroyed. You are getting insurance compensation later. So in the year you receive insurance compensation, what will happen? You will have to pay. Insurance receipt from the insurance company on account of damage or destruction of any capital asset is chargeable under the head capital gain. Year of transfer is the previous year in which the asset was destroyed or damaged. Year of chargeability, previous year where insurance money is received from the insurance company. What if money was not received? They replace it with another asset. FMV of the value of asset on the date of the receipt. Period of holding, very simple, date of acquisition to the date of destruction. Which page number is this? 13. Obviously, if no insurance claim is received, then there will be no capital gain. On what all accounts can the asset be destroyed? Flood, typhoon, hurricane, cyclone, it's called act of God. Riot or civil disturbance. Accidental fire, action by enemy. Any terrorist attack? Yes. Accidental fire, not intentional fire. Intentional fire is called arson. This is not arson. Arson is an offense. It is accidental fire. It has to be proven. This will take time, 1 year, 2 years. So obviously, then whenever you receive it, you will be taxed. Simple. Nothing there. Which one? Insurance company will not pay you 1 rupee also. If it is arson. In case they pay, then of course it will not come here. The thing is, it will not be, in the sense they will never pay you, if it's proven that you have committed fraud. In fact, you have to pay. Correct. That is a capital receipt, not taxable. 45(2) done. Now this conversion of stock in trade, capitalization to stock in trade, I have to compute the FMV. How will I compute? Will they give in the question or I should compute? Mostly they will give, but sometimes they don't. That time you see, this rule we have to follow. Quickly we will see that. Rule 11 UAB. Determination of FMV for inventory. So they will not give directly, they will give other hints. Inventory being immovable property, that will be the SDV, stamp duty value. We anyway told stamp duty value can never exceed, FMV can never exceed SDV. Generally we have seen that, Generally it will be the same. Inventory being jewelry, drawing, sculpture, painting, etc. There is a value determined as per 11 UA that you have to follow. Other assets, FMV. That's how it is. So slightly later stage, we will also discuss this jewelry, drawing, sculpture. This 11 UA will also help us in the Black Money Act. Similar calculation. 45 compulsory acquisition and fully done, no tension. Joint development agreements, JDA. So in JDA, what happens is you have a land, let's say you acquired it in 2010. This land will be transferred to a builder. Let's say in 2018, you will transfer to a builder. Builder will take it off. Will give you some cash. He will promise that I will build a building. If it's 8 or 10 flats will be there. In that 5 flats are yours. 5 flats are mine. Construction I will take care. Don't worry. For land, some small amount I'll give you. But I will give you 5 flats. You can sell that off, whatever you want. So until the construction etc. happens now, obviously I cannot pay any tax. So if you see there, what is the year of transfer? Year of transfer is the year in which the possession of the land has been transferred to you. In my example, 2018. But what is the year of chargeability of tax? Is it when you receive those 5 flats or you receive a certificate? Actually, you should receive a certificate that is called CC, completion certificate. So very simple. That I'll discuss. Year of transfer, previous year in which possession of immovable property is transferred. Year of chargeability, certificate of completion. Period of holding, date of acquisition to date of transfer. What should be the consideration I should take? Consideration will be stamp duty value of the flats that I am receiving plus cash. Plus cash. So when will it be when do I have to pay tax? That day. Which day? CC. CC. Right? Huh? Which one? No. Here it is certificate of completion. Purely certificate of completion. So when will you pay the tax? I don't care when you took possession, whatever. Certificate of CC, if it is received, that year you have to pay the tax. You received after the CC only, you OC will come. OC is occupancy certificate. So practically you can never take possession if you do not have the CC. The possession will anyway come later. CC will come before. First CC, then OC, occupancy certificate. For occupancy certificate, you have to put all these fire extinguishers and your electricity supply, all that you have to give. Yeah. Tell me. That you cannot tax only, no, because you wouldn't have got any money. Yeah. Yeah. Correct. There is a specified agreement, yes. Now, in final, what they'll ask, all this is inter-level. Final level, 2018, I gave you of the possession. In 2000, this got constructed in 2023. I gave you the possession already. In 2019, this original owner sold it to somebody else. Means what? Sold the right to receive 5 properties somebody else. Now will you get this benefit? This point you see. In case individual or HF transfers his share in the project on or before the date of issue of the said completion certificate, capital gain shall be deemed to be the income of the previous year in which the transfer takes place. Accordingly, the beneficial provisions of 45(5)(a) being taxability of capital in the year of issue of completion will not apply. Means what? Whenever the transfer is taking place, deemed. So, landowner enters into an agreement in July 2020 with Bhavya Developers for developing a residential project. Shashank is entitled to 30% as a share in the project. The project completion certificate was issued in August 22. Shashank transferred his share in the project on April 22 only. In this case, capital gain shall be chargeable in the financial year 2021 itself, even though the completion certificate is issued in the year 22-23. So, which means you have to reopen those proceedings. I am standing in 22-23. You can't just say that year I should have paid. I can't have dreams in 20 that I will sell it off in 22. So, what they are trying to tell is reopen the proceedings. Reopen the proceedings and do it. Right? Yes. Which one? HDV is the cost. No? HDV will be the cost of acquisition. See, an example you see. I got your question. Cost of acquisition to the individual on transferring the share in the project before issuance of COC shall be the full value of consideration as determined under 45(5)(a), that is 49(7). Anyway, other example. So, here is the example. Now, what is the cost when he is selling the 5 flats? See, Mr. Kunal is the owner. He acquired the land in 2001-2002. Cost of acquisition was 2 lakhs. He sold it to JDA on 24/7/2018 to XYZ Builders. On 14/7/23, when that agreement is there where 3 flats in the project will be given to him. On 14/7/23, completion certificate was received, and on 14/7/23, SDV of each flat was 40 lakh. So, what is the period of holding? 2001-2002 to 18-19. That is a year of transfer of the land. Now, computation of capital gains for whom? For Kunal. How much am I getting? SDV I should take, no? So, this is for selling the land I am getting. 40 lakhs into 3 flats, 1.2 crore. Transfer expenses nil. Net consideration 1.2 crore. What is the index cost of acquisition? 2 lakhs into 18-19 is 280. 2001-2002 is 100. Correct? 2 lakh into 280 by 100, 5 lakh 60. What is the long term capital gain? 1 crore, 14 lakhs, 40,000. Let's assume now Kunal sells one of the flats for 90 lakh on 13/6/24. What is the period of holding? What is the period of holding should I take from here, or actually when I get the possession? Get the possession. House ka possession is 14/7/23. Land was different. So, when did I get the land, house? 14/7/23. When am I selling the house? 13/6/24. Short term or long term? Short. So, 90 lakh minus 40 lakh. 50 lakh. So, period of holding 14/7/23 to 13/6/24. Cost of acquisition as per 49/7, that is amount deemed to be the FVOC. Whatever was the FVOC here, that will be deemed to be my cost here. I have already paid the tax on 40 lakhs here. That will be deemed to be the cost. Was that your doubt? Yeah. Cost of acquisition is 40 lakhs. So, what is the short term capital gain? 50 lakhs. Yes. No, here you mean? Huh. Hmm. Here, this one. Hmm. Correct. Yeah, that would come. Yes, that would come. Because here the cost would include what? That is the beauty of this here. You have written it down here, you see. This same thing will come. Stamp duty value, whatever consideration you got, that will be the cost. You see here, it says very clearly, amount deemed as FEOC. And what is FEOC? Cash plus this thing. Both will come. So you asked that question, no? That possession and all, will it come or only certificate of completion? Who asked that? You only asked, no? That is given here, you see. In Balbir Singh Supreme Court judgment, they are told it should be registered. But at Balbir Singh thing was overridden. By what? By inserting this point. It should be certificate of completion. In 2017, Balbir Singh judgment, Supreme Court judgment was what? Agreement must be registered. When can it be registered? I mean, even when the possession happens, then transfer of property happens, you've seen. So it was creating confusion. So in 2017 or 18, they changed the law to override Supreme Court judgment, saying that it should be completion certificate only. So now there is no confusion. Transfer of Property Act will not apply to JDA. See third case also. Based on the capital gains, should I see the original JDA or should I see the revised JDA? There will be disputes and all that. JDS will keep on getting changed. You should compute your entire thing based on original JDA or revised JDA. Revised. To summarize, (45)(1) normal transfer. Year of transfer is when asset is transferred. Year of tax when asset is transferred. Period of holding, date of acquisition, date of transfer. Consideration. That's easy. But these are exceptions. Asset is damaged or destroyed only when you get the insurance amount. But the period of holding is till the date of destruction. Capitalization is stock in trade. The year of conversion, it happens. But when its stock is sold only, you will pay the capital gain. Compulsory acquisition, when the asset is compulsorily acquired, you will obviously, what do you say? It's a year of transfer. When the compensation is received, that is the year of tax. JDA, same thing, completion certificate. This and all is fine, guys. It's very simple. That is, securities made by the depository is deemed to be the registered owner under the Depositories Act. So here it is depository, that is CDSL or NSDL. They are the holders of shares in all the companies. You are holding shares in Demat account. Demat account is registered in the bank in which you hold the shares. They are called depository participants. All the depository participants will be holding shares in depository. So when you are selling the share in Reliance or Infosys, your name will not be entered in the register of members. It is CDSL or NSDL's name will be entered in the register of members. So here they are trying to tell, it's a very simple provision that ultimately it is money that you will, consideration etc. that you will pay tax, capital gain tax on. Is it on what received by NSDL or what you receive? It is what you receive. So it is chargeable in the hands of the beneficial owner. You are the beneficial owner of the shares, not CDSL. Whose name will be entered in the register of members? CDSL. But who will be taxed? You. That is a known point only. It is given in the form of a law. That's all. And what will be taxed? Like today I bought 10 shares, tomorrow I bought one more 10 shares. Is it numbered, anything like that? No. When it goes out, what will go out? First in, first out, FIFO basis. Are the shares numbered? Is it physical shares? No. Today I purchased 10, tomorrow I purchased 10 more. So what am I taking out? We don't know. Like I have 500 rupee bundle notes in my wallet. I would have withdrawn one note yesterday, one more note day before yesterday. I can pay anything, no. So here it is for ease of use, it's considered FIFO. That's all. Whatever we generally trade, it is given in the form of a law. It's an easy thing that they'll not ask anything in the exam as such, so it's fine. Only in case of dematerialized stock, then you'll have to see the movement. Anyway, that part is no longer there anymore. Next, capital gain on transfer of a capital asset by a partner or a member to AOP BOI. So partner is transferring it to the partnership firm. I have my computer I want to bring it into business. Transferring. Transfer of capital asset by a partner to the firm by way of capital or otherwise. Capital or otherwise. I am either bringing it in as capital or any other reason. Shall be subject to the tax based on the value of asset recorded in the books of the firm. Value of capital asset recorded in the book shall be deemed to be the FEOC for the purpose of section 48. My cost of laptop is 1 lakh. I am bringing it into business and showing it as 2 lakhs. What is FEOC? 2 lakhs. Where the capital asset is introduced below the market value, then dangerous. 1 lakh is there, I am issuing it at 2 lakh, good, no problem. But a 50 lakh asset, I am introducing it at 20 lakh to the firm. For me, no tension. Can I show capital loss? FEOC 20, cost 50, right? So I am showing loss, you are showing at a lesser rate, win-win situation. That's why they introduced 56,210. You are showing loss and they are also, it's a win situation because of 50 lakh asset they got at 20 lakhs. So what will I do? I have introduced gift taxation. Aren't they getting something worth 50 lakh at 20 lakh? Yes. Firm is getting a benefit. That benefit 30 lakh will be taxable in the hands of the firm. One person's loss is other person's gain. Correct? In the previous case, 10 lakh, 1 lakh asset I am giving it at 2 lakh. So for the firm, they will record it at 2 lakh, take depreciation, that's fair enough for them. But for me, I have to pay 2 lakh minus 1 lakh tax, settled. Reverse case, 50 lakh asset I am depositing at 20 lakh. Cheating. 30 lakh I am showing capital loss. And the firm is taking a 20 lakh benefit. If they had bought it outside, they would have to spend so much money. It's about cash flow, not just about depreciation. So they are telling, okay, in that case, even though you paid only 20 lakh, please record it at 50 lakh. Pay IFOS 30 lakh readily. That is 56,210. Capital gain on transfer of a capital asset, stock in trade, money by a firm to the partner. Reverse case. Reverse case. So AOP, BOI or a firm, that's called a specified entity. Where a specified entity transfers money or capital asset or both to a specified person at the time of reconstitution of such specified entity. Such specified entity shall be subject to tax under 45(4) under the capital gains in the previous year in which the money is transferred. Because guys, reconstituting, new partners are coming in, old partners are going out. Like one new partner comes in, one new partner goes out. One new partner comes in, one old partner goes out, sorry. So in that case, what should I do? Whatever asset I am giving, I have to compute capital gain. So it will be done like this, simple formula. If you see, profit and gain shall be determined in the following manner. Income of the specified entity chargeable under the head capital gains will be equal to value of the money received by the specified person from the specified entity plus C, FMB of the capital asset received by the specified person from the specified entity. So I will give a partner cash, I will give a partner asset. Asset ka market value I should take into account. That person's capital balance was only 5 lakh. But he is getting 3 lakh cash plus an asset valued 15 lakh. So what would be the income of the specified entity? Because I am releasing it now, it is what? 3 plus 15, 18 minus 5. So it is taxed on that. Very simple. Value of the money received by the specified person from the specified entity. Specified entity will means firm. Specified person means partner. FMB of the asset received by the specified person. Amount of balance in the capital account at the time of reconstitution. So if ultimately your capital balance only is more, if value of A in the above is negative, then value shall be deemed to be 0. That is what it is. Otherwise, in other cases, basically I am removing the asset from the particular thing. I am removing the entire thing. So if you see, there is one formula, this is 45(4). If you see, previously I did not do that on purpose. You see here, you will understand now. When we did value of consideration, long-term capital gain, non-depreciable asset, less expenses, net consideration, index cost of acquisition, index cost of improvement, see here. What will I subtract? Amount chargeable as the income in the hands of specified entity under 45(4). So that is the amount chargeable under 45(4), which means I am giving away certain things. Cash I will give away, value of asset I will give away, but I will retain the capital balance, which means I am actually giving it to you at that rate. So that will be my income, which I have to pay capital gain, that I will subtract from this particular non-depreciable asset. So there will be simple calculation problems where they will say the cash was given this much, FMB was given this much minus D. Just have to compute that in the MCQ. That's all, very simple. It will not be any difficult high level questions, simple questions only. Has come all this while, it will continue to do the same thing. Component, everything we have done, all this is done. So we are going in a structured manner so that things will become very easy. Initially we discussed what do you mean by capital asset, then we discussed what do you mean by transfer, then what is not a transfer we had to do, and we also saw the period of holding, rates we are yet to do, no problem. So all these things. Stock also similar concept, you can see that later. It's a similar concept. This part we will see slightly later. Taxation of firms also we can handle this, no problem. 9b we will see later. Right. So Let us one second see if there are any questions which we can solve, one or two. Problem is everything they'll give with the exemptions, that's the issue. Again, first question is an exemption based question. Then slump sale, 2 questions are there. Slump sale also will solve. Question 7 already done. Question 8 is on an exemption. Question 9 is liquidation problem. Then it's all related to shares, so it's fine. Question number 9, MCQ 9. MCQ 9, you try, guys. Please try. This is PGVP and CG. Plant A, plant B, all in the same block, right? Yes. No depreciation. Short-term capital gain. Okay, so how did we solve this? First, is it the same block? Yes. So in the block of assets, plant. So what is the full WDV? 3 lakh 50 plus 1 lakh. How much will it come? But plant C also was added 25,000. When was it added? 10/6. So what will that come? Overall how much? 5 lakh 50. 50 or 50? Okay. Then what is the depreciation? No depreciation because I have already given. So it is sold at what rate? This is the sale consideration. So what is the, how much is the monies payable? Sale consideration minus expense will be the monies payable. So how much will that be? All that 225 minus 12,000, 50 minus 0, 85,000 minus 200. That will be the monies payable. 647, 800. So what is the final thing? 97,800 will be the short-term capital gain. Yeah. Huh? Which one? Huh? I think the question is 2018, no? But this already, it had these things, no? Did it say that purchase a new? I think this date is wrong. Because, you know, it would have been an old question. See, it's in March 19 question, no? So it's actually bought during the year is what you can say. It would have been like WDV on 2023, right? Some of the dates here are wrong only. I had asked my team to change the dates little bit. They have goofed up little bit here and there. So the date, if it's an old asset, why will it come now? Correct. It's a 2019 question. Yeah, it will come there only. So it should not, need not consider. Got it? So what will be 97,800 is the short term capital gain. So then it's fine. Then what do you say? So is there any chance of avoiding capital gains? Yes. You just add one more asset to the tune of 97,800 or more. That's it. So which option? C. Depreciation nil and short term capital gain 97,800. Further, ABC Limited can avoid capital gain if purchase another plant during the previous year for how much? 97,800 or more. 97,800 or more. Very, very simple. So if you buy it for just 97,800 or more, then everything will be set. That one thing only we need to keep in mind. That's it, nothing else. This is buyback and all that. Yes. Okay, guys. So now coming to some special points, which is again continuation in our notes as well. So if you see here, it starts important concepts. First is 50C. So we'll anyway do it here only. Right. So here section 50C says the SDV only is treated as FEOC. The stamp duty value only sometimes will be treated as full value of consideration. So what used to happen was the land was given to from Ambi to Onion 70 lakh rupees, and Onion gave 70 lakh in the bank account, but the real value, the proper stamp duty value of that property used to be 110 lakhs. So 40 lakhs he used to give it in cash. So what he used to do was, they used to make the fair market value 70 lakhs, whereas the actual stamp duty value was 110 lakhs. For example, in this area, if the value of this entire area is 1 crore, fair market value can be anything. No, I told you fair market value can be changed. So I will make this as 70 lakhs and the bank account deal will be, the agreement deal will be 70 lakhs. But actually what is the proper stamp duty value here? 1 crore. So what will I do? Fair market value, make it 70 lakhs. And then, but 70 lakhs if I do also good, no, for me capital gains also will be less, everything will be less. Stamp duty payment also will be less generally because it's at the value at which I do. So 70 lakhs I will make that fully, and then later what will I do? I will pay cash 30 lakhs and close it. Black money also converted, everything done. So to curb that from happening, many years ago only 50C was inserted, where they said the FVOC, you may take whatever you want, but FVOC will always be SDV. But there is a thing. So if the stamp duty value happens to be more than the consideration, in my example 1 crore was the stamp duty value, consideration was 70 lakhs. So I will deem the FVOC only to be stamp duty value. So FVOC only will be the stamp duty value. So basically guys, if I am looking at land and building or both, this is specifically for what? Land or building or both. It is specifically for land or building or both. If it's a capital asset, 50C will come. If it is a stock in trade, then what will come? It's a stock in trade, what will come then? This 43CA. Under PGBP, 43CA will come. Similarly, if for example, in land and building or both is the question here. Builders are selling like this. Builders are selling 1 crore property for 70 lakhs and taking 30 lakhs in cash. So for the builders, what will be the deemed to be the PGBP? 1 crore and not 70 lakhs. That is 43CA. Cool. So let us say one more example. Your consideration is 100 lakhs. That is 1 crore. Consideration is 1 crore. Stamp duty value is 1 crore 5 lakhs. Just little bit more, that's all. Is there any threshold allowable, or it's always SDV greater than consideration is what I need to see? Some threshold is there, because in each area it may be different genuinely. So that's the reason why they gave a threshold of 110%. If SDV is greater than 110% of consideration, if SDV is greater than 110% of consideration, then what it is? What should I take? Then I should take SDV. If it is greater than 110% of consideration, then I should take SDV. Otherwise, consideration. If SDV is lesser than or equal to, if SDV is lesser than or equal to what? Yeah, less than or equal to the same thing, that is consideration, then FVOC it will come. Otherwise, SDV will be the FVOC. So for example, here consideration is 10 lakh, SDV is 10 lakh 70,000, consideration is 10 lakh, SDV is 11 lakh, consideration is 50 lakh, SDV is 57 lakh, 10 lakh, 11 lakh 40,000. 110% of consideration I should see first. 11 lakh, 11 lakh, 55 lakh, 11 lakh, 110%. Then I should compare this and this. Is SDV equal to or more than? SDV is less than 110% of consideration. So SDV only will be the here. Here 11 lakh, both are, so consideration only will be the FVOC, because SDV is less than 110% of the consideration. So basically there is some leeway is what I am saying. 10% threshold I can give you. So in my example I told you 1 crore is the consideration, 1.05 crore is the SDV. So 10% here and there, no problem. So government doesn't have any problem with 10% here and there, doesn't matter. but anything more than that is an issue. In this example, 11 lakh, 11 lakh. So, consideration only will come. SDV is 57 lakh, 110% of consideration is 55 lakh. So, I should take the SDV. Here, SDV is 11 lakh 40, 110% is 11 lakh. So, I should again take SDV. So, general rule is this: if SDV is less than or equal to 110% of consideration, then consideration is FPOC. If SDV is more than 110% of consideration, then SDV itself will be the full value of consideration. This is the special point number 1. But there is a catch in this as well. Let us take an example where this happened with my aunt actually. She bought a property in a place called Madikeri in Karnataka. It is a hill station. So, Coorg, Kodagu. So, in Coorg, there is a place called Madikeri. So, they bought a property. They were very rich people from Netherlands. They lived all their lives in Netherlands and came back and shifted here. So, my mom's cousin. So, they bought it, let's say, for 2 crore. This was the cost of acquisition. Many years left and the SDV, stamp duty value, was 5 crore. Stamp duty value was 5 crore. She wanted to sell. So, the consideration should be what? There about 5 crore only. So, when I sell that, I will sell it on the fair market value obviously. The fair market value of the property was just 3 crore there. So, if the consideration is 3 crore, what is 110% of consideration? 3.3 crore. SDV is 5 crore. What will come? SDV. But she is telling 3 crore, there is a reason why it is 3 crore. Because actually that house was situated and a lot of mountains are there around. A lot of landslides used to happen. So, all the homes in and around is destroyed. This is on a slightly elevated platform, that's why it's standing. It's a huge bungalow. Nobody wants to touch that property also because it is a landslide prone area. You saw what happened in Kerala, right? Unfortunately, why not? Right? Yes. So, in Madikeri also, it's because of encroachment where you are not supposed to build in these corridors. In Wayanad, they started left, right, opening resorts. That's the reason, unfortunately, it happened. It's tourism. So, here also in Madikeri, the same thing happened. Actually, it's happened to her. Now, the question is very simple. If she sells it for 3 crore, she should take the full value of consideration as what? 5 crore and pay capital gain on 5 crore. Crazy. And it's simply unnecessarily waste. Is there a way in Income Tax Act where you can go and apply somewhere and say, boss, it's not this much? What do you think? Yes. You can go to the valuation officer and say, sir, there is something wrong with the FMB is 3 crore according to me. You please, he is telling 5 crore. So, kindly do something about it in such a way that I don't have to pay so much. So, 3 crore is what this fellow is ready to pay. I'll anyway get 3 crore. But according to me, 5 crore is too much. Please do something about it. So, valuation officer may do many things. Valuation officer may say, madam, you are 100% wrong. This 5 crore also is wrong, ma'am. It should be 6 crore. Or he may say, ma'am, it is not 3 crore, it is 2 crore actually, not even 3 crore, it is just 2 crore. Or he may come in between the two. He may say, no, 5 crore is too much, but I feel it is around 3.5 crore. Because that fellow AO is hell bent on charging this amount, 5 crore. I want to reduce the amount. That's why I am going to the valuation officer. Valuation officer is telling first case 6 crore, more than this actually. Second is 2 crore, third is this one. Thus, you only tell me. My auntie asked for less than 5 crore, this fellow is telling 6 crore. What should I follow? I'll pay 5 crore and close it. Here, income tax department is telling the assessee is ready to pay on 3 crore. You are telling 2 crore. Have you gone mad? So here what will I take? 3 crore. I am ready to take 3 crore. No, the assessee is ready to pay 3 crore. What are you saying 2 crore? So these two are wastes. Valuation officer's value will be taken into consideration only if it is between FMV and SDV. So if it is 3.5 crore, then I'll say, okay, no problem. This still only will be deemed to be the full value of consideration. Let's make it 3.5 crore. Let's not take 3 crore. Let's not take 5 crore also. Let's make it 3.5 crore. Accordingly, you will also tell that fellow to buy it at 3.5 crore and close it, so you will get that much money at least. This is the scene. Reference to valuation officer. Very logical, no need to mug up anything. Very logical. So, only if the amount is between FMV and STV, the amount is between FMV and STV, will the valuation officer's thing come. Otherwise, it's a problem. So, you see, if value determined by valuation officer is more than SDV, in my example 6 crore, more than 5 crore, ignore valuation officer's valuation. If valuation officer's value determined by is less than selling price, ignore. Only if it is between the two, less than the SDV but more than the selling price, only then I should take into account this sum. Got it? Very simple. So that is what we need to see. One more thing, guys. So if the selling price is 55 lakh, SDV is 68 lakh. Just write this down. It's an interesting MCQ asked in CA final once. No need of MCQ as such, you only can tell me the answer. Selling price is 55 lakh. Selling price 55 lakh, SDV 68 lakh. So what is 110% of selling price? 55 lakh plus 5.5 lakh, 60 point, yeah, right, 55 plus 5.5, 60.5 lakh, definitely SDV 68 lakh I have to do now. Now the question is, I went to the valuation officer. I went to the assessing officer and asked for the valuation. Valuation fellow gave 4 different values, 4 scenarios basically. Scenario number 1, 66 lakh. Scenario number 2, 70 lakh. Scenario number 3, 57 lakh. Scenario number 4, 50 lakh. Against each of these things, write down what according to will be the FVOC. That is your answer. You should write the answer for each thing. Tell me guys. SDV 60, this fellow is giving 66 lakh. What is the amount? 66 or 60? Sorry? Oh, 68, sorry, 68, okay. SDV, okay, SDV 68, he is giving 66. So, what will I take? 66. SDV 70, 68. Fourth one will solve first. SDV is 50 lakh, less than the selling price. I am ready to pay for 55 lakhs. You are telling 50 lakh. What is that? 55. Third one is interesting. 57 lakh they are telling. So, is it 57 lakh or 55 lakh? What do you think? 57 or 55? So, guys, this 50C, will it override the general rule of 110%? Will this 50C override the general rule of 110%? What do you think? You see, what is 55? 110% of consideration 60.5. 60.5. Correct? Up to, if it is up to 60, if the SDV is up to 60.5, what will be my FEOC? 55 lakhs. Did you agree? If the SDV is up to 60.5, 110% of consideration, what will be my FEOC? 55. Now they are making SDV only 57 lakhs. If my SDV is only 57 lakhs, what will be my FEOC? 55 lakhs. Are you getting it? It's very, very logical. This was the question where people missed out. Correct? Did you understand, guys? If my FEOC is 55 lakh and if I am adding 10%, it will become 60.5 lakh. So, with a threshold limit of SDV being 60.5 lakh, I can always claim 55 lakh. You see the first one. My threshold was 60.5, but you have determined it to be 66, so I will take 66. My threshold was 60.5, but you have determined to be 70 lakh, but boss, that is more than actual SDV, so I will take 68. Third one, you have determined less than the selling price, which is not allowed only. Fourth one is peculiar. 55 plus 10% is 60.5. Up to a threshold of 60.5, I have no problem. I will take 55 only. You have determined that to be 57 now. Still, I will take 55 only, no? Right? Understood? So, this is 55 lakhs is the answer, not 57 lakhs. So, the 50C and its valuation will not override the normal concept of, the valuation concept will not override the actual 50C 110% concept. So, if your valuation is anyway within the 110% range, consideration only will be taken. That is the hidden point. Got it? So, the same thing, assessable value and all those things. So, general rule is this, 110%, less than 110%. Reference to valuation officer we have seen. So, check this table 2 minutes, guys. Actual consideration 100, stamp duty value 90, no valuation is made, so 100. Actual consideration 100, valuation is stamp duty value 150. I didn't go for any valuation. Isn't it 110%? Yes. 110% is 110. I'm charging 150. So what should be the 100 and 150, but I went to the valuation officer, he determined 170, more than that, 150. 100 and 150, that fellow determined 120. Yes. So, but is it within the range of 110? No. It is more than the range of 120. Simple. 100 and 150, he did 90. 100. 100 and 102 within the threshold, so 100. 100 and 105. Value determined is 120, I don't care, within the range, 100. Simple. Now, one more deadly thing happens. For example, this one. Your consideration is 100. Stamp duty value is 150. And let's say, let's say normal thing here only. This one. Consideration is 100. Stamp duty value is 150. What is the value adopted? 150. So, the seller will pay how much? 150. The buyer on the seller, I am selling the house, no? So, what is the value that I have to determine? I have actually received 100, but for my income tax calculation purpose, I will use 150 and pay on that additional 50 lakhs, I will pay capital gain tax. Reverse case, the buyer is receiving it at, buyer is paying 100 actually. Buyer is paying 100 and is receiving the property which according to the stamp duty value is worth 150. Should I tax that 50 in the buyer's hands also? What do you think? That's a deadly point, 56-10. It's a combination of CG and IFOS. Right? So, what did I say? I am 100 lakh is my selling price, but the stamp duty value is 150 lakh. So, the seller value adopted is 150 lakh. 50 lakh extra he is paying. Tax on 50 lakh extra he is paying. There ends the matter. But from the buyer's point of view, he is actually paying 100 lakh. But is getting the value how much? 150 lakh. Question is 50 lakh extra benefit he is getting? Yes, that definitely 56-10. It's like a gift, purchasing an immobile property for inadequate consideration. So, isn't it double taxation? Yes. Double, same amount, same thing is taxed twice. So, double taxation. Tomorrow when this fellow sells it off, he sells it for 200 lakhs. Cost of acquisition, what will you take? 150, because I have already paid on that 50 lakh extra. Got it. Second point, guys, advance money which is forfeited. 2-3 points. Advance money forfeited. What is this? So it's an interesting part again. Let's say Mr. RCB acquired in 2000 to 2003 a house worth 70 lakhs, right? So he's about to sell it to Mr. CSK for 1 crore in the year 2007-2008, and he has taken an advance of 15 lakh. Fair enough. Now CSK does not buy this house. When he does not buy this house, I have forfeited this amount of 15 lakh. I have forfeited it, which means RCB has got this 15 lakh extra. Later, there is no refund. Later, when I am selling the house, RCB is selling the house to some other person for 10 crore later. When I am selling the house for 10 crore later, the question is, this 15 lakh that I have received, should I reduce it from the cost of acquisition? I sold it for 10 crore, that you leave, minus cost of acquisition will be 70 lakh minus 15 lakh, or cost should be 70 lakh only. I received it in 2000 to 2003 and 2007, 2008, sometime later I am getting the advance, but I am actually subtracting from as if I have received it in 2000 to 2003 only. Is it a correct treatment? Or is the advance 15 lakh not taxable? Or is it taxable under IFOS and I should not touch the cost of acquisition? So many doubts, right? So guys, there's a rule. Advance money for up till 2014, there was a section called section 51, which had a very stupid provision. It should reduce from the cost of acquisition. It did not make any sense. My house was bought in 2000 to 2003. I forfeited the advance HI in 2020. How will I reduce that from the cost of acquisition and then give less indexation? Correct? Indexation also is there, no? 2000 to 2003, I am getting indexation for a lesser amount. Doesn't make any sense. Thankfully, they changed it in 2014. Yes, deduction is before indexation. That's so stupid. So you should make it what? 70 lakhs minus 15 lakhs, then indexation you are giving. Zero logic. So till before 2014, any advance received, still you have to follow that only. Cost of acquisition, if asset is acquired on or after 1/4/2001, reduced from COA or reduced from FMV or reduced from WDV in case of depreciable asset. But thankfully, it is easier. Of any advance received after 1/4/2014, what's the treatment? IFOS 5629, advance money forfeited. Which year you will pay? In the year of forfeiture, that's all. Simple. In the year of forfeiture. This makes more sense. See point number 3? Yes. But one interesting thing I'll tell you, again illogical little. Miss Sheila had a house worth 1 CR. She was about to sell it to Mr. Atesh in 2009-10 for 10 lakh, which was forfeited. Fair enough. Sheila gifted the house to Mr. Kaushik in 14-15. And this guy sold it to Mr. Abu for 4 crore in 22-23. I told you gift is not a transfer. We'll discuss that after the break. Gift is not a transfer. And the period of holding will come from the previous owner. So what is the period of holding for Mr. Kaushik? It is from 2000 to 2003 till the day he sells, 22-23. It's not the day he acquired it. The period of holding will come from the previous owner, because when Sheila transferred it to Kaushik, it is not a transfer. What happens to this 10 lakh which was forfeited in 910? Is it reduced from the cost of acquisition when Kaushik is selling it? Unfortunately, again, advance money forfeited by previous owner has to be ignored. Which one? Correct, but the thing is, gifting is always be done between the relatives. So the thing is, again, ideally speaking, when you are saying that it should be reduced always, it's like Sheila and Kaushik are the same here because gift is not a transfer. So whatever should apply to the previous, when period of holding is coming from the previous owner, cost is coming from the previous owner, cost of improvement is coming from the previous owner, cost of acquisition coming from the previous owner, advance is not coming from the previous owner, doesn't make sense. But anyway, general rule, advance forfeited by previous owner has to be ignored fully. Ignore. No, nothing, no treatment, zero treatment. Zero treatment. Here, given there already. Shall not be reduced. Zero treatment, no treatment at all. Then full value of consideration on transfer of unquoted shares. So unquoted shares is 50 CA. Little bit later we'll see, but just quickly we'll finish it off now. Unquoted shares means what, guys? Unlisted shares. Purpose of computation of capital gains, full value of consideration shall be higher of what? So it's unlisted, so I don't know what I should do. FMV I should compute. 11 UA, that same 11 UA is also there for black money law also, same thing. Actual consideration or FMV. This applies to non-resident also. All types of shares are covered. That is equity preference, which is held as a capital asset. If you hold it as stock in trade, this section will not come. So quoted share means share quoted on a recognized stock exchange with regularity from time to time. It is based on current transaction. So quoted shares are exempted from ATCA. It should be recognized in the stock exchange. Guys, unquoted shares, does it include listed shares? Generally unquoted is unlisted, but does it include listed also? Yes, listed but not traded, called penny stocks. You would have watched Wolf of Wall Street. That fellow keeps selling these penny stocks. It's listed but not traded regularly. The penny stocks are also covered here. So Mr. Tarun acquired 100 shares of PG Limited in 0405 for 5,000. He transferred all the shares to Mr. Varun for 510 per share on 17/4. FMV per share on this date was 625 rupees. So full value of consideration will be taken as FMV as on the date of, so it's 625 or 510, whichever is high, 625. So FVOC 100 into 625. Though I received it only 510, I will take it as 625 because it's a unquoted share. Cool. So after the break, guys, we'll be discussing what is not a transfer. That's about it. So is the pace fine? Yeah, able to understand? We are going methodically, all the adjustments you are doing, solving sums also. So we'll continue with it, and we also will link it with our IFOS later. We have to do that also. We are doing it, but we'll do more of IFOS. We'll finish it. All right, buddies, did you have lunch? All good. Okay, let's continue. So we were doing the special cases. Before the break, we finished all the other areas. And now, which are the cases which are not considered as transfer? So, we understood many other things. Now, we have to go into the area where it says that certain transactions are not considered to be transfers, which means they are exempt from the capital gain side. So, exempt from the capital gains, one by one we will see. Transactions, so we are reading page number 29 of our material. I mean, of course, your will be slightly here and there different, but yes, transactions which are not regarded as transfer. So, section 47 specifically provides for the transactions that are not regarded as transfer and accordingly which are not chargeable under the head capital gains. The list of such transactions are, first of all, distribution of a capital asset on total or partial partition of a HUF is not a transfer. So, when a capital asset is split into various parts or it is given to various people on a partition of a Hindu undivided family, then it is not a transfer. So, HUF generally when they partition, they will distribute all the assets. So, the distribution of assets will not be a transfer, which means for them there is no capital gains. For the HUF also is no capital gains. But when that Karta or that co-parsoner or the member is selling that asset, will there be capital gain? Obviously, yes. So, the period of holding will be whatever the previous guy got, same thing. Transfer of a capital asset by way of gift or under a will or an irrevocable trust is not a transfer. Yesterday when we did clubbing, we saw a concept of irrevocable transfer. Means or a trust where I will transfer all the money, my assets there and say that that is for the benefit of one person only. We saw that in clubbing of income. That income will anyway be clubbed in the hands of one person. But there it was income being clubbed. Here I am talking about the asset only I am transferring. So, under a gift etc., if I transfer, is it a capital, what do you say, is it a transfer? No. Which means if one person gifts to the other person, no issues, absolutely no problem. However, will IFOS get attracted? We need to see later. But interestingly, this section will not apply to gift of ESOP shares, gift of ESOP, which is of a capital asset being shares allotted by a company. Gift of capital asset being shares allotted by a company directly to its employees. You are the employee of a company, you have got ESOP worth 10 lakhs. That part we will see in ESOP taxation. In ESOP taxation, will that be chargeable to tax for you? Yes. In what way? Will that be a perquisite or will that be a capital gain? Perquisite. It will be taxed. At what rate will it be? When will it be taxed? Basically, I will give you 2 years time to work in the company, after which you will be able to exercise the option. That 2 years waiting period is called vesting period, and after the vesting period, then you will get time to exercise the option. So, this one is for exercising the option. When will it be taxed? Taxability is postponed to which one? That time you exercise the option, right? That will be based on the FMV. The thing is, you are getting the shares for 500 rupees. The market value is 700 rupees. So, that extra 200 is deemed to be a perquisite, that is ESOP taxation. So, that you leave, that is the employee, when you are getting the ESOP, you will be taxed for sure. But now that employee gifts it to you, will it be taxed is the question. So, here this exemption will not apply. Would it be a transfer? Yes, it will be still a transfer. So, this one thing they have not changed even now. So, they have always been asking why this thing has not been changed. This point is still retained. Basically, the moment you get shares, the shares belong to you. You cannot gift it, and if I gift it also, what? It will be a transfer. So, this in ESOP taxation we will just see quickly later. Third one, transfer of a capital asset being work of art, archaeological, scientific or art collection, book, manuscript, all these things. So, if I sell art, archaeological collection, we already saw it is capital asset and its capital gain. But if you sell it to or give it to the government or university or national museum, national archives, something of relevance like Bombay Natural History Museum, if you donate it or you sell it also, that will not be considered as a transfer. It will not be considered as a transfer, no problem. So, in all the above cases, what happens guys? Cost of acquisition will be cost to the previous owner. Cost of improvement will be incurred by the previous owner plus incurred by the present owner, except the cost of improvement incurred before 2001. That anyway is excluded, we have seen that. Period of holding will be what? Date of acquisition by previous owner to the date of transfer by present owner. And indexation, cost of acquisition into index for the year of transfer divided by index for the year of acquisition by the previous. Everything we have discussed, same provision will come. So, this was a landmark judgment of indexation, Manjula Desha, which has been thrown aside in the new thing that you leave. What has happened in the new thing? Leave it. Yes, Manjula Desha is bye-bye, over. Right, there is a landmark judgment. That time they told, yes, that is what it is. So, gift taxation, check this out. This is how it works. Mr. Raj, who is a husband, previous owner of the asset, he gifts it to wife Mrs. Simran on 5/6/2018. Not a transfer, no capital gain. Mr. Raj had acquired it on 2001-2002, cost of acquisition was 5 lakh. Gives it to Simran. Simran now sells it to Mr. Kunal on 14th October 21. Simran is the present owner, Kunal is the new owner that he is getting, and 80 lakhs he is selling it. She is selling it to Kunal for 80 lakh rupees. What would be the period of holding? 2001-2002 to 21-22. 2002 to 21-22. What is the computation of capital gain? Full value of consideration is how much? 80 lakhs. Less transfer expenses, nil. Net consideration, 80 lakh. What would the cost of acquisition be? This amount here, 5 lakh into, when are you, selling? 21-22. But when is it coming from? The period of holding from 2001-2000. Simple points. So, long term capital gain 64,15,000. 64,15,000. Transfer between holding company and subsidiary company. So, generally guys, any sort of transfer between holding and subsidiary is taken to be what? Not a transfer. So, for example, Lipton Incorporated Germany had 100% subsidiary Lipton India, right? And then Unilever UK bought Lipton Incorporated Germany, because of which the shares of Lipton India had to be sold to Unilever UK. Whatever it is sold at 400 rupees per share. 10 rupees share was sold for 400 rupees per share. So, 390 rupees per share as an example. Would that be taxable? The answer is no, because as I told you, holding subsidiary relationship, there should be 100% subsidiary. Normal subsidiary if you sell, then fine, but what is exempt? Holding company should have a 100% subsidiary, and subsidiary should be an Indian company. Another case, 100% subsidiary transferring shares to holding company, and holding company should be an Indian company. So, if Tesla Incorporated, a foreign company, has 100% shares in Tesla Bangalore, which is an Indian company, then any transfer of assets from Tesla Incorporated USA to Tesla Bangalore exempt. Reverse, Reliance is the holding company, correct, and subsidiary, 100% subsidiary is Hamleys Toys. Hamleys Toys transfer shares, assets, whatever it is, to Reliance, which is a 100% holding company. And here holding company is an Indian company, hence it is exempt, no problem. Apart from that, there is one more condition, that's what here, whole of the, that's what, transfer between holding company and subsidiary company, 47.4 and 47.5. See, none of these section number, subsection number not needed. What is not a transfer? Section 47, that's it. No need to remember 47.4, 47.5, all that nobody will expect you to remember, it's okay. So, transfer of a capital asset by holding company to wholly owned subsidiary and is not regarded as transfer if holding parent company should hold whole of the share capital. Subsidiary company should be an Indian company. And transfer of capital asset by subsidiary company to its holding company is exempt if the following two conditions are satisfied. Yes, holding company should be an Indian company. Now, the holding company is transferring shares to Indian company, everything, or it is transferring assets to Indian company. An Indian company is taking over those assets and recording it as stock in trade. It was assets in the hands of the holding company, but in the subsidiary company, it is, let's say, subsidiary company is into real estate business. Holding company has transferred 5 buildings in the name of the subsidiary company, and the subsidiary company is accepting it as stock in trade. Do you think this exemption will come or not? No. Exemption will come if both the companies take it as capital asset. That is this point. 47 shall not apply if the holding company transfers a capital asset to the subsidiary company, the subsidiary company records it as stock in trade. Exemption will not apply then. So, holding company has to pay tax there because I am transferring it to you as a capital asset, it's okay, but you are recording it as stock in trade, hence for me I will have to pay tax, no choice. Now, to curb this from happening, whatever they are doing, I will transfer it as capital asset, you will keep it as capital asset for 1 or 2 years, then you will convert to stock in trade. Right? That is why one more section came, 47A1, where at any time before the expiry of 8 years, where did you see this 8 years before? Carry forward loss, then one more thing, asset relating to asset, using the asset. Yes, 35 AD, perfect, same 8 years. If such a capital asset is converted to stock in trade of its business, so directly when you record it only as stock in trade, anyway not allowed. To circumvent this rule, what I was doing, I was giving it to you as capital asset, you hold it for 2-3 years and then convert to stock in trade, then no tension, no. So you see, holding company, or that is one part, that is one part. One more is what? Okay, I am holding it as capital asset, you also hold it as capital asset, no problem. If I hold it as capital asset, you record it as stock in trade, problem, exemption will not apply. I am holding it as capital asset, you are also holding it as capital asset for 2 years, then converting to stock in trade, exemption will not apply. Fourth, one more thing was happening. I was holding it as capital asset, you also holding it as capital asset, but within 8 years, I used to divest, means 100% became 90% now, 70%, 60%. I have to sell the shares of the company to somewhere else. Then what about the exemption already allowed? Will allowed or not? No. See here. Holding or nominee cease to hold the entire share capital of the subsidiary. Amount of capital gain exempted earlier shall be chargeable to tax in the hands of the transferor company in the year of transfer of such capital asset. Very simple. So, when is the year of transfer? The year you sent it to the other company. So, I have to recompute it from that year. So, anytime within 8 years, if I don't do it, I should recompute in which year? In the year of transfer of such capital asset. No, it's in the year you transfer. I'll show you an example. Let's finish this, then we'll read this full example. I've covered everything here. We'll read the full thing, you'll get full clarity, don't worry. Then additional conditions. The provisions of 47A are applicable to a transfer. Assessment of the transferor company shall be reopened for the previous year in which the original transfer took place. Your doubt? Correct? With an example here we'll solve, don't worry. If the provisions of 47A are applicable to a transfer, assessment of the transferor company, in your example 2015, shall be reopened for the previous year in which the original transfer took place. When did the original transfer took place? 2015. To amend the order to charge the capital gains to tax. Right? What if it is time barred, etc.? We will see it in assessment procedure. If the transferee company, this is another doubt. 2015, you gave it to me, I kept it for a few years, within 8 years, I sold it off. If the transferee company subsequently sells the asset after satisfying the conditions in 47A, if I keep it for 8 years, no problem. Then cost of acquisition to the transferor company shall be adopted as the cost of acquisition to the transferee company. There is cost from the previous owner, no problem. If the asset is sold by the transferee company after attracting the provisions of 47A, means what? Within 8 years, 100% will reduce, or within 8 years, what will I do? I will sell off the asset, whatever it is. Cost of acquisition shall be the actual cost incurred by the transferee company to acquire the asset from the transferor company. Correct? Sorry? Yeah, correct. Perfect. Indirectly, what is it? 0, because I have not paid anything, no? So, it will be 0. Instead of telling nil, what am I telling? Cost of acquisition, nil. So, very simple. Either keep it for 8 years, or, everybody understanding? I will show an example, don't worry. Either keep it for 8 years, or, and that 100% thing also should be there. If you sell it off within 8 years, or if the value decreases below 100%, then whatever was exempt that year, in the year of transfer, I will reopen it and do the calculation there. And ultimately, when I am selling it now, or let's say I have fulfilled all the condition, absolutely no problem, and after 8 years I am selling, sell, no problem. Cost of this will be cost to the previous owner, normal like gift only. But the moment I attract 47A, and then I am now paying, what do you say, I have already paid tax for that time, no problem. So, here cost of acquisition cannot be taken as that. Cost of acquisition will be taken as the cost at which I am acquiring. So, everything combined, we will see an example here. Withdrawal of exemption. Right. So, Pani Puri Limited Holding Company, subsidiary company, Save Puri. Yes, you have to give these examples. So, building is what? Cost is 10 lakhs, capital asset, right? Purchased in 2001, 2002. Transferred to the subsidiary company on 22/4/2020. Right? At what rate is it transferred? What was the FMB or whatever it is? It is 50 lakhs. Even if it is sold also for 50 lakhs, is there any capital gains? No. It can be anything. I would have purchased it for 50 lakhs, or I have purchased it at nil also, whatever it is. It is depends on the transaction between holding and subsidiary company. Whatever it is exempt until you follow the conditions. Building is sold by Pani Puri to Save Puri on 22/4/2020. They have sold it actually. Right? Save Puri Limited sold the asset on 27/8/22 for 85 lakhs. In this case, is there a violation of 47A? Building was not converted to stock in trade, and the relationship between holding and subsidiary does not cease for 8 years, that is till 23/4/2028. So, capital gains for Sevpuri Limited, transferee company for previous year 22-23, that is assessment year 23-24 is what? What is the FVOC, guys? 85 lakh. I am selling it for how much? 85 lakh. What is the index cost of acquisition? Cost to the previous owner. What is the cost to the previous owner? 10 lakh. And what should be the period of holding? From that year till whenever I acquired. When did I acquire? 21-22, right? Sorry. When did I acquire it? When did I sell it? When am I selling it? Because that is not a transfer. When am I transferring it actually? In this example, 21-22. When am I selling it? 21-22. So, it is what? Period of holding is what, guys? 01/02 to 27/8/22. Sorry, here. Sevpuri sold the asset on 27/8/22. Oh, yeah, 22-23. Correct. 22-23, correct. My bad. You're right. So, that CI will be wrong. Yeah, that's fine. Whatever. But ultimately, this is the correct. 27/8/22 will be 22-23. You're right. So, whatever it is, you will take it into account. No problem. That is a mistake there. Cool. That is fine. Done. So, it's simple. Have I violated anything? No. I can either sell it for nil or I can sell it for some value. I don't care. And the relationship is subsisting also for 8 years, and I have not taken it as stock in trade. So, no problem. Case number 2. Yeah. Which one? Reverse. Can you do it to subsidiary of a subsidiary? That is allowed. Can you do it to the holding company again? Then again I need to see that. The subsidiary company, is it 100% holding company? There are two things, no? Holding company giving to 100% subsidiary, 100% subsidiary giving to holding. Both are covered. Ultimately, both if they are Indian companies, it's okay. Otherwise, it will not apply. Exemption is very simple. Subsidiary 100%, holding company should give it to 100% subsidiary. 100% subsidiary should be an Indian company. And 100% subsidiary should give it to holding company. Holding company should be Indian company. In this example, both are Indian companies, so no tension. But if one is foreign company, then the exemption will not come. Yes, building is sold by Panipuri Limited to Sevpuri Limited on 22/4/2020 for 50 lakhs. On 26/2/22, assume relationship between Panipuri and Sevpuri ceases to exist. Means what? That 100% thing is gone. In this case, capital gain arising from transfer of capital asset not charged to tax by virtue of section 47 shall be actually charged to tax in the hands of transferor company. In which year? In the year in which transfer took place. Which year was that? Which year was that? 2021. Why? Here, this one. Correct. Which year was that? 2021. So, I have to reopen the proceedings and charge to tax there, which means capital gains in the hands of Panipuri for the previous year 2021. FVOC. Now, that cost of acquisition will be the cost at which I bought. If it is nil, then it is nil. In this example, I have paid how much? 50 lakhs. 50 lakhs. Generally, in practical life, it will be nil only. Nobody will buy, since its capital gain is also nil, I will take it into account. But I need to see now whether gift taxation will apply, later we will see. Anyway, 50 lakh minus again 10 lakh into 301 by 100, 30 lakh 10,000. Long term capital gain 19 lakh 90,000. Now, I have already paid for this tax. Sevpuri is selling this building on 27/8/22. In the year 22-23, they are selling it off. For how much? 85 lakhs. Capital gain in the hands of Sevpuri in previous year 22-23, that is assessment year 23-24. FVOC is how much, guys? 85 lakhs. Less indexed cost of acquisition. What will be the cost of acquisition that I will take? Since I have already paid tax here, I will have to take that same cost of acquisition, 50 lakhs. into same. Here I have brought it till 2021, that will be my year of acquisition, and year of selling will be 22-23. Long term capital gain 30 lakh 1,661. Is it clear? Yes. Third condition. Building is sold by Panipuri Limited to Sevpuri Limited on 22/4/2020 for 50 lakh rupees. On 26/2/22, Sevpuri Limited converts the building into stock in trade. You should not do it for 8 years. FMB of the building on 26/2/22 is 65 lakh. Conversion of building into stock in trade. Capital gains, whatever was not charged, shall now be charged in the hands of the transfer company in the year in which the transfer took place. Right? Capital gains in the hands of Panipuri Limited for the previous year 2021, that is assessment year 21/22. How much? 50 lakh. Minus indexed cost of acquisition. How much will it be? 10 lakh rupees. What is this index cost of acquisition? 10 lakhs. Why? Normal, because you have breached the thing, no? Same way. So 301 divided by 100. So what is it? 30 lakh 10,000. So what is the long term capital gain? 19 lakh 90,000. Now Sevpuri Limited sells this building on 27/8/22 for 85 lakh rupees. Capital gain in the hands of Sevpuri will be what? See, they have already converted to what, guys? Stock in trade. So basically, on the date of this thing, on the date, when is transfer? Transfer is on the date of conversion. We have already discussed this. Transfer will be on the date of conversion. But when will the capital gain be calculated? The day the stock is sold. So Sevpuri Limited sells the building on 27/8/22 for 85 lakhs. Capital gains in the hands of Sevpuri Limited in previous year 22/23 is what? FVOC, basically 65 lakhs. This is the FMB on the date of conversion. Minus cost of acquisition already discussed, 50 lakhs. This is short term because 22/4/22, 26/2/22. So what is the short term capital gain? 30 lakh 1,661. Right? What is the income from? Sorry. Oh yeah, there is some calculation problem. Yeah, correct. You're right. That will be 15 lakhs. Yeah. So this one, what do you say? What this is correct, guys? You're right. Anyway, what is the income from PGBP? PGBP will be very simple. That is FMB 65 lakhs. Income from PGBP is 85 minus 65 lakhs. That is 20 lakhs. This is correct. So income from PGBP 85. This we have already done. Conversion of capital asset into stock in trade. So transfer will be in the year of conversion, but the tax will be postponed to the year of payment. Simple. Which one? Rate will be as on that. Rate will be as. Rate will be as on that day. Only the period of holding, etc. will come here. Right. So next one, if you see, transfer of a capital asset in a scheme of amalgamation by amalgamating company to amalgamated company is not regarded as transfer if the amalgamated company is an Indian company. Similar provision. So if the amalgamated company is an Indian company, then it will not come. So if you go to point 4, chapter number P. Chapter number P, just quick conditions we can just go through quickly. Chapter P. See here guys, chapter P. According to 2(1)(b), amalgamation in relation to company means merger of one or more companies to another company, merger of two or more companies to form a new company. Merger of one or more companies with another company. This is absorption. Or merger of two or more companies to form a new company. Vodafone Idea became Vodafone Idea. On the other hand, this Hutch was taken over by Vodafone. So in that case, Hutch became Vodafone. That was absorption. Like Reliance took over a company called Tesseract. Tesseract was into, it's a Bangalore based company. In 2012 only they took over. They were into virtual reality. So they do these VR glasses, etc. So Jio is working on, they already released it 2 years ago, something called Jio glasses, whereby if you see virtual reality. So in the next future, with AI also integrated, everything will be through virtual reality, is what the thing is. So here same thing, whether it is merger by absorption, by amalgamation, whatever you technical difference you find in your FR, that doesn't matter here. Everything is covered under the same section for income tax purposes. These conditions should be satisfied, that's all, these three conditions. So if an amalgamating company transfers shares to amalgamated company, means if Tesseract is selling its shares to Reliance, everything they are selling, when will the transfer be exempt? When will the transfer be exempt? Point number 1, all the property of the amalgamating company or companies should become the property of the amalgamated company. Second, all the liabilities of the amalgamating company or company should become the liabilities of the amalgamated company. Right? So all the property of the amalgamating company should become the property of the amalgamated company. All the liabilities of the amalgamating company should become the liabilities of the amalgamated company. Basically, everything should go there. And most importantly, shareholders holding not less than 75% in value of the shares should become shareholders of the amalgamated company. They are not saying 75% shareholders should go. They are saying shareholders holding 75%, which means mostly the promoters and other fellows only will have some 80%. They should be shareholders here also, that's why. Even if they hold one share here, it's fine. What they are trying to tell is shareholders of the old company holding 75% in value should now become the shareholders of this company. If all these conditions are satisfied, then the transfer is exempt. Otherwise, not exempt. Simple. So if you see, A Limited is amalgamating with B Limited. B Limited holds 20% of the shares in A Limited prior to amalgamation. Now, what about this, which already had prior holding? For the purpose of above clause, shareholders holding 75% or more of the shares in value out of the remaining 80% only should be considered. If one company is already holding shares in my company and I am taking over that company, that 20% is immaterial, right? So that I should exclude. And of the remaining 80%, 75% of the shareholders should come on board in this company. Because if I am only holding shares in you and you are taking me over, that part should be ignored, is what they are saying, which is correct. And as per 47(6), which we are discussing, there are no capital gains on transfer of capital asset by amalgamate subject to these conditions. If this condition is there, now tell me guys, all assets, cost of acquisition will be cost to previous owner, period of holding also will be the same. And when the shareholders are allotted shares, then also it will not amount to transfer, hence there is no capital gain. Simple. Again, most important thing, the final company should be an Indian company. So what they are trying to tell is here, the 75% value fellows will go to the new company, right? So in exchange of present company shares, Tesseract is selling to Reliance. So Tesseract founders having 80% shareholding, they will get shares of Reliance in exchange, obviously. So now for them also will capital gain come? No. When the main merger only is not liable to capital gain, for me also it will not liable to capital gain, provided the final company should be an Indian company. Cost of acquisition of shares in amalgamated company, Reliance, is cost of acquisition of shares in the amalgamating company. That's all, no change. Whatever I bought here, same will be the cost there. Period of holding will be the full thing, same thing. Right. Same concept for demerger also, guys, no change. All property, everything should be given, same 75%, no change at all. So coming back to our capital gain, amalgamation, demerger, all same. Shareholders also we saw. Right. So these are all the things that we have to see. Next, coming to the next point, F. Conversion of bonds, debentures, debenture stock or deposit certificate of a company into shares and debentures is not a transfer. This is what for convertible bonds, convertible debentures. Isn't it changing from one form to the other form? Yes. And you will be getting some extra money, extra benefits. For example, debentures you are converting to equity shares for which you will get the value will increase. So I would have bought debenture valued at 1 lakh and now the current value and conversion will become 2.5 lakhs. On that 1.5 lakhs will there be tax? No. There was one interesting case where Tata Power issued convertible debentures and the shares which were convertible debenture into shares, and for every debenture held or for every 5 debentures held of Tata Power, they allotted 1 share of Tata Consultancy Services. Exemption applicable or not? Tata Power issued debentures. For every 5 debentures of Tata Power, they gave 1 equity share of Tata Consultancy Services. Conversion, same group, allowed or not? Exempt or not exempt? Not exempt. Why? Yes, one word. Conversion of bonds, debentures, debenture stock or deposit certificate of a company into shares or debentures of that company is not regarded as transfer. If you give it some other company, 100% regarded as transfer. If such converted assets are sold subsequently, cost of acquisition of shares or debentures so received on conversion shall be the cost of debentures, etc., which were converted. Same thing. Whatever you received shall be the cost of debentures which were converted. Period of holding shall include the period prior to conversion. Example, in 2003-2004, 100 debentures of 10 each were issued at 5%. In 2014-15, 100 debentures were converted into equity shares of 10 each. This conversion does not amount to transfer, no capital gains. Capital gains shall arise only when the shares are being transferred subsequently. In this case, cost of acquisition of equity share shall be the cost of debentures, which is 1000, this one. Period of holding will be from which year? 2003-2004. That's the interest portion. 5% is the interest. So that you will be getting interest, that's your income anyway for you. So we saw one thing, right, that gold monetization scheme. Is it a capital asset? When we are discussing capital asset, we discussed if I transfer the gold to gold monetization scheme, is it a capital asset? It is not a capital asset. Then he asked one question, what about sovereign gold bonds? So I said sovereign gold bonds is a capital asset. But is capital gain there or not? I will buy sovereign gold bonds and the government will redeem it later. That redemption money that I am getting, is there capital gain or not? Yeah, so point number B. For that we'll do a chart later, but here. Redemption of sovereign gold bond issued by RBI under the Sovereign Gold Scheme 2015 in case of an individual SSE shall not be regarded as transfer. Which means I'll have to explain one more point, later we'll discuss that. Because sovereign gold bond, one is this one, sovereign gold bond can also be other SSE, no? Later we'll see that. Then also, Indian government wanted to ensure that the rupee gets stronger. So they issued certain things called rupee denominated bond. So Indian companies started issuing rupee denominated bonds in IFSC, International Financial Services Center. One of the largest IFSCs in the world is the Gift City in Gujarat. Correct? So Gift is one of the largest, correct, trade center. So there are, you have stock exchanges, and then you can also sell it outside India also we can issue. So in order to ensure that you please invest in rupee denominated bonds in India, that too in Indian currency. I am denominating in Indian currency, but you are investing in US dollars. So any income is also exempt separately. Apart from that, when you transfer it to some other person, whatever money you make, that also is exempt in your hands. This is just to ensure that people buy rupee denominated bonds, especially non-residents buy rupee denominated bonds and bring in the requisite US dollar into the country to increase our foreign exchange reserves. That's all is the objective. That is why point number C was inserted. Transfer of a capital asset made outside India by one non-resident to another non-resident in the nature of what? Rupee denominated bond of an Indian company, or even if you buy a government security, shall not be regarded as transfer. Shall not be regarded as transfer. Transfer of a capital asset made outside India by one resident to another non-resident, one non-resident to another non-resident in the nature of what? Rupee denominated bond of an Indian company. Government security shall not be regarded as transfer. Very simple. Why? It is only and only to give them the benefit, that's all, nothing else. There is no other hidden agenda. So just have to give you that benefit of investing in the country. So however, if there's such equity, and one more, that is one thing. So guys, here conversion of bonds, debentures, debenture stock, etc. is not regarded as transfer was there. What about preference shares? Preference shares converted to equity shares. Is it a transfer or not a transfer? Used to be a transfer, for which for conversion the valuation will increase obviously, right? Preference shares will be like 100 rupees means equity shares will be 200 rupees. So ideally speaking, the difference you have to pay tax. So they went and told, when you have given it for bonds, debentures stock, why not for preference shares? So government had to amend it and add here. Conversion of preference shares of a company into equity shares of that company is not a transfer. If such equity shares are sold subsequently, same, no change. Period of same like debentures, no change. This part we'll see later. Next part we'll see later. Next, reverse mortgage. This is one of the very good schemes brought in by P. Chidambaram. Right? So what is this? He observed that many Indians go abroad, no problem, and start living there. But one thing as per the statistics that the government had was, they will never come back also. They don't care about their family property also. And the thing is, more often than not, the parents are fending for themselves later. But one thing they'll come for sure is when the parents die for the will, because they'll get the property. So until they live, nothing, but after that, property. So he recorded many such cases in Tamil Nadu, Kerala, Karnataka, and all parts of India. He recorded. And then he said, we need to, but what about the sustenance of these elderly people? Nothing can be done. So what he did was, he came out with a scheme. Generally, mortgage means what? I will put my asset as a security to the bank, and bank will give you a loan. And then it can be used to buy another house also. Basically, if I have some asset, I'll give it, mortgage my entire immovable property. I want to buy a new house. I'll take a loan and buy a new house. And then repay the money and get my other house also. Here, and the thing is, they are not getting any money. Who's not getting? I'm just getting a loan, nothing else. Here, what he did was, came out with a wonderful concept where he said, if you have a house and you're an elderly person, you give the house to a bank, SBI, no problem. You give it to them. Don't transfer the ownership as such, but just give the papers, security. They will give you one lump sum amount for your expenses. Apart from that, they will also give you what? Monthly payout, so that you will be taken care of fully. Till when? Till you die. Or the period of that, whatever, 10 years, 15 years, whatever you want, you can opt for. At the end of the period, I've just taken the security, that's all, and I've given you this money. That money for you, is it taxable? No. That money that you are getting is not taxable for you. Enjoy. You please live your life. But at the end of whatever years, if you die, then I'll sell the property, close the issue, no problem. If you don't die, if you want the property back again, then you purchase it. It's like that time, it will be like that whatever you have paid, you repay it and you take it. Otherwise, the objective was what? Anyway, you have 15 years, 10, 15 years to live. You enjoy. I will give you money. Just keep your property in my name. You please enjoy the money. I'll give you every month, first lump sum, and then every month I'll give. So your expenses till you die is taken care of. Then that fellow said, what if I die? If you die, you will leave, enjoy, no problem. Right? But what about my children? There also they thought about their children. Then Chidambaram said, boss, your children don't care about you now only. After you die, they'll want the property, no? That time they'll come. Then I will collect money from them. Then I'll tell your parents, I gave you, your parent this much money. So you please pay this and take the property to you. That is a wonderful concept. Predominantly, the idea was very simple, to ensure that the elderly people are taken care till they die without having to spend anything, as long as they have a property. That is reverse mortgage concept. So you see. And now, when I am transferring the capital asset to government and government is giving me money, it's actually transfer, no? They said it's not a transfer. That is why they made it exempt. Right? Transfer of capital asset in a transaction of reverse mortgage by a scheme made by central government is not regarded as transfer. Reverse mortgage is a scheme of liability of senior citizens under which bank could take the properties and provide lump sum amount. Secure stream of cash flow. The liability to capital gains arises when? On reverse mortgage, only at the point of alienation of the mortgage property by the bank for the purpose of recovering the loan. That time would have died anyway. So basically it's like I am going to now, when the children come for the property, that time I will recover money from them. That time it is. Then 1043 also exempts any lump sum payment also, no problem. Full exemption. Maximum period of loan is what? 20 years. Directly. When the loan is dispersed in part or in full for the purpose of periodic payments. Periodic payments till the residual lifetime of the borrower. Imagine. That's what. Basically the idea is what? You don't have to pay anything. Give the property, you enjoy, you go. Bank is telling, I am like your son. I am like your daughter. I will take care of you. Just give me your property. That anyway your son also will tell the same thing. Instead of that, it's a legal way. You give the property to me, I will take care of you. No problem. So later when that son comes, then that time we'll see. That will be charged. So that is the scene. Reverse mortgage. So when I am transferring the money, that is not a transfer. And when you are giving me some money, that is also exempt under 1043. That is reverse mortgage. Cool. So there are so many things like this, guys. So let us see. Then, one second. That is the reverse mortgage concept. Next, we'll come to the other areas. We'll discuss bonus shares. Tell me one thing. Is bonus share is just a capitalization of reserves? According to you, is bonus share when they issue, is it a transfer of capital asset? So you are getting certain things. Is that a transfer of capital asset? No. It is a conversion of what? Reserves and surplus into this thing. What would be the cost of acquisition? Is it FMV or 0? Right. So now the problem was cost of, you are 100% right. Cost of acquisition on or after 1st April 2001 is 100% 0. What if the bonus was issued before 2001? Is it 0? Actually, as per this section, it was 0. But if you see other section, is bonus share a capital asset? Yes, share is a capital asset. This section said 0, cost is 0. But you read the other section. Other section says all assets acquired before 1/4/2001 will be cost or FMV, whichever is higher. Correct? So cost is 0. FMV, there will be some value of that share. So what should I take? Very stupid provision, unfortunately. Right? So bonus shares acquired before 1/4/2001. Cost nil. This section says nil only. But that section is not changed, no? So cost or FMV as on 1/4/2001, whichever is higher. Which means if at all you have issued any bonus shares before 2001, I have to compute what? FMV also. And that take that as the cost. But subject to one provision called 112A, which we will see later, this thing will slightly change. We will again discuss later. Right shares, coming to right shares. So all the important things, adjustments we are doing. Right shares, market price 1600. Right is given at 1300. Right is an entitlement. $50 shares. I am acquiring 50 shares. Because I have got the right to acquire 50 shares basically. I can acquire the 50 shares at 50 into 1300. So if I acquire this right to buy 50 shares and actually buy it at 1300 rupees, what would be the cost of acquisition? Very simple, 50 into 1300. But the thing is, I can choose to what? Renounce the right, surrender the right, or relinquish the right. Let's say I surrendered the right. So if I sold the right for 200 rupees per share, if I sold the right to 200 rupees per share, am I not relinquishing the right? Yes. Is right a capital asset? Yes. Relinquishment of right, is it a transfer? Yes. So what will be my capital gain? 50 shares right into 200 rupees per right or per share. Cost will be nil. I didn't do anything to get that. So 50 into 200. 10,000 rupees is always short term. Why? Because right shares are allowed only within 15 to 30 days. That's it. When I issue a right offer, it is allowed only for how many months? 1 month, that's all. Within 1 month, you have to decide and close it. They will not give that offer for 7 months. The prices are so dynamic, 1 month maximum. So, selling of the right is always short term. Short term, it will always be a gain only. So, no, it's always a gain because the cost of acquisition is always nil. On the other hand, I sold it to Sheila. So, cost of acquisition for her will be two things. One, 1300 she has to pay Reliance. 200 she has to pay me. But the market value is 1600. So, that's fine. She will be paying 1300 into 200 plus 200. So, she will be paying what? 1500 into 50 shares. 1500 into 50. So, this is what you need to look at. This is for which one? Right shares. So, anything they ask right shares, this will be the value, like that we should understand. Enunciation and all those things. Now, generally for debentures and bonds, you will not get any indexation. Why? Because debentures and bonds generally they don't go through any fluctuation. So, debentures and bonds, no indexation. There are two exceptions. One is called a capital indexed bond, which is no longer continuing. Second one is sovereign gold bonds. Sovereign gold bonds issued by RBI, you will get indexation. So, coming to that chart that I was saying, sovereign gold bonds issued by RBI. Generally, the maturity period will be 8 years. Maturity period of sovereign gold bonds will be 8 years. Remember, individual and SSE. What is not a transfer? Individual or SSE or other SSE? Sovereign gold bonds transferring for individual is not a transfer, or for other all SSEs. You can read and tell. Sovereign gold bonds exempt, we just did now. Individual or all SSEs? Individual. Which point? There you go. Point number B here, no? In main point F. Individual SSE. So, if the individual SSE is redeeming on maturity, then it is not a transfer. Hence, no capital gain due to section 47. If I am redeeming it before maturity, then capital gains will apply. I will also get indexation benefit. Only if I am redeeming it on maturity, it is not a transfer. This is for individual, because there also very clearly it said issued by under sovereign in case of an individual SSE, not regarded as transferred, only when what? Maturity. As per the scheme. Scheme says only as per maturity. Others, other SSE, whether you redeem on maturity or before maturity, it will always be regarded as a transfer. Capital gain will come. Indexation also will come. Indexation also will come. So, there is always indexation for sovereign gold bond because it is an exception. General rule, no indexation in case of debentures or bonds. Exception will be SGB, sovereign gold bonds. Now, interesting point 50B, slump sale. These things we'll discuss in a while. Come to this slump sale. So, if you remember in PGBP, we are calculating the WDV and that minus you had monies payable, then minus slump sale. So, slump sale is a scenario where the asset can be, different assets can be in different blocks, but it will all belong to one particular division. So, slump sale is like selling of that entire division, company, etc. So, I told you the WDV is always granted for an SSE and not for the block concept is for an SSE and not for company. So, if an SSE is having multiple businesses, what I meant was if the company has multiple businesses, then each business will have different assets and all put together I will make it into a block of asset. So, slump sale under 50B is selling of an undertaking. So, this is governed by section 180 of the Companies Act, which will give you the power to sell an undertaking. So, you require a shareholders resolution and a board resolution to sell it off. So, slump sale means transfer of one or more undertakings for a lump sum consideration, without values being assigned to the individual assets and liabilities in such transfer. Transfer of undertaking can be in the form of sale, exchange, relinquishment, whatever it is. So, part of the undertaking if I am selling, that is what I need to do. So, if the capital asset being an undertaking itself, the best part of the story is slump sale. What is the property that you are selling? Asset or undertaking? Undertaking. The undertaking was started 4 years ago. 90% of the assets were bought 1 year ago. Long term or short term? The undertaking was started 4 years ago. After discarding many assets, 90% of the new assets were bought 7 months ago. Now I am selling in a slump sale, everything I am selling. Long term, short term? Long term, because the asset here being sold is the undertaking, not the asset, not the individual assets, bulk. So, that is here you see. If the capital asset being one or more undertaking, transfer under slump sale is owned and held for more than 36 months, capital gain shall be treated as long term capital gain. In any other case, short term capital. The period, Supreme Court decision 2017, period of holding of the undertaking is relevant. and not the period of holding of individual assets. Now this is important because I'll ask in the exam. Computation of capital gains on slump sale. How will you compute? I told you it's the entire value of the undertaking. When I say value of the undertaking, it will be what? FMB of the undertaking, right? So, FMB of the capital asset on the date of the transfer of undertaking shall be deemed to be the full value of consideration. FMB of the capital asset on the date of the transfer of undertaking shall be deemed to be the FVOC. The fair market value of the capital asset shall either be FMB1 or FMB2, whichever is higher. So, I should compute FMB1 or I should compute FMB2, whichever is higher I should take. One of the values mostly will be given. The second value generally will be given, actually, this one. See, here I am not selling the assets again, let me repeat, I am selling the entire undertaking. So, I should compute the value of all the assets being sold, and from each block I should remove that portion. That is why in PGBP it said minus slump sale, right. FMB2 they will generally give, is what I have seen. FMB1 we need to compute. FMB1, A plus B plus C plus D minus L. A, book value of all the assets other than jewelry, artistic shares, securities, immovable property. All other assets other than jewelry, artistic work, shares, securities, immovable property, because all these things will be market value. For jewelry, artistic, shares, securities, immovable property, market value. What is left then? Your current assets and all that. That will obviously be book value, no? Debtors balance, book value only I should take. As appearing in the books of accounts of the undertaking division transferred by a slump sale as reduced by the following amounts: income tax paid after reducing the amount of income tax refund, and unamortized amount of deferred expenditure does not represent the value of any asset. All your other expenses, deferred expenses, unamortized version, preliminary expenses, etc., whatever is there, I should knock off everything, and whatever balance is left, that only I should take. Jewelry, very simple, price at which the jewelry is fetches in the open market by a valuation expert. Take the valuers that they will give in the question only, they will give that a valuer's figure, jewelry, this was what he was claiming. Point number C, shares and securities fair market value as determined in rule 11 UA. Mostly they will give this. Stamp duty value of immovable property. So, immovable property SDV. Always we have been seeing HSDV. Under 50C, what should I use? SDV. Liabilities. Lastly, I have to, all the assets have accumulated. I have to knock off what? Liabilities. Liabilities will be book value. Book value of liabilities as appearing in the books transferred by way of slump sale, but not including the following amounts: paid up equity share capital, amount set apart for payment of dividends on preference shares. This is what? Proposed dividend. Dividend equalization reserve, that I should knock off. Reserves and surplus, I should not take. Basically, guys, whatever comes in the shareholders' funds, I should not take. What is shareholders' funds? Paid up equity capital, reserves and surplus, dividend, equalization reserve, all that separate, outsiders liability. So, liability to you understand as outsiders liability. Provision for taxation, all these things should be knocked off. Basically, I should take only the outsiders liability, creditors, all that I should subtract. That only obviously gives me my what? Net worth sort of a thing, and FMB. All assets minus outsiders liability is my net worth. Other way around, if I just add the shareholders fund, that is the net worth. That only I am transferring outside. right? Simple, logical. That is FMV1. FMV2, value of monetary consideration received or accruing as a result of the transfer. When you are selling it, what is the money that you are getting that you should add? Fair market value of the non-monetary consideration received or accruing during the year. Monetary consideration, non-monetary consideration. And open market pricing of other assets, property, movable property, etc. Other than movable property, other movable property. And plus H, stamp duty value of non-monetary consideration. So FMB2 generally they will not ask you, they would have given. But actually in all the questions they will ask you to do FMB1 only. Net worth of the undertaking shall be deemed to be the cost of acquisition and cost of improvement for the purpose of computation of capital gains. So if you see, depreciable asset WDV, assets of specified business at 35 AD nil, self-generated goodwill nil. This you remember in 35 AD we discussed. In slump sale it should be taken as nil. Self-generated goodwill nil. Other assets and liabilities book value. So all that I should add. So net worth will be the cost of acquisition. What is the selling price? FMB. Minus cost will be what? Net worth. And obviously, the FMB I am taking the fair market value. Net worth will be generally at book values. That only will obviously talk about the gain, right? That only will give me the actual gain amount if you think about it. That will be taxed. Since I am doing everything at market value, do you really think I will get indexation benefit again? No. And of course, we will need CA's, what do you say, certificate. Neon Private Limited sold assets and liabilities of Division Pink as a slump sale to Lavender. Lump sum consideration of 615 monetary consideration. Building is 300 lakhs. SDV is 400 lakhs. What should I take? 400. Plot of land 250. SDV 350. Then balance sheet of Neon Private Limited is as follows. All these things. Following information is given. Land and building purchased in 2008 for 400 lakhs. SDV as on 31/3/2003 was 1350 lakhs, which they have again revalued here. 2000 it has become. WDV of plant and machinery as per Income Tax Act is 300 lakhs. I should take Income Tax Act or Companies Act? Which one? Yeah. Capital gain on slump sale will be computed as follows. So note number 1 will be calculation of FVOC. A is what, guys? Other assets at what value? Book value. Plant and machinery, what should I take? Book value. 350, yes or no? 350, that is the WDV portion. I should take 350 book value. Sundry debtors 260. Bank balance 80, loans and advances 20, stock 90, all these things. Book value 800. B is what? Jewelry. C, shares, nothing is there. D, land and building. What should I take? SDV. Here they are given 1350. Should I take the revalued figure? No. SDV clearly mentioned 1350. Then other things, unsecured loans, sundry creditors, this one. Sorry? Then you'll have to take the value mentioned here. If it's revalued, you have to deem it to be SDV. They'll give, man. Generally, they'll give. Otherwise, we should take that value. Then it doesn't make sense. Here, you can deem this only to be SDV then. By that logic, you can write a note. They'll give. Generally, they'll give. Yes. So, FMB 800 plus 1350 minus 595, which will be 1555. FMB2 also is given E plus F plus G plus S. Monetary consideration, they have only given 650 lakhs. That's the money that I am getting from it. F is nil, G is nil. And if you see H is what? That is 400 and 350 they have given. How 400? Here. Or first one? Here. Yes, this one. 400 and 350. Building and a plot of land. That is SDV I should take. 50 lakhs. So 1400. So FMB will be what? 1 or 2, whichever is higher. Which one? 1555. Computation of net worth. How will I compute net worth? Everything I should take at book value. Subtract everything at book value. That then plant and machinery as per Income Tax Act. Revaluation I should ignore. So all I should take at those respective values. Net worth will be 555. So what is the ultimate calculation? 1555 minus 555, 1000. And for this, under section 1112, directly I will have to pay capital gains. That is my slump sale. Done. Yes. Whatever you bought it for. That value only is its cost. No, but once he buys in slump sale, when he puts it in the respective this thing, what do you say, block, he will do the valuation and put in those block, right? So then that value only you should take. Because when I am doing this in the slump sale, whatever I bought, I would have put the values for each of those assets, no? That's how it is. I am actually taking over the entire business. Then it will continue. Cool. So we'll take a short break. After that, we will solve 1 or 2 questions which are there in the previous year's questions for slump sale, and then we'll move on. Alright guys, let's solve the question. Check out question number 5. Question number 6 you solve. That is Beta Limited. Question number 6, page 49. Slump sale question. Beta Limited has transferred its unit Omega and Delta Limited by way of slump sale on December 31st, 2023. Summarized balance sheet of Beta Limited as on 31st December 24 is given below. Fixed assets. Unit Gamma, Sigma, Omega. 75, 75, 275 lakhs. Debtors they have given separately. Paid up share capital, trade creditors. Using the further information given below, compute the capital gain arising from slump sale. Unit omega and the tax on such capital gain. They have given the values 167 and 348, which is our CIA. This has been repeated twice actually. This is 167 and 348, but unit omega they are selling. Lump sum consideration on transfer of unit omega is how much? 600 lakhs. That is the consideration they are receiving. Fixed assets of unit omega includes land which was purchased at 30 lakhs and revalued at 45 lakhs as on 31st December 23. Should I take revaluation? No. Stamp duty value of land is 42. What should I take? Stamp duty value. Other fixed assets representing machinery are reflected at 230 lakhs, 275 lakhs less the value of land obviously, which represents written down value as per books. The written down value of machinery is 155 lakhs. Unit omega was set up by Beta Limited. The company does not opt for 115BA, that is that other reduced taxation. So, computation of FPOC, first one, what will it be? First one, land, I should take the stamp duty value and not the cost or the anything else, revalued figure, 42. Machinery, I should take purely, it was point number A, all the book values, machinery book value, debtors book value, less trade creditors of only omega, they have given in the question 45. That I will subtract. FMB 1 or FMB 2, whichever is higher. FMB 1, how will I compute? The FMB 2 directly they have given 600. What is FMB 1? What is FMB 1? Fair market value of assets capital transferred by way of slump sale. Fair market value of the consideration. Here this is 600. So here if I do all these things, it will come up to how much? 627. So what should I take, 627 or 600, whichever is higher? So what is the answer? 627. Net worth of the undertaking shall be deemed to be the cost of acquisition and cost of improvement. How do you compute the net worth? Book value of non-depreciable asset. Land, revaluation is to be ignored for computing net worth, 30 lakhs. Debtors, 400. Written down value of the machinery, 155. They have given there. What is the debtors book value? How is it 400? It is given. Here, omega, 400. Written down value of machinery under 43.6, that also they have given in the question, 155. Aggregate value of total assets, 585. Less trade creditors of unit omega, here, 45. I should subtract. What will I get? I will get the net worth. That will be the cost, 540. So 627 minus 540. What is the long-term capital gain arising on slump sale? 87. That's the long-term capital gain arising on slump sale. And on that, 20% tax, 4% cess. That's it. Very, very simple. Similar problem, the previous one also. So 5 and 6 are the same. So if you see, easy questions are being asked and sometimes the tricky ones are also being asked, not that only easy ones are there, everything mixed. That's how it is. So slump sale is done, depreciable asset, net worth, all that is calculated. So that finishes that discussion on slump sale. So everybody got the answer, no? Yeah. Moving on. Yes, I was mentioning today morning and also yesterday that if I, can I measure the value of goodwill as such? No. So what will be the cost of acquisition? So in BC Srinivasa Shetty case law, which is a famous case law, they said the value of goodwill is indeterminate. That's why if I sell goodwill, what will be the cost of acquisition? Indeterminate, which means capital gain nil, because it is indeterminate. So to overthrow the judgment of BC Srinivasa Shetty, they changed the law and now they have told that anything, how much is it? What is it? Nil. If they make it nil, then at least you will have a cost. Otherwise, there will be no cost also, right? That is what it is. Come to that. Anyway, we'll discuss all the notes point later. So guys, in case of goodwill, business or profession, trademark, brand name, right to manufacture, produce, process an article or thing, right to carry on business or profession, any tenancy rights, LUMARs is generally used in your textile industry. So any route permits, the permits to go from one place to another place for the vehicle to move around, any tenancy rights, the right to occupy a place, anything for that matter, for a longer duration, it is all a right to do so. Cost of acquisition, it is nil if it is self-generated. Earlier it used to be indeterminate, now they have said it is nil. Purchase will always be the purchase price I should take. If it is purchased goodwill, then purchase price, then there is no doubt about it. But if it is self-generated, it used to be indeterminate, now it is nil. FMB as on 1/4/2001, benefit is not available at all for this. Indexation benefit is available. So basically speaking, cost of improvement, cost of acquisition is what? Generally, FMB as on 1/4/2001, that benefit etc. is not available for these things. It's very simple. Any cost of acquisition of goodwill is nil. Any purchase, whatever you are doing, it is the purchase price. That's it. If it is done before 1/4/2001, interesting to know that there is that benefit of 1/4/2001 FMB is not available, because for that particular section, that FMB point is not taken into account. Indexation benefit, yes, allowed. So cost of indexation, cost of improvement on the other hand, for goodwill, patent, copyright, right to carry on business, is there anything called improvement? What will you improve? Nothing, correct? So it is nil. Other assets, it is basically what? On or after 1/4/2001, any capital expenditure that will be taken into account. Before 1/4/2001, not taken into account. So that's about it. That is regarding those areas. What about capital gain in case of unquoted shares? As discussed, it is always FPOC is equal to fair market value. So unquoted shares means shares which are not listed, or listed but which are not traded regularly, that is penny stocks. So the share value is less than the fair market value, then the FPOC will be the fair market value. So if the cost of acquisition is 75,000 and I sold it for 100, but the FMV was 400. Whatever the case may be, if my share value is less than the FMV, they say, I don't care, do whatever you want, you should compute the fair market value, and only then that will be the full value of consideration. Very, very simple. Cases where asset is exchanged. I am giving you a building and I am taking from you some shares. So what is the value of shares then? Is it the value of shares that I have given you, or is it the value of the building that you are giving me? On the other, that is for me. For you, ulta. You are getting the shares, you are giving the building. What is the sale consideration? Is it the value of the building you are giving? That may be 2 crore, or is it the value of the shares that you are getting? 1.5 crore. So that is what is given here. When one asset is exchanged for another asset, and generally the consideration is not determinable because both are different. Full value of the consideration is equal to FMV of the asset transferred. For example, Mr. X has exchanged jewelry for shares with Mr. Y on 1/4/16. FMV of the jewelry as on the date is 14 lakh and FMV of the shares is 16 lakh. So he has exchanged jewelry for shares. So shares are coming in. So in the hands of Mr. X, FPOC, what is the share here? 16 lakh. That will be taken into account. In the hands of Mr. Y, he is getting what? He is giving shares, getting jewelry. So what is coming in? 14 lakh. Because both the values will definitely change. So what the value is coming in? Asset transferred. You see, Mr. X has exchanged jewelry for shares. What is coming in? Yeah, so what is it? 16 lakhs. I should take the shares. Very simple. Yes. Same value. Take the value. Because that will give the same value, no? Will there be a transfer? Is exchange a transfer though? Yes. So, but the value will be the same, right? And also, are you selling it to anybody as such? No. It's like you are only, going there and giving a gold in one form and converting to another form and taking. So is there any change in the value? Nothing as such. Only the charges you will have to pay anyway. That anyway you have to pay other ways also. Yes. So it's about whatever is exchanged. Asset received in return basically. Now, there is a first proviso to section 48 which says for non-residents, indexation you will not get. Right? So what used to happen was, US resident, $1 lakh is what he will want to invest in India. $1 is 70 rupees, assume. So $1 lakh means 70 lakhs he invests in India. He buys 10,000 shares at 700 rupees each. Now he's got 70 lakh rupees in his hand. He got shares worth 70 lakhs. Later he will sell 10,000 shares at 800 rupees. 80 lakhs he gets. What is the capital gain? 10 lakhs. Very simple, 80 minus 70, 10 lakhs. At the time of sale, however, unfortunately, because of the currency fluctuation, a dollar which was running at 70 rupees is now giving at 85 rupees. So 80 lakh divided by 85 is how much? $94, 94,118. Only because of the currency fluctuation. So what was his investment outflow? 1 lakh. What is the return on my capital? 94,118. What is the loss? $5,882 because of the exchange rate fluctuation. And what is the tax on which he has to pay money? On what amount? 10 lakhs because it's a capital gain. So first I will take tax. Then there is also a loss in my investment. So they said, boss, what is this nonsense? This is because currency fluctuation, it's becoming too much. That is the reason why first proviso was inserted, where they said, rather than converting everything to rupee at that point of time, take an average rate. That makes more sense. The full value of consideration will be average rate on the date of transfer. What is average rate? Telegraphic transfer buying rate, telegraphic transfer selling rate, TTBR, TTSR. right? The rate at which the bank buys from the customer, the rate at which the bank sells. Telegraphic bank, there's a banking rate which is available on the websites and all those things. So first only when I'm getting the money, convert it in the average rate. Transfer expenses also, do it in everything, convert. Net consideration you will get, less cost of acquisition, no indexation benefit because you are taking the average and you are taking the market rate anyway. And whatever the short term or long term you get in foreign currency, immediately later that convert to INR. Rather than initially everything converting and then ensuring that first 10 lakhs and then because of the currency fluctuation also it happens, take everything in dollar using these respective rates and then convert. By that you will definitely save up the money. So for example, if the average rate of transfer is like 74.5 and 74.75 assume, average rate will be 74.625. And this one alone, last one, that short term or long term that you get in foreign currency, this you convert to INR as on the telegraphic transfer buying rate, TTBR, on the date of the transfer. Everywhere average rate on date of transfer, average rate on date on everything is, this is only TTBR only, no average rate, TTBR on the date of transfer. So by that logic, if I spend 53 lakhs, convert to 74.625, I will get $71,000. Expenses on transfer, do the average, $884. Net consideration, I'll get so and so. Cost of acquisition also converted to the year at the time of acquisition, how much it was, 50,000. Finally, the capital gain assessable will be what? 20,138. This you just multiply by the 74.5, which is my buying rate. That will give me my full amount. That is, yes, telegraphic transfer buying rate as on the date of transfer. That makes a lot of sense because you are taking on that rate only. So rather than every year, every time changing it on that rate, currency fluctuation also you will do, plus you will get double loss. Instead of that, take an average, that makes more sense. Take an average, average out everything, and final rate that you get, multiply by the rate buying rate on the date of transfer. That is a better representation of the data and actual representation of the capital gain. You will not be burdened by any currency fluctuation to such an extent, because what you had initially, what you have now, you would have sold some shares, everything will change. So this was introduced, which actually helped many people for sure. And all the rates is adopted not by RBI, by the way, it is by SBI. So conversion and reconversion rate is the rate of exchange adopted by State Bank of India. That is what they have given. Benefit of indexation will not be available. This methodology is only for the shares. It's not applicable for GDR or ADR. Capital gains, what do you think, guys? Easy, difficult? It's actually quite simple. Just that little bit common sense here and there. PGVP also is simple. Assessment procedure is also very easy. Assessment procedure, people think it's very difficult, but it's actually not. It's quite simple. So we will go in the same depth that we are going, no doubt about it. We still have to do the income from other sources point of it, we will do for sure. Just seeing some other points. A little bit of international taxation also comes in capital gain because non-residents are involved. So for non-residents, what is taxable? So there are two important rules that we need to remember, which is enshrined in section number 9. And the share part of it we'll have to discuss in capital gain. So all shares are taxable, or what is taxable for them? Rule number 1 is what? Any person, whether is a resident or non-resident, if he transfers assets located in India, so I am breaking it down, that's all. Any person is a resident or non-resident who transfers assets located in India to any other person who is a resident or non-resident, income is deemed to accrue or arise in India. So you would have heard the term deemed to accrue or arise in India. What do you mean by that? Any person who is a resident or non-resident, where they have made a transfer of what? Any asset which is located where? In India, to any person where? Who is a resident or non-resident. Income is deemed to accrue or arise in India, even if the transfer took place outside India. Even if the transfer took place outside India, I don't care. Asset must be located in India. Now you only tell me, one foreigner is in USA, other foreigner is in Canada. He transfers as Infosys shares and gets the money in USA. Is it deemed to accrue or arise in India? Yes. Why? Shares are India. That is what you need to look at. That's why we told an exemption we gave. Rupee denominated bonds by transfer from one person in outside India to another person outside India is exempt. Only sole reason was I just wanted them to invest money in India, that's it. Except rupee denominated bonds, then everything else. Yeah, and government securities. Government securities is good. No, it's my government securities of government companies only I am selling anyway. So good, you invest. Apart from that, everything else is taxable. Now where will it be taxed? As per the rules of that country, it may be taxed there also, but it's definitely taxed in India. That's why you need to look at the double taxation avoidance agreements to understand. Rule number 2, shares, debentures or bonds of a company should be located at a place where the registered office of a company is situated. Obviously India. So any Indian shares, anything Indian company, you do wherever you want the dealing, I don't care. Since the asset is located in India, you will have to pay. It is deemed to accrue or arise in India, hence you will have to pay tax. So in the non-resident taxation, especially shares, the simple rule is this only: where are the assets located? And once you sell or buy shares, first proviso to section 48 will come. TTBR, TTSR, all that you have to do. But this will not apply to ADR and GDR because the ADR, GDR assets will not be located in India. Yes or no? How does GDR work? Global Depository Assets. How do they work? Somebody from US wants to buy the GDR, right? Somebody in America wants to buy the ADR of Infosys. So the shares are actually sold to a foreign custodian bank. Or the shares are kept in a foreign custodian bank. And the foreign custodian bank will give the, depository assets. Are the assets located in India? No. Where are the shares? Foreign custodian bank. Correct? So for ADR, GDR, that first proviso will not come. Other provisions will come. We'll see that later. Anyway, so that is the general rule. Generally, I am trying to tell in the international taxation thing. Now, so basically, for non-residents, so many sections have been added, which I have already discussed. One is conversion of bonds into shares, bonds into GDR, and then second is bonds and GDR, government security, RDB, that is the rupee denominated bonds, and then IFSC. So in that rupee denominated bonds, if you buy, no problem, exempt. Anything that you do in IFSC, no problem, exempt, because IFSC, even though it's in India, it is deemed to be outside India. And since I want to make more and more people buy shares of the companies traded in IFSC, I have given exemptions. Government security, exempt. Right? Bonds and GDR. Again, 47(7)(a), bonds and GDR and conversion of bonds, all these things are exempt. Conversion of bonds into shares of that company, you already seen, exempt. Correct? So, foreign currency exchangeable bonds, all that will be not taken into account, no problem, no issues. Similarly, bonds and GDR, where non-resident will buy bonds and global depository assets, foreign currency convertible bonds, foreign currency exchangeable bonds, no issues, nothing will happen, no problem. So, these are all the things that I wanted to tell you. Basically, basic stuff. Now, as far as mutual funds are concerned, you may have equity oriented mutual funds, debt oriented mutual funds. So, what do you mean by equity oriented? We saw basically that 65% investable funds will happen where? Equity shares. Debt oriented will be government debt oriented, private debt oriented, government and private put together debt oriented, all these things. Then, as far as equity oriented fund is concerned, you may have, for example, FMCG, fast moving consumer goods equity oriented scheme, and pharma equity oriented scheme, banking, transport, so many are there. And basically here also you have the growth plan, dividend plan, growth plus dividend plan, so many things are available. Now, what will come where is what we need to see, because the next part of the discussion obviously is about the mutual funds, and of course I told you there is an amendment 50AA to discuss that. That all will come in the rates. When you do the rates, we will discuss that as well. I will come to that. Just giving you the primer of wherever we are coming to, all these things. So, first proviso already discussed here. Coming to again, capital gain on transfer of assets by non-residents. First one already discussed, guys. This is specifically only for non-residents. Everything is in one place. First one is what? First proviso to section 48 and rule 115A. No need to remember any of those things. It's fine. So, what is it? Because of the problems that they were facing, now there is no problem. It is average rate you will do and close the deal. Next, sixth proviso to section 48. Any gains arising to a non-resident on account of appreciation of rupee against a foreign currency at the time of redemption of the rupee denominated bond shall be ignored. Correct? This proviso provides relief to the non-resident investor in case foreign currency fluctuation between date of issue and date of redemption. So many benefits. If there is any appreciation in the rupee, initially it was $1.80. An appreciation in the rupee means what? $1 will be 75 or 85? Appreciation in the rupee, 75. Correct? In that case also, whatever the case may be, I will protect you. Example, suppose an Indian company issues bonds RDB, 1 lakh each. Mr. X, non-resident, applies for bond of 70 lakh on 1/1/2019 and 1/1/2019 the rate is 70 rupees. Therefore, he remitted 1 lakh to India to subscribe for these bonds. So, $1 lakh. He wanted to purchase rupee denominated bond to the tune of 70 lakh. Because that time it was 70 rupees. The bonds are redeemed at par on 2/1/21, 2 years later. But that time, $1 is how much? 63 rupees. How much will he, because of the appreciation in the rupee, he will be getting how much? 70 lakh divided by 63. How much will he be getting? 1,11,111 dollar. This redemption doesn't involve any other appreciation except the appreciation of the rupee of 7 rupees. Why the hell should he pay tax for that? That is why which proviso has come? Sixth proviso. For the people following sixth proviso, if they are buying, selling, etc., will first proviso apply? Yes, first proviso is the TTBR selling, that will apply. Appreciation portion is ignored. You see here, this proviso provides relief. In case of capital gains, first proviso shall apply, but appreciation in rupee shall be ignored. Appreciation in rupee shall be ignored. In first proviso, what was the problem? Depreciation of the rupee. Yes or no? In the first example, I took 80 rupees and it became 85 rupees, and that was the problem. Here it is reverse, appreciation. So, depreciation in the rupee also is taken care of in the first proviso. Appreciation in the rupee is ignored as per sixth proviso. See the number of benefits the non-resident fellows get, guys. That is why if you see, the foundation of our economy is the stock market, and in that the major players are foreign investors. So they will obviously check each and everything. So earlier the foreign investment was only based off through BSc, etc., because BSc was an association of person. That's why they said, boss, association of person, others are coming inside and you have an associate, convert to company. They didn't listen. That's why that corporatization and demutualization came. Anyway, so that's about it. So these are all the various points to be noted. Now let's do chilled out topics. Exemption. 100% it will come for sure. Exemptions though guarantee. Every single question you see, one exemption will be there for sure. There are some hidden points here also, we need to understand that. Because after exemptions, what will come then? Rates of tax. Rates of tax also have undergone changes, and that's it. Everything will be over, and some miscellaneous here and there, 50 AA, all those. Capital gain is very easy, guys. So yes, exemptions 54 to 54F. So along with exemptions, once we do this, we also need to move on to the other part, that is IFOS, income from other sources, to understand the gift taxation, how it will work there, and all those things. We'll go definitely. So these are normal exemptions that you will see. Apart from that, there are some other exemptions. First one, exemption for residential house property. It's only applicable for what? Individual or HF. What is the asset transferred? Residential house property. Capital gain will be short term or long term? Long term. If I sell house in India and buy a house in Singapore, will this exemption apply? Those type of questions come in the exam. Will it apply? No. If I sell a house in Singapore and buy a house in India, will it apply? If I sell a house in Singapore, buy in India, yes, see, what is the asset transferred? House property, whether in India or otherwise. Nature of capital gain, long term. Asset to be acquired to avail exemption, one residential house property in India. One residential house property in India. When should I buy? Purchase a new asset within 1 year before or 2 years after the date of transfer. Purchase new asset within 1 year before or 2 years after the date of transfer. Which transfer? My transfer. I am selling the asset, no? 1 year before only if I had bought a new asset. or when I sell this house, within 2 years I'll buy a new asset, which means I may have other money also. I may use that money to buy an asset, no problem. But I can tell that this money I use there and still get an exemption. Construction of a new asset within a period of 3 years after the date of the transfer. New asset I am buying within a period of 3 years. Construction should begin or construction should complete? Complete. Now, since it's getting constructed, I cannot invest everything now. So I should transfer it to a separate account called CGAS, Capital Gain Account Scheme. I'll come to the lock-in period in a while. So SSE to acquire eligible asset as per time limit to avail exemption. If such reinvestment is not made in the SSE by the SE before the date of furnishing the return of income, not before 31st March, before the due date of filing return, amount of the capital gain is required to be deposited in the account with CGAS. Relevant points are: deposit shall be made before filing the return of income or within the due date for furnishing the return of income, whichever is earlier. It will be made with an account notified by central government, proof of deposit you should give, and all these things. If you do not utilize it within 3 years, for example, you are either 3 years or 2 years as the case may be. I want to buy a new house, 2 years. I want to construct a new house, 3 years. Then whatever exemption you had got before will now be withdrawn, will now be taxed. It's not that I have to go back to that year and change, not like that. That time I got exemption, this time it will be taxed. It's like deemed profit of income tax. Bad debts written off 5 years ago. Today you are getting back the money, this year it's taxed, right? It's not like that JDA thing. So if you see, one more question. The father had his account in the CGAS. 3 years construction was going on. In the 3rd year, father passed away. And unfortunately, 3 years are over. We could not construct that house. Legal heir gets that money. Is it taxed in the legal heir? This is a valid doubt. Is it taxed in the legal heir? In the legal heir's name? He gets the money. Because in the will, everything will go to him. He will get it. Is it taxed? She went to CBDT. Law is silent. CBDT clarification. 1996. Individual who dies before the expiry of the stipulated period, any unutilized amount of deposit made under capital gain account scheme shall not be chargeable to tax in the hands of the legal heirs of the deceased. Maybe Nirmala auntie's relative gave something. That's why some breather. There is no chance. I am also shocked to see this. Right? It is not chargeable to tax under this section. Yeah. Now, I buy a new house within 2 years. Suddenly, I want to claim this exemption again. Can I sell again? What is the condition? Within 2 years I have to buy. Tomorrow only I will buy, then again I will sell. This is not an investment incentive or something. It is for normal middle class people like us to buy a house, sell one old house, buy one house and be happy. That's it. Or even if I want to resell it, wait for a few years. That's why there is a lock-in period. New house property shall not be transferred within 3 years from the date of its acquisition or construction. If it is transferred before the lock-in period ends, the exemption claimed earlier shall be withdrawn by reducing the cost of the asset by the amount of capital gain exempted earlier. By reducing the cost means what? I would have bought the new asset for 3 crore. I would have gotten the capital gain exemption 3 crore. So what are they saying? Here, exemption granted earlier. What is exemption granted earlier? Full 3 crore shall be reduced by the cost of asset by the amount of capital gain exempted earlier. So now, will you take the full amount into consideration? Yes. Basically, whatever that exemption you got, 3 crore minus 3 crore, that 3 crore will be knocked off. Ultimately, exemption that you got will be added back is what they are trying to tell. You will not get any exemption. So that is what it is. Then, for example, here, in capital gain 50 lakhs, cost of the new asset is just 35 lakhs. Unutilized out of the capital gain account scheme 25 lakhs. Exemption you will get how much? Either the cost of the new asset 35 lakhs or the capital gain, whichever is less, 35 lakhs you will get. But if the 10 lakhs is not utilized, in this example 10 lakhs let's say I have never utilized, because unutilized portion in CGS is 25 lakhs. So that 35 lakhs minus 25 lakhs, that is cost of the new asset minus the unutilized portion. Utilized portion, sorry. The unutilized portion will be 10 lakhs. That will be taxed. Basically what they are trying to tell is, invest whatever you want, no problem. If anything balance is left, put it in the CGAS, and that also invest in the house. If you are not investing in the house, the unutilized portion will be taxed, as simple as that. So you sell the house for 6 crore, sell the house for 3 crore, buy a house for 5 crore, no problem. But this full 3 crore minus whatever expenses, the capital gain of 2 crore assume. Capital gain of 2 crore, kindly invest in this house. If you are not investing in the house, put it in the CGAS. And then you have to invest it in the house. If you don't invest in the house, no problem, pay capital gain tax. Simple. I am not forcing you. If you please do it, then you will get exemption. Otherwise, no exemption. Simple. Yeah, whenever you don't, after 3 years. If you are kept it for construction of the house, then 3 years. You have to mention all the details there, what you are doing and all those things. We'll discuss. So, in Finance Act 2019, so they went and asked Nirmala Madam same thing, that boss, I have capital gain of 4 crore I got now. I don't want to buy one house. Unfortunately, you have said one. Even in the law, it says a. What is the problem if I invest in 2 different areas? Correct? Anna Nagar one, Nungambakkam the other area. So I want to 2 different separate areas. 2 crore each. What is your problem? That was a valid question raised, because over the years, middle class, dreams is no longer one home. It is 2. Obviously, everything will increase, right? It is 2. Spouse is one only, right? It is 2 homes. So one I will use it as an investment like Airbnb. The other one I will keep it home, no problem. And if they have 2 children, one child, then later they will again fight later. Then they will blast me only, right? So one house like that will give. Actually, that's true. That's why in Finance Act 19 they changed it. In case amount of capital gain does not exceed 2 CR. 2 CR. When they said 4 crore, they said, boss, that is wishful thinking. This is for a middle class mindset. So if the capital gain does not exceed 2 crore, the SSE may, at his option, purchase or construct 2 residential houses in India instead of 1. So capital gain, if it's 4 crore, I will not allow. Capital gain should be less than or equal to 2 crore. Then you can purchase 2. 70 lakhs in one place, 80 lakhs, no problem, take it. Can I buy 3? No. 2 homes. And this option, let's say I keep these 2 homes for 3 years. I'll sell 1 home again. Can I buy again 2 from that? No. This option is only once in a lifetime. If you break this rule, because they'll already have all the data. If you break this rule, then whatever exemption you have claimed, you will never get. The new house you would have claimed exemption, you will not get, obviously. So, once in a lifetime only. 2 homes you can buy. What is the capital gain amount? 2 CR. Now, what were rich people doing? Capital gain 15 crore, huge houses. Then they were buying 2 homes, 7.5, 7.5. That is not possible. Why? Maximum only should be 2 crore. But then they were buying 15 crore capital gain, they were investing it and again claiming exemption, keeping it for 3 years, again selling. That 15 crore would have now become 25 crore, again purchase, 20 crore gain, 20 crore again invest after every 3 years. So, the objective of section 54 only was what? Not for high net worth individuals, it was for middle class people. So, a very good important change in Finance Act 23, which you can make a note, which is applicable for November exam. Maximum deduction that can be claimed by the SEC under section 54 has been limited to 10 crore rupees only. You have a huge property of 15 crore, I don't care, boss. How much will you invest? You invest whatever you want. What is the maximum gain? I will give you 10 crore. Where the cost of the new asset exceeds 10 crore rupees, you please buy. I am not stopping you from buying, but don't claim exemption 15 crore. The amount exceeding 10 crore shall not be taken into account only for the purpose of this subsection. Yeah. Balance 5 crore taxable. No choice. So, let's say I got a gain of 15 crore from this. I am investing in a 20 crore property. Extra 5 crore I only put, no problem. So, when I am investing in that, how much will I get? Exemption 10 crore. That's all. And in this gain also, in this, how much I have sold it for? 15 crore. No, 15 minus 10. 5 crore I have to pay tax. What is the quantum of exemption? The cost of new residential house or capital gain, obviously whichever is lower. Capital gain is 2 crore, cost of house is 3 crore, so 2 crore. Capital gain is 2 crore, cost of house is 1 crore only, then 1 crore. You should be smart enough to ensure that whatever you gained, you will invest it in a new house. That is what they say. So, here, Mr. Raj sells a residential house property, date of transfer. And the day you transfer here, 1 year before or 2 years after, buy one more residential property or construct 3 years after one more residential property. 1 year before or 2 years after, purchase a residential property or construct within 3 years residential property. There was a valid doubt. Can I start construction before selling this house? That construction is completion or starting? Completion. So, here they are telling purchase 1 year before. You can't construct 1 year before, but they say start the construction, but it should be completed within 3 years. It is invested in residential house property or deposited into the CGS account, lock-in period 3 years, should be utilized only for what? Residential house property. And you should do it before due date of filing the return. If you don't do it, if it is not utilized as per the time, it is withdrawn, and exemption whatever granted will be no longer available. What is the exemption? Capital gain amount, cost of new asset or deposit amount, whichever is less. That is one. 54B, this we can go quickly. This is what, guys? Urban agricultural land. Urban agricultural land, which means what? Which is within that radius, 2 kilometers, 6 kilometers, that one, urban agricultural land. So, here urban agricultural land should be owned, no, used for agricultural purposes. It must have been used in the 2 years immediately preceding the date of agricultural land. Nature of capital gain, short term and long term. For land, what is the period of holding? 2 years. Individual or used by his parents also or HF. You should purchase one more what? Urban or rural agricultural land. Sell one agricultural land, buy one more urban or rural agricultural land. Purchase a new asset within 2 years after the date of transfer. What should you acquire? One more urban or rural agricultural land within 2 years. And you should lock in for 3 years. It shall not be transferred. My one question to you is this wrong? It says you should use it for 2 years immediately preceding the date of transfer. If I use it for minimum 2 years or more than 2 years, when I sell it, it obviously will be long term, right? Can there ever be a short term capital gain? How? By whom? Previous owner, is it given there? No. Why? See, either by that fellow only, individual. It doesn't say by any individual, by that individual. Gift, okay. Partner, HF, no. Okay, that also is, I agree, fine. But what is the actual? Everyone will not do those things. Generally, land, how they acquire is first they'll take it on lease. They'll use it for a few years and then they will buy. So my parents took it out on lease. They've been using it for 10 years. Then I see the land, it's almost like mine only. Why not buy it? So I buy it 1 year ago. Then I'll sell it now. Can I sell it? Yes. That is why they have used, it's not owned, it is used. So the parents or you had taken it on lease and used it for 3-4 years, and today, yesterday only you bought it, today only can you sell it? Yes. That is why short term or long term capital gain. But you want to buy one more what? Urban or rural agricultural land. What's the lock in period? 3 years. Let's say I sold an urban agricultural land and bought a rural agricultural land. Sold and made a gain of 2 CR and bought a 2 CR agricultural land, rural agricultural land. Lock in period 3 years. But next year only I sold that, and because airport was coming in that area, I got an opportunity, the land rate boomed to 4 crore, I sold that land. Will 2 crore be capital gain? No. I sold a urban agricultural land, bought a rural agricultural land. Lock in period is 3 years, but next year only I sold it for 4 crore, made a 2 crore profit. What do you think? Is it capital gain? Lock in period I didn't follow. What I am saying is lock in period I didn't follow. My exemption allowed was 2 crore. See, what is that? I sold an urban agricultural land, got 2 crore capital gain. At capital gain, I invested in rural agricultural land. That is this exemption, I have got 2 crore exemption. Now, this rural agricultural land of 2 crore, I sold at 4 crore. That first 2 crore exemption, will it be taxed? Yeah, that's the answer. Rural agricultural land is not a capital asset only, no. So will that lock-in period apply to that rural agricultural land? No, deadly point, right? So what am I buying? Urban or rural? Rural, if I sell it, it says new asset shall not be transferred within 3 years. New asset means what? New capital asset. Rural agricultural land is not a capital asset only, no. So this section is kind of useless. If I actually sell a urban agricultural land and buy a rural agricultural land and then sell that rural agricultural land, next day only I can sell, no problem. I can claim the exemption also under 54B and enjoy the benefits of sale of agricultural land. Tax planning. Similar provision, same thing. So 54 is residential house property. Urban agricultural land 54B. Compulsory acquisition of industrial land and building 54D. In the question, they will never ask you that this section will be applicable. You only need to figure it out. This is what? Similar to urban agriculture, but is land or building used as part of the industrial undertaking. Here it is compulsory acquisition only. Should have used it for 2 years. So, we will see the chart directly. So, you are a company, whatever, and you have, basically it is applicable to all SSEs. In this example, you are a company. Compulsory acquisition of industrial undertaking has happened, which has been used for industrial purposes for 2 years, and this you are selling. You are selling this, it's invested in the industrial land or building again, or deposited in the scheme. It is compulsorily acquired, by the way. So, you should buy one more industrial land and building 2 years before or 3 years after the completion, then you will get the exemption. Everything is the same, but in one small change is what? Compulsory acquisition. Question is, 3 years after compulsory acquisition or 3 years after receipt of compensation, you should buy a new agricultural land, a new industrial land 3 years after acquisition or 3 years after compensation. Obviously compensation, which means it will never be 3 years. They will give 4 years later. So, 4 plus 3, 7 years time I have. Which one? Yes, correct. Compensation receipt is, as we have already seen today, initial compensation, first installment. (54EC) we saw in one of the questions in PGBP. This is selling a land and or building or both, which is a long term capital gain, and purchasing these bonds. Rural Electrification Corporation, National Highway Authority, PF, Power Finance Corporation, Indian Railway Finance Corporation, all these things, or any other bond notified by the central government. Specified bonds, which are government bonds, which are redeemable after 5 years, issued on or after 1/4/2018, and issued by these things: Rural Electrification Corporation, National Highway Authority of India, Power Finance Corporation, Indian Railway Finance Corporation, or any other bond notified by the CG. So, what is the asset which is transferred? Immovable property, land or building or both. What is the nature of capital gain on asset transfer? Long term capital gain. Rural Electrification Corporation, National Highway Authority, Power Finance, Indian Railway Finance Corporation, all these things you should take. When should you buy? Within 6 months from the date of transfer. Amount of investment in the specified bonds or capital gain, whichever is lower. So, what people used to do, that is, what is the amount? 50 lakhs. The maximum amount of investment in bonds cannot exceed 50 lakhs. So, people were investing 50 lakhs in rural electrification, 50 lakhs in National Highway Authority, 50 lakhs in Power Finance Corporation. Then they said, no, that is not what I meant. They said it is all bonds put together. There was a case doing everywhere. You said what? Okay, maximum 50 lakh in bond. Okay, in each bond I will put 50 lakhs. That's why in one of the questions, you remember, it was there, no, 50 lakh twice they had done. So, we told 150 lakh is not to be covered because of this. It was there in PGBP, remember. Yeah, so it is like that, 50 lakhs overall put together, not per bond. Which one? No, you sell the asset, whatever it is, whatever you sell, overall 50 lakhs, that's it. You can do it for asset, no problem. You sold asset A and you invested in bonds. You sold some other asset, invested in bonds, no problem. SSE cannot transfer or convert into money or avail loan or advance whatever within a period of 5. There is a lock-in period also. Lock-in period of those bonds is how many years? 5 years. So these bonds, if it is linked to ATC also, ATC you will not get because 54 EC already got. So simple. All SC immovable property, proceeds of capital invested in government bonds, maximum 50 lakhs, 6 months after, same. Bonds cannot be transferred for 5 years. If transferred, capital gain exemption is withdrawn. 54 EE is irrelevant now because these are the units which are issued before 1/4/2019. So it's kind of immaterial. Same only 50 lakhs separately it's given only for those units. So here the lock-in period is 3 years that you can ignore. 54F. Exemption for any long-term capital asset. In 54 it was selling a house, buying a house. 54F is selling other than a house but still buying a house in India. 54 is selling a house, buying house. Here selling other than house but buying a house. Can I buy 2 homes here in 54F? No. That is only in 54. Second change. Can I buy 1 house worth 15 crore? And the capital gain, can I use 15 crore? Or that restriction is only in 54? No, here also restriction is there. So that 10 crore restriction is in 2 places, guys. That's an amendment in Finance Act 23. 10 crore amendment is in 2 places, 54 and 54F. 2 homes thing, it is not available here. Only 1. 54 you can buy 2, provided your gain is less than 2 crore. So that is Finance Act 23 amendment. They have not asked actually. So individual or HF, long-term capital asset, not being a residential home like gold, anything. Shares, can sell shares also and buy house. Nature of capital asset on asset transfer, long-term capital gain. Asset to be acquired to avail exemption, 1 residential house property in India. Same, 1 year before, 2 years after, 3 years. Here, a very, very interesting thing. In 54, capital gain is exempt. Here, it is depending on the net consideration. If the net consideration is fully utilized for new asset, then capital gain is fully exempt. If net consideration is partly utilized, then capital gain will be exempt proportionately. Capital gain is 50 lakh and the net consideration is 90 lakh and fully utilized for the new asset, then full capital gain is exempt. Capital gain is 50 lakh, net consideration is 90 lakh, but only 70 lakh is used. So for 90 lakh, 70 lakh, 50 lakh is the capital gain. For 70 lakh, how much? 50 into 70 by 90, only 38.8 lakh will be granted. That is a big change between 54 and 54B. Then SSE, lock-in period, same. Now in this, if I already have 2 homes under 54, can I buy a 3rd home here? Different section, no? There I already have 2 homes, that is locked in. Now I sold some gold or some shares. Can I buy 1 more? See here, SSE should not own more than 1 residential house other than the new asset on the date of the transfer. Means what? You can have one other than this asset. This is your new asset on the date of the transfer. Correct? So you cannot own more than one house. You can have one other house. So under 54, if you have already bought two new assets, can you buy one more house here under 54B? No. Yeah, it is not 54B, sorry, 54F. Is it possible? No. So should not own more than one residential house other than the new asset on the date of transfer. Then as again, obviously you cannot buy one more. Does not purchase or construct anything other than the new asset which I have bought. This is the new asset which I have bought. This asset I can have, one extra house I can have, that's it. So there if I have already bought two in 54, here I cannot buy the third one. Violation, same thing. Say maximum deduction that can be claimed 10 crore. Done. So one more guys, 54G. We'll finish off. Two more are there quickly, 5 minutes. Exemption for land, building, plant and machinery while industry transfer from urban area to rural area. What is this? These two are specifically for final actually. All SSEs, land, building, plant and machinery, rights in land used for industrial area in an urban area. Now I am selling that in the urban area and buying it in a rural area. It's an exemption given because near the city it's getting crowded. So you sell off everything, go near the rural area and buy the same thing, exemption given. New asset to be procured within 1 year before or 3 years after the date of transfer. What is the quantum of exemption? Amount of shifting expenses plus cost of new assets or amount of capital gain, whichever is less, whatever it is, no problem. Shifting expense also will be there, cost of new asset also will be there, or the entire gain, whichever is less. Same lock-in period 3 years. Other condition same as 54. Last part. Exemption for land, building, plant and machinery while industry transfer from urban to any not rural area, special economic zone. Everything is the same, but here it's not rural area, special economic zone, same, everything same. All these are the same. 10 crore limit is not there here. 10 crore only two places. Only for two things. I am talking about CGAS is same as 54. Other things are not there. Cool guys. So in the next class tomorrow we will be finishing off capital gain, finishing off IFOS as well. IFOS also has very interesting scenarios of gift taxation, deemed dividend, 222, ABCD, all that will come in the exam. And of course we'll start off with assessment procedure, we'll do the other smaller things, we'll see, we'll do something. Hi guys, good morning. How are you all? All good? Okay. So in the yesterday's session we were discussing capital gains. Today we'll finish it off, and then interlinking thing would be the income from other sources. So we'll finish that also and then see what else can we do. Maybe we can start off with other areas. Yeah. So, and of course a couple of other questions are there with respect to the shares. So today important areas would be the taxation part. So as we discussed yesterday, we had to understand what is a capital asset, which we did. We had to understand what is a transfer, which we did. We had to understand what is not a transfer, that also we did. And also we have to understand the period of holding. So for different things we had different periods of holding, we discussed that. And also what is pending is the rates. and especially for non-residents, certain special areas in terms of capital gains, and also some miscellaneous items like, for example, in capital asset, what is not a capital asset we are discussing. That first one was, what is not a capital asset? First one, stock in trade. And then personal effects was also not a capital asset. And then we saw your, rural agricultural land. Then we saw for the foreign institutional investors, that is also not a capital asset. Fourth one was the ULIP that we have not discussed. So we have to discuss the ULIP portion as well. In fact, in the RTP May 24 or something, that inserted a few points, and even for November 24 they have put the same points. So it's not in the material but in the RTP, but I'll put it up on the screen and then we can discuss a little bit of that ULIP. In the new material I've added, obviously. So the thing is, Institute keeps coming up with new stuff, new illustrations, etc. So we need to keep all the updates ready. So yeah, anyway, thing is, every 3-4 months the material will change. It's very dynamic. That's how it is. Especially income tax and IDT, nothing can be done. Nirmala madam will get up one day and like, today let's change something, right? Then she'll call a GST council meeting and everything will change. So that's how it is. Anyway, so, and then of course we understood the exemptions. Regarding non-resident, we'll take up special points in a while. We'll also discuss some tough MCQs, what MCQs could come and all that. As you see, the material is designed in such a way that as and when we are doing only, we are solving problems in terms of, adjustments. So ultimately there's no point in solving a full-fledged problem, which we are doing anyway. What I'm saying is, if you know the adjustments, then you can solve the problem. So that's how we've been trying to understand and solve the entire thing. Yeah. So now we did the exemptions part, but there are certain interesting areas in the exemptions which I did not want to touch upon yesterday, because with a fresh mind it will be always better. So we will see here. So in my book it's C57, yours will be here and there. This is the, after all the exemptions are over, there are certain general notes on exemptions. These are all the important adjustments that have come in the exam. So these are nothing but adjustments in the exam, MCQ adjustments or full-fledged problem adjustments, exam adjustments. So I have designed my material in such a way that all the adjustments are part of the notes, so that it will be easier for you to understand, which you saw also while solving PGBP. Whatever we have written as adjustments has come in the exam. Yes. Now, there was a question in 54 and 54F. It is one more residential house property. Is it a flat, or what about the land portion also? Like if I buy a land and then I will construct, I should construct within 3 years, right? Can I buy a land also, and is it allowed, or is it only building? That was a valid doubt, because if my gain from the previous thing is around 3 crore, can I buy land of 2 crore and then construct for 1 crore? Or that was a general, or can I buy land and keep and then later construct within 3 years? Yes. So if you see, yes, the land acquired by the SC also will be eligible, first point. Then, as already discussed yesterday, date of commencement of the construction is not at all relevant. However, such construction shall be completed within 3 years from the date of transfer. Online people, good morning, are you there? Right. So, however, such construction shall be complete within 3 years from the date of transfer, and expenditure incurred for construction before the date of transfer becomes eligible for exemption. Option of investment in 2 residential houses subject to certain conditions applies only to 54 and not 54F, already discussed. That's why these are exam adjustments, like a revision, and some new points also will be there. To claim exemption under 54, purchase of residential house, that is one thing. You should purchase within how many years? 1 year before or 2 years after? When I say purchase, is it possession? Is it ownership? Or is it you have to pay some amount? Possession and sale price. Now, one more thing I want to address here. On, let us say, June 2020, I entered into an agreement for sale for a property worth 2 CR, and I paid 10 lakh rupees through check. Down payment I made. In 2022, I took over the possession. In 2024, it got registered. Possession also, let's say I would have paid some 1 crore by now. Registration 2 crore I paid and got it registered. We were discussing when is the transfer happening. Ideally speaking, registration date. But then we saw Transfer of Property Act, part performance of the contract. If you have paid something, then yes. Now for the cost of acquisition, guys, that you know, this is the day when the transfer happens as per the Transfer of Property Act. SDV of this property, this is the consideration overall. SDV was 2.1 crore. Here SDV will obviously change, right? 2 years later, 3 crore. By the time it got registered, 3.5 crore. What will be my FVOC? When is the transfer? Okay, first of all, legally when is it transferred? 2024. For capital gain purposes, read with Transfer of Property Act, when is it transferred? 2022. Next, my question is for FVOC, what will I take? That dialogue is there, no? SDV must be, if it is greater than how much? 110% of consideration, then SDV will become the FVOC. So if you see the first one, June 2020, 2 crore means 2.1 crore is less than 10% because 10% is 2.2 crore. But in 2022, it becomes 3 crore. And in 2024, it's 3.5 crore. So what will be my full value of consideration for the person who is selling this house to me? Person who is selling this house, he should write the FVOC, no? So when he is writing the FVOC, full value of consideration, what will he take? Because that will be, is it 3 crore, 3.5 crore or 2.1? And even for me, I am purchasing this house. Tomorrow I want to sell it. What will be my cost of acquisition? 3 crore. This was a doubt raised, which went to court. He said, sir, I have already paid in the agreement for sale. There is a promise that I will pay and I have paid the money and that too through check. The reason I paid it is I wanted to fix that SDV because I know it will change. And in India, you know, construction, they'll promise 2 years, it will take minimum 5 years. They'll promise, right? One of my clients, he bought one house in 2020. They promised in 2021. Today, till today also, it's not been delivered. It's a normal thing. 3 years, 4 years, normal. Yesterday afternoon also, I was talking to him in the lunch break. So he was with a conference call with the builder. Builder always tells stories. Builder is amazing. If you want any script, etc., you can go to the builder and sit. Superb stories he will tell. I am in front of the office only, sir. I can do video call if you want. All that they'll tell. So anyway, so now my question is, for income tax purposes, what would be the SDV that I should take? Because if you say registration date, then my FVOC for the seller will be 3.5 crore. And for the buyer also obviously 3.5 crore cost of acquisition, because on the balance amount he'll have to pay 56,210 gift taxation, which we'll do today. Tell me guys. So this went to court. Court said the reason why you are paying in June 2020 is to ensure that you will pay that, you will buy that house anyway. When it gets cancelled, that will be advance money forfeited. But when you have paid an advance already, with that too not by cash but by check, which means that you have that 100% motive to buy. So they said, if you have paid during the agreement for sale only an amount by check, this SDV only can be taken. Consider the SDV as on the date of agreement for sale, which means consideration and SDV. Is SDV more than 110% of consideration? No. So what will be the FVOC? 2 crore. Got it? So even though in that year in which I am actually buying, it is 3.5 crore, what is the SDV that I should take? I mean, SDV is 2.1 crore. What is the consideration of FVOC? 2 crore. Understood? This is the logic. So 3 things we discussed. When is the transfer happening? Legally 2024. But when is the transfer happening as per Transfer of Property Act and along with capital gain for capital gain purposes? 2022. What is the SDV? Where is the SDV flowing from? It is flowing from the day you pay some amount at least, but it has to be not through cash, but through banking channel. That same 40A3 thing. NEFT, UPI, what is that? Cross check or bearer check or which check? Account pay check, right? Same dialogue, same conditions. Then you will have to do that. Now my question to you is coming to the exemption. When I say that I have to purchase a house within 1 year before or 2 years after, what do you mean by purchase? Possession, registration, or giving this check of 10 lakhs? Possession plus? Yes. So if you see, to claim exemption under 54, purchase of residential house coupled with possession is a precondition. Registration is not needed. Same Transfer of Property Act. These are all exam adjustments. They can, for all you know, merge this and give. They can merge these two and give a question. They can say FVOC is dash and the purchase is completed dash. Two options. Correct? So when is the purchase completed? 2022. Which means within 2 years of buying you should purchase means 2 years of selling you should purchase means when? By 22. That 2 years should be 22. This one. Which one? What claim amount? Whatever your capital gain. So your capital gain, if you have invested fully, then that amount is what is claimed. I sold an old house. I got 3 crore. I have invested 2 crore in this. Okay. So what will be the claim amount? In 2022, have you taken the possession? Yes. So what will be the claim amount here? Whatever you have invested. What have you invested here? 1.1. Only that much only you can claim. If you want to claim the full amount, you should do what? Buy the entire thing. That you should pay full 2 crore on the date of possession. So and on the date of possession, whatever you have purchased, that only will be the claim amount. Which means they are trying to tell when you are possessing the property, pay the full amount. That's how everybody does, guys. Once then they give you an occupancy certificate, then only you will first, no builder will allow possession without payment, first of all. But there are some builders who do. My client, that builder, he actually is agreeing to give possession because he only delayed it. He's like, okay, sir, lift is not there, sir, you please come and start staying, no problem. Later we'll see registration. He is agreeing. So some builders do, but majority, main big builders and all, they'll say, no way. You pay the full amount, register, and only then possession. So that's why by that time you would have paid the full amount. So in this example, whatever I have taken, what is the exemption amount? 1.1. Clear? Yes. Now if I, if I want to buy a flat in a society, I already told you, can you buy the house or should you buy the shares of a cooperative society? So when I say 1 year before or 2 years after, I need to purchase a house property. Purchasing the house property is purchasing the house or purchasing the shares? If I am in a cooperative society, purchasing the house or shares? Shares. That is the next point. Check it out. Release of shares in house property by co-owners in favor of the SSE tantamounts to acquisition of house property by the SSE. So I sell an old house, buy a new house. Should I live in that? It says residential house property. Does it say self-occupied? Nothing. So next point. See, all these are exam adjustments because they are actually basic points, but in the exam there is full confusion. Did it say self-occupied residential property? Did it say residential property used for his residence? All that confusion will come. So all these are exam adjustments I have taken and made it into a set of notes. That's all. Now what many people do, even in my apartment, there is one fellow who has bought 2 units for this separate agreement, Then he has demolished this wall and made it into one full unit. You would have seen two houses they'll buy, 2 different units it is. They'll club and they'll buy. So if I had, let us say, old house I sold for 2 crore and I actually am buying one house only, but Here I am buying 2 units and merging and making into one house. Is it considered one house or 2 homes? Anyway, you can say 2 homes you can anyway buy, that you leave. That let's say that point was not there. If your thing is how much less than 2 crore capital gain, you can buy 2 homes is what we have seen. But forget about that point. Is it 2 homes or 1 home? Dwelling unit is 1 only. It's just that I bought as per the apartment fellow, he gave 2 homes. But I've already clearly told, sir, I want 1 house only, but I know you don't have that space, so I'll demolish and make one big space for me. 1000 square feet, 1000 square feet, 2000 square feet I'll make. So is it 1 house or 2 homes? Kitchens, okay. So this went to court again as usual. They said this point, see. 2 flats acquired by C which are adjacent to each other can be considered as a single house for the purpose of exemption under 54F, even if it is purchased under 2 separate deeds. There will definitely be 2 separate deeds because as per the builder, it's 2 homes. But for your purpose, what is your purpose? To buy one, make it into one. So ultimately, their benefit was given to the SSE. Considering this only, like these cases only, they said, okay, I'll allow you 2 homes. But anyway, you can buy now. But either way, now if I have 4 crore capital gain, can I actually buy 2 houses, one next to each other and make it into one house? Yes. Yeah, that can be 2 houses there. You can do that, yes. So where my parents are staying now, there one fellow has bought like that only, 4 homes. Each house only is 3500 square feet. Think about it, into 4. And that's a duplex apartment. So 3500 square feet into 4. And only one fellow is living. Right, crazy. But yeah, there are people like that. In case building which is constructed for the sake of convenience, it may consist of several units and could be capable of being converted into one residence as and when required for the purpose of claiming exemption. Yes, an entire building can be converted into one residence. Now this building, for example, assume this is actually a residential area only, right? So this is now used as a classroom, but assume, can I make this an entire house? Yes. There are 3 floors. Can I make it into 3 floors? Yes. Can 3 different families stay? Yes. Or can one family only stay in 3 floors? Yes. That's what they're trying to tell. Ultimately, we should see the use, what you are using it for. What people, assessing officers were doing it is, you should deposit that CGAS account when? Before due date. Many people were slightly delaying by 1 day, 2 days, etc. because of which the AO was not giving the exemption. He's telling, sir, sorry, there was a problem. I went to the bank, they didn't open. SBI and all is very famous. They'll not open. During COVID, the FCRA norms had come, no, Foreign Contribution Regulation Act, where they told any money coming into India has to be opened in SBI. That to Delhi. SBI doesn't even work on normal days. Imagine this is COVID time. And account opening, they took 1.5, 2 months and all those things. So like that, if CGAS account opening only, it was got stuck. And because of that 1 or 2 days delay, and AO was disregarding it. He said, sir, actually I want to buy a house only. See, I have already did, everything is ready. Went to court, court said, boss, don't be so harsh on the SSEs. Correct? This intention only is for the middle class people. Sometimes delay here and there will happen. Okay, if it's a 10-month delay, that I understand. 3-4 delay, 1 week delay, let go. Right? So you see, next point. Deposit of capital gain as per scheme is a procedural requirement. Your exemption doesn't depend on the procedure. Here and there delay allowed, no problem. So in Delhi, these things happen where one area will be there, of which 1 floor will be constructed already since your father's time. Now you will sell one small other house was there, you sell that house and you construct like 2 more stories on top of your house only. Is it considered to be new house and can you get exemption, or is it the same house? This was a Delhi case law, because in Delhi it's like that only. You have various vihars, Preet Vihar, Gayatri Vihar, that Vihar, all areas, and there is no wall in between. It's like two buildings are touching each other. Crazy it is. I was also shocked. I had never seen anything like that until I went there. So then every person has some 5 floors, 6 floors. So there the JV is such that the builder will come to you and say, boss, your house only 3 floors I'll build. Last floor you give it to me. Other 2 is for you only. I will only do the full construction, don't worry. So that your JD will come. But here on the other hand, if I only want to build, I have one more house, I'll sell it, I'll build 2 brand new floors on top. Is it considered to be one more house? Delhi High Court case law. Yes, it is allowed. The next one. All exam adjustments. Where a residential house is sold and the capital gain is invested in constructing the first floor of another residential house already owned by the SSE, exemption can be availed. Extension of existing house is also permitted. So it says construction should be completed within 3 years. But in India, as I told you, builders take their own sweet time. Everything is ready. He took 5 years to construct, but I've already paid him the money. He's not constructing. Is it allowed? Yes. Exemption cannot be denied merely on the ground that construction was not at all completed. If there is a delay on part of the builder, which is not in the control of the SSE, exemption shall not be denied. So, one more doubt was, I have to invest in a new house. Somebody took a loan and then invested in that new house, but the money that he got from capital gain, he invested in share market. So, when the assessing officer asked him, show me where you have sold this house, show me where this proceeds you have invested in the new house. He said, no sir, this proceeds I have invested in the stock market, sir. But to invest in the house, I have taken a loan, bank loan. I didn't want to put this money, but he still claimed exemption. Allowed or not? Allowed or not? What do you think? Like for example, he made a gain of 2 crore. He had already taken a loan of 1 crore, which is already given to the house. So in extra 1 crore, he put it in capital gain account scheme. The remaining 1 crore, which he already had taken a loan anyway, this 1 crore he put it in the share market, invested, did whatever he wanted, went on a trip. But he claimed exemption 2 crore. Allowed, right? Yes. Why? Because it says purchase 1 year before. How will you purchase if you don't have the money? When law only is giving you an option to purchase 1 year before without getting 1 rupee money from this, should it be a one-on-one correlation? This money only should be invested there? No. The amount should be invested. It need not be that same source. So this also is a case law. Check next point. It is not necessary that sale consideration should be utilized for the purpose of investment. As per 54-54F, SC has an option to invest in new asset 1 year before the transfer, which anyway could not have done with the sale consideration alone. Hence, borrowed money is also allowed. Yesterday, somebody asked me, can I put in 54 and balance amount, can I put in 54 EC? Yeah, why not? From one source, can I have 2 different exemptions? 100% allowed. So, I said the investment in 54 EC should be done within 6 months. 6 months should be the date of issue of the bonds or date of investment. That also was one doubt. Because I invested in at the end of 6 months, but they issued it to me at the end of 7th month. Issue is investment or issue. When I say I have to invest within 6 months, is it where I have deposited in the bonds or where I should get the bonds? Deposit, yes, you're right. There are some bunch of 5-6 bonds that we have seen. In that one bond they have not issued only yet. They tell that the next bond will come 7 months later. I want to invest only in the rural electrification bonds, but the rural electrification bonds have not yet been issued. Old issues have stopped. They have told new issue in only 7 months. But other bonds are allowed. Other bonds are available. So am I forced to buy other bonds, or can I wait for this for 7 months and then invest? See, so many cases, guys. It said bond 1 or bond 2 or bond 3 or bond 4. 2, 3, 4, 5 is available readily. Rural electrification bonds, government has stopped it temporarily because every 6 months they come out with new issues. They'll say the next issue is 7 months later. So I am like, I want to invest in that only. I don't want other bonds. So can I still get an exemption after 7 months? Is it in my control? I am ready to invest now, no? So it is based on ready to invest, not actual investment. Next point. All these are cases. So there was something called as the, they had taken away the land compulsory acquisition, and then I invoked the provisions of the Land Acquisition Act and sat with the other person, government, etc., and asked for more compensation on all those things. So ultimately I got compensation which is higher than what I deserved. I still claimed the exemption under 54D and all those things. They are telling this is no longer a compulsory acquisition because you got way more than the market value because you negotiated on it. It's like an actual sale. The assessing officer did not grant him the exemption because he changed the character from compulsory acquisition to actual sale. What do you think? Just because you invoked an act and got extra money which you anyway would have deserved, does it take away the character of the acquisition? No. It is still compulsory acquisition. Next point. One more thing which we have seen in 54 EC and all those things, that the SSE has to invest in the bonds. Should it be in his own name or can he do in the name of his daughters, wife, or in his own name? That was one more doubt. This guy did it in the name of the daughters. Assessing officer said not allowed. He's telling, boss, it's my money only and they are my daughters. So I want to do it in their name. Who are you to tell? The exemption is only for investment. Nowhere there is investment in my own name. Went to court, he won. Except 54B. 54B, it is allowed only if the new asset is purchased in the name of the SSE himself. Generally relatives, any name you can't, that will become Benami. That is not allowed under income tax anyway. It is not allowed under Benami prohibition of Benami Transactions Act, which will eventually lead to Black Money Act, and eventually it will come back to Income Tax Act. So anyway, you can't do that. Because there is a link now between prohibition of Benami Transaction. Benami Transaction Act was like a toothless tiger till 2016. It was a 1970s, 80s law only. No one cared about it. 2016, after demonetization, they changed that law and added wonderful provisions. See, all this a CA should study, which was there in as part of your law. Everything removed. It's shocking. All this a CA has to study. A CA has to know in depth of Benami and all those things. Black money, little bit they've added, but anyway, in income tax they've added, but yeah, these things are very, very important. Yes. One second. (54D), yeah. Second. No, it is 54B because it's that agricultural land point. Because you know why? This agricultural land, no, issue is I have using it right as an individual, and if I buy an agricultural land, in agricultural land also what is there are various points which, what has it given here? It should be B or D is given. No, it's B because agricultural land, I'll tell you why it is, because agricultural land is allotted based on unfortunately in India based on caste. You also know it. There are certain agricultural lands that are allotted only to OBC, SC, ST and stuff like that. So you cannot touch those lands. what people were doing is, it happened in Karnataka especially, where there are in the fringe areas of the forest, where they had bought these areas are only allowed to a community called Kuruba. Kuruba are the ones who actually lived in the forest many years ago. So for them only it is allowed. What these fellows were doing, they were selling some asset. I don't want the exemption, but anyway, I wanted the exemption. I can put it in somebody else's name, no? So they made these Kurubas only some relatives that are happening, and they said it is my land only at the end of the day. So the thing is, they were claiming exemptions, but they were using it in whose name? In the this Kuruba's name. So the thing is, there are in India, especially agricultural land, it has to be it is unfortunately can be allotted only if you are from a particular community in certain areas, particular caste, creed, etc. So that's the reason why they have entitled that. It's not D, it's B, because D, if you see guys, is D allowed to all SSEs? See D. D, is it for all SSEs? Yeah, but you see B here, it's only for these two. So D, ultimately it will be in the name of your company, even if it's a company, for example, right, in the SSE. But here in B, as I told you, agricultural land, that is the issue with agricultural land. So that is what it comes there. That's the logic actually, why B is there. Is exemption possible under more than one provision, guys? Yes, 100%, as discussed yesterday. Somebody asked me. Yeah, that is the answer, possible. Now that compensation I receive after 4 years, I'll have to buy a new asset in that whatever it is, from the date of when I get the compensation money, can I use it to buy, let's say, a house is compulsorily acquired because of metro construction. When should I buy a new house? 2 years. Compensation was received after 4 years. Can I buy a new house? That was also a valid question. In 54, what should I sell? House. Sell, transfer is compulsory acquisition, transfer? Yes. So my house was compulsorily acquired. They gave me the money 4 years later. But unfortunately, within 2 years, I have to buy a house. The moment I received compensation, within 2 years, I bought a house. Allowed or not? Allowed. That's the next point here. Extension of time. These are all CA final adjustments, guys. Concentrating on these adjustments. Anything can come, you never know. Now, yesterday I told you about the agricultural land, that whether it's urban or rural depends on the land records. What if I acquired a land for non-agricultural purpose, but I used it for agricultural purpose? Will I get exemption under 54B? It's an urban agricultural land, but I bought it for non-agricultural purposes, thereby changing the nature of the thing. My intention was, in an urban agricultural area, I wanted to build some 2-3 farmhouses and open like a homestay. It's already happening in Bangalore. Correct? They say weekend getaway. It will just be 20 kilometers from Bangalore. But to reach there, it will take 2 hours anyway. That's why it is weekend getaway. I'm not even joking, really. Right? Just 20 kilometers from Bangalore, they say. But to reach there, minimum 2 hours. So the thing is, right, it's actually happening. So now my question is, I used it, and it's a urban area, not rural area. Within that cantonment, within those radius, whatever it is, it's all within that only. It's definitely not rural area. Now, urban agricultural land, I used it for non-agricultural purposes. I intended to use it. Farmhouse. Let's say I did the farmhouse for 3-4 years. I didn't like it. Then I started using it for agricultural purposes. I removed all the farmhouse there and started growing crops. But I've used it for agricultural purpose for 2-3 years. Can I now sell it and claim 54B? Or it is, can I say it is used for non-agricultural purpose for a long time? There is a case law, please Savita Rani case law, Punjab, Haryana, where land sold by SSC was used for agricultural activities for a period of 2 years immediately preceding the transfer. Exemption 54B shall be granted even when such land is situated in a commercial area and was initially acquired by SSC for non-agricultural purpose. Here the usage is required, right? Exemption for urban agricultural land on compulsory acquisition. This is another thing, 1037. Voluntarily, I just told you, if a house gets compulsorily acquired and the compensation I received 4 years later, then can I invest it in another house? Yes. But can I say the same about 54B, which is acquisition of what? Urban agricultural, selling of urban agricultural land and buying one more urban or rural agricultural land. So if you see, capital gains arising to an individual or HF from the transfer of an urban agricultural land is exempt provided the following conditions are satisfied. First one, land was used for agricultural purpose for 2 years, same condition. See this dialogue. The land is compulsorily acquired. If the land is compulsorily acquired, can I go and claim 54B? No. 54B is exemption. I am saying if it's compulsorily acquired, the entire amount is exempt. What exemption you will claim? Full entire amount is only exempt. So, in case they ask compulsory acquisition of house, then can I buy 54, one more house? Yes. But if they say compulsory acquisition of urban agricultural land, will I go to 54B at all? No, it is 1037, fully exempt. Yes. Yeah, date of transfer. No, you have to use it for 2 years. Because here, the logic of this is very simple. It's that you are using it for agricultural purpose. I am taking away your main source of income, or rather your vocation, or whatever it is you are doing. That's the reason why I'll give you an exemption. Because agricultural land is a very sensitive topic in India. Right? That's why even the 54B, one more, it should be in your own name. Because even today, people are asking, please tax agricultural income. Because many farmers are there and the others are giving them a bad name. Politicians and all have huge agricultural land. So that's the reason why they have told that nothing doing. You have to use it for 2 years. 1.5 years and all if you use, not allowed. So generally, the people of a certain community or people of certain areas really know how to do business. For example, I respect Gujaratis and Marwadis for that. When it comes to business and usage of agricultural land, people from Kerala, hats off to them. I'm not even joking. They'll never buy anything. They'll go to that land, take it on lease, and grow ginger there. Ginger is such a thing; it will actually suck out the nutrients from the soil. So they'll actually absolutely make it barren for 10 years, and they'll mint money by selling ginger. And later, since the land value is fully reduced, then they'll buy that land. Very smart it is. They'll buy that land, then again make it extremely fertile and start their business. So you should understand small points from this from various people. I give a lot of opinions from people in Kerala regarding this only, agricultural land stuff only. Whether it's urban agricultural land, rural agricultural land. So I have many students in Kerala who now are chartered accountants and they are doing consulting, but they need opinions. from tax opinion, just to show that, okay, this fellow has given an opinion. So you can rely on this opinion. So there are many contentious issues. That's why we do a lot of research. So I'm saying that from different communities, I've observed the trend. So Gujaratis, Marwadis, excellent businessmen. So Kerala guys know how to use the agricultural land provisions to the best ability. That is my personal opinion, what I have seen. So very good. Right. So exemption for urban agricultural land under 54B is for transfer of such asset and not via compulsory acquisition. Compensation or consideration includes enhanced compensation also. (1037A) you can just ignore. This is something called as land pooling, where this is the Andhra Pradesh capital city land pooling scheme, whereby they took the land from one person, pooled all the land and then developed the entire city. So for that time, every step of the way you will get an exemption. So you can just go through this, it's fine. This much in depth and every single point they will not give, but ultimately they will give the benefit. You can go through these examples. Cool. So with that, we now reach the other important leg. We have done the capital asset leg, we have done the transfer leg, we have done what is not transfer leg, we have done the exemptions leg, and now the last couple of legs. Now this, and then special cases for non-residents also we have to discuss. Tax rates on capital gains, very important for November 24, because our auntie has changed everything. Correct? Drastic changes in May 25 onwards. So it is really drastic. Other things are a small change we'll ignore, but this is really drastic change. So the way and this also an assessment procedure also. So those two things, drastically she has changed the procedure itself, and here the rate itself. So whatever, I am not going to tell what the rates are, I don't care about it. We should also not care, we are writing November exam. So later we will see other things. So this is definitely a drastic change in terms of calculation, everything will change, right? So yeah. So the thing is, it's so coincidental that I finished my tax book on the day of the budget. I was very happy, it was about to send for print, thinking very small changes will be there. And madam gave bomb after bomb. So everything had to be changed. So that's why again now I was reworking. Anyway, this has the old stuff only. Yes, so that is what it is. It's fun to see the budget. Yes, so yeah, so guys, very simple. So tax rates under capital gains. So before 2004, anyway, it was like some 20% for LTCG, and for STCG it was normal slab rate. So in 2004, the Chidambaram introduced the concept called STT, Securities Transaction Tax, and he said, now all LTCG is exempt under 1038. And he created one more section for STCG 111A for the shares. He said 15%. So in 2018, as recent as 2018, they said, okay, boss, till now we have made it full long-term capital gain exempt. Now enough is enough. Let us give one little bit, tax. Let us put, and tax was imposed by Arun Jaitley 10% in excess of 1 lakh. This is again important for November 24. In excess of 1 lakh means 1 lakh was like a basic exemption limit for internal basic exemption limit for 112A long term capital gain in terms of shares, etc. Anyway, so now the issue was very simple. I mean, one important thing here to be noted is this came in 2018 budget. That's the reason I'm telling this. Suddenly he said LTCG will be charged. Suddenly he said LTCG will be charged. The budget came on 1st February 2018. And he said from 1st April 2018, the rate will be 10%. Now you only tell me, from February till February and March, 2 months, if you say that after 2 months tax will be there at 10%, we are Indians, we are like impulsive. Only the people who want to stay in the long haul, they will keep quiet. Others, impulsive. Let me sell the things now only. Oh, they'll start selling. So I have to stop that from happening. What do I do? Can I say from today nobody will sell the shares? Nobody can do that. It's a constitutional right. You can do whatever you want. So Jaitley came out with a wonderful thing. What did he say? He said that, check this, I'll show you. Change the cost of acquisition. change the 1st February budget came. So if I sold anything, correct? Very simple, guys. If I sold, he created a new section 55 to AC. So on 1st February when the budget came, I would sell all the shares between 1st February and 1st April and bring down the entire stock market. Because my cost of acquisition, I would have taken it long time back. So the thing is, I will gain huge amount I will gain. So what is the only way to curb this from happening? If I make the cost of acquisition on 1st February, if I make the cost which is up to the fair market value, correct? If I make the cost, for example, if I have a share of, let's say, which I can sell it at 10,000 rupees because the market value only is 10,000 rupees. Example I am saying. But I had bought the share when it was 1,000 rupees. The moment budget came, what will I do? Immediately I will sell the share for 10,000 and I will make a capital gain of 9,000 tax free. I have to stop you from doing it. How will I stop you from doing it? I will tell one thing. Just previous day, please take the FMB. Let's say previous day FMB was 9,990 rupees. And he will tell for all the shares that you are selling today, the cost will be whatever you are selling it for or FMB, whichever is less. What is it? 9990. So today if you are selling the shares, your capital gain will be 10 rupees. Enjoy. Instead of 9,000 rupees, the capital gain will be 10 rupees. So 10 rupees I will exempt you. Take it. Enjoy. So that is the deadliest thing he did. He inserted a section called 55 to AC, whereby he said all the cost will be now marked till one day before the budget. You read this. Cost of acquisition for the purpose of computing capital gain in respect of shares or units referred under 112A. And what is exactly 112A, by the way? 112A is these shares, guys. Equity shares. Equity oriented units and units of business trust. 112A is all these shares. Equity shares. If it's unlisted, what is it? 2 years. If it is listed, 1 year. Equity oriented units in that table, 1 year. Units of business trust, 3 years. Everything has changed now. That's why all these are important. I will not tell what is the change. Right? So basically 112A. They said up to 1 lakh exempt. Up to 1 lakh gain exempt. More than 1 lakh, 1 lakh is a basic exemption limit. Over and above 1 lakh, everything else is taxed at 10%. Will you get indexation? Will you get indexation? No, I am charging very basic amount, 10,000 rupees. So there is no indexation. But didn't he create something like an indexation only? Yes. By telling that 31/1/2018, he actually created indirect indexation. Here he told no indexation. But he created an indirect indexation by telling what? Okay, boss, today if you want to sell in the next 2 months or from now if you want to sell, I will take the cost immediately. Cost will be FMB as on yesterday. Do whatever you want. So because of that wonderful provision, he controlled the entire what? Ensured that the stock market did not fall. Nobody dared to sell because your gain will only be 10 rupees. Deadly. He was a good finance minister. Chidambaram also very smart. Arun Jaitley also very smart. Nothing against parties or anything, just the person. Nirmala madam, less said the better. Yes. Right. So nothing about that lady, but then if you have attended her sessions and all that, she is very, very arrogant lady. Extremely arrogant. That's not the way of FM should be, in my opinion. But we should, hats off to the gutsy nature. Amazing. You need to be that strong to put down people. Actually, that's very good. But if genuine questions are asked, you should not put down everything. That is what my personal opinion is. But anyway, good fun. The cost of acquisition for the purpose of computing capital gain in respect to the shares or units referred in 112A and acquired by the SSE on or before 31/1/2018 shall be higher of the following. Actual cost of acquisition of the asset, in my example, some 1,000 rupees, and lower of fair market value as on 31/1/2018. I told 9990, and full value of consideration received or receivable 10,000 I am receiving. No. So first this or this, whichever is lower, which one? This one. Then this or this, whichever is actual cost is 1000. This or this, whichever is higher, 9990. So what will be the cost? 9990. So today if you are selling at 10,000 minus 9990, 10 rupees capital gain. Who will sell? Nobody will sell. If this provision was not there, it would have been 10,000 minus 1,000, 9,000 rupees capital gain exempt. Everyone would have sold. So it's a wonderful provision. Though he told there is no indexation, indirectly introduce indexation by bringing everything up to 31/1/2018. So very simple, you should do higher of the following. Higher of the following means actual cost of acquisition of the asset and lower of FMV and FEOC. Lower of FMV and FEOC. Whatever you are selling, that same thing. So if you see, an equity share acquired on 10/1/2016 at 90 rupees. FMB is on 31/1/18, 250 rupees. And sold on 25/4/22 at 300 rupees. You can sell any time later. In this case, cost of acquisition shall be selling price 300 or FMB as on 31/1/2018, 250, whichever is less, that is 250. This has to be compared to the actual cost of acquisition, 90. So 250 is the cost of acquisition, 250 or 90, whichever is higher. Very simple. You may sell it any time after 1st April 2018. Any time you sell, automatically I have created, because the moment taxation came, I brought everything of the past till 31st/1/2018. So indirect, though I told there is no indexation, actually there is indirect indexation. Now one other thing they'll ask is, I am saying here FMB. How will I compute FMB? Right? So this is also one more thing that they can ask. When I say FMB as on 31/1/18, how will I calculate it? Is it the last traded price on 31st January? Or is it, what if it's traded both in NSE and BSE? Should I take the average? Right? So, where the capital asset is listed on 31/1/2018, FMV shall be the highest price of the capital asset quoted on such stock exchange on the said date. Highest price of the capital asset for that particular exchange. So if I am doing it in NSE, NSE is highest, that share price highest, whatever price which it fetched on that date, I should take on 31/1/2018. If there is no trading on 31/1/18, highest price traded immediately before 31/1/18. Where the capital asset is not at all listed on any recognized stock exchange, then if it is a unit which is not listed, unlisted units, net asset value. If it is a unlisted equity share, FMV shall be equal to the index cost of acquisition. Needs mention that indexation shall be done only till the financial year 2017-18. So very simple. She said do the FMV. FMV is anyway indexation. If you are unlisted, what indexation you will do? You cannot create the FMV. So what did she say? Take the cost and do indexation. Till which year? 17-18. So ultimately, Arun Jaitley eventually included indexation and simply said 10% without indexation. Indexation was automatically included in it. So example, you see, Mr. A acquired shares of Milky Limited, an unlisted company, for 7 lakhs in the year 2007-2008 only. During the previous year 21-22, Milky Limited is amalgamated with Mist Limited and Mr. A is allotted 100 shares in the amalgamated company. In the previous year 22-23, Mr. A sells all the shares for 30,000 rupees per share. FEOC is very simple, 100 into 30,000, 30 lakhs. But what is the cost? Cost as per 55 to AC. What is the cost of acquisition? 7 lakh. FMB as on 31/1/2018, I should bring it till that year. Its indexation is only till that year, mind you, after that no indexation. So 7 lakh into 272 by 129. Why? When did he purchase it? 7/8. So 7/8 is 129. And this thing, when it is 18, 17, 18 is 272. 14,75,960. FEOC 30 lakhs. So this or this, whichever is low. This or this, whichever is high. What is cost of acquisition? So what is my LTCG? 30 lakh minus 14,75,969, 15,24,031. On that 1 lakh rupees, 0%. Remaining 14,24,031, 10%. Taxation. That is what it is. Very simple. So ultimately, this 112A section is applicable only when STT is paid. For equity shares, STT is paid on acquisition and transfer, and STT is paid on transfer of your units of business trust. Units of business trust. So for units of business trust, it should be paid on transfer, whereas for equity shares, it should be paid both on acquisition and transfer. 112A is applicable only when security transaction tax is paid. And when will you get STT? Only if it is traded in the stock exchanges, predominantly, yes. So there could be cases where you will do off the market transactions, direct buyout. So for that, will 112A come? No, because STT will not be paid there. So I can go and purchase from the person directly. I can take over the company. In those cases, obviously, stock market is not, secondary market is not used, right? So basically, it is when direct buyout, etc. happens, 112A, ultimately 112A will come where? Only when STT is paid. So I will come to the other part. So this is the ultimate thing to revise. Higher of step 1 and step 2. Higher of step 1 and step 2. Step 1, cost of acquisition. Step 2, FMV as on 31/1/18 or sale value, whichever is less. Should be higher of step 1 and step 2. Indexation after 2018 not available. So even today if I am selling, I should bring the indexation, and I bought the shares in 2004 or something, I should bring the shares up to which date? 2018. For all shares purchased after 2018, no tension. Whatever purchase direct cost of acquisition is that. I cannot bring it to, I bought it only in 2020. So sale price minus purchase price, that's it, over. This will apply only when the shares are existing till 2018. Old shares. Very good provision. Now I'll ask you another question. What about bonus shares? Bonus shares, I told you, after 2014 if you remember, after 14 it was 0. Before that, okay, before 1981, not 14, before 1981, 2001, sorry, before 2001, what is it? FMV or cost, whichever is higher. I told you it was weird because that FMV portion was not changed. So if I receive any bonus shares before 2001, my cost would be, and if I am selling that today, my cost would be FMV as on that day 2001 or cost, this is nil, whichever is higher. But after that day if I have received, yeah, my question is, it was received in 2016. Today you are selling. But this is also there now, 55 to AC. Cost of acquisition or FMV as on 31/1/2018. Yes or no? This dialogue is there now. If I have, let's say, bonus shares were issued in 2016. I want to sell the bonus shares today. What will I do? Cost of acquisition 0. You are right. Step number 2, sale value, I am selling it at 10,000 rupees now. Cost was 0. FMV as on 31/1/2018 is 6,000. What will I do? And here this or this, whichever is less, 6,000. This or this, whichever is high, 6,000. So should I take that or not is the question. So for bonus, this is how it looks now, guys. There is one hidden point. Yes. Yes. Which one? So this is predominantly for equity shares which are purchased. That will not apply for bonus. 112A only if it is equity shares or units. Because in that STT, it should be paid if it is chargeable. When it's not at all chargeable, what will you pay? Right? What they are trying to tell is if it is chargeable, you should have collected it. In this, it's not chargeable only. No? It's like that 43B, otherwise allowable. If it's not allowed only, what will you do 43B? So guys, this is the final deal now. Before 1/4/2001, if I had issued bonus shares, what is the cost? Nil. FMB, whatever FMB, whichever is higher. After 1/4/2001, if it's issued, what is issued? Bonus shares. If it is relates to 112A, means equity shares or units which are listed and on which STT is paid. Because 112A only applies if STT is paid. If STT is not paid, unlisted equity shares, it will not come if STT is not paid. That's why period of holding will be 1 year only. 2 years it can't be because STT will not be paid for unlisted shares. So anyway, bonus issue after 1/4/2001 under 112A, equity shares or units which is listed on which STT is paid. What is this? Section 55. Non-112A cases, I received bonus shares on private company equity shares. Cost will be nil. So if this benefit was not available, I would have paid in my example 10,000 minus 0, 10,000. But now I will pay 10,000 minus 6,000, 4,000. Got it? Which is the bonus issue. Bonus. Regarding bonus, the FMB benefit will be available as on 31/1/2018. Makes a lot of sense. So very simple. Before 1/4/2001 different procedure, after 1/4/2001 different procedure. Before they are no longer asked now, all after. So in case they ask anything about bonus shares, we have to be very, very alert. We should take what? We should only take on our own this formula. Higher of step 1 and step 2. They will never ask anything, guys. We only should figure it out. MCQ question, we only need to figure out. It's all about application of the concepts. Income tax is one of the easiest subjects, to be very honest with you. It just requires structured studying. And my job is only to tell you this is the way to study. Rest is up to you. I know you will do it. You are smart enough to do it. It's actually easy subject. Please take out that fear in your mind. And don't tell others also it's difficult. And it's actually easy. The problem with DT, from that time I am doing or before that also, oh DT, difficult. It's that mindset it has come off. It's not actually difficult. Very easy it is. Just structured studying is needed. Yes. Correct. It's not the case where stock exchange is closed. No trade has happened. Correct. Traded day. Actually, traded. Highest price of the last traded day. Got it? That's why they have put that. So basically in 31st March, prices were in there, no one bought it. It's very rare that no one buys even one share, but if it has happened also, last traded.
So that is the case on 31 Jan. So will the increase will be taken or will last?
It should be traded. Trade will happen only when selling, buying both happens. Trade. There should be a transaction, not just a quotation. There should be a transaction. Perfect. Right. So FMB benefit is available. So automatically we should figure it out whenever they ask a question on bonus, guys. That's all. So for example, there's a Punarvas Limited in the period of holding in 3-4, starts from 3-4, cost was 10 lakh that time. On 31-1-18, it is 72 lakh. Selling price on 10-11-22, 84 lakh. So ideally, it would have been what, 84 lakh minus 10 lakh, 74 lakh windfall gains, that's it. No. So now because of this, it is 84 lakh minus 72 lakh it will be. Right? And on 12 lakh, on the first 1 lakh, nil. Remaining 11 lakh, 10%. I am keeping on stressing 1 lakh because that limit has changed in Finance Act 24. What is the limit? Let's not go, but limit has changed. It is 1 lakh rupees last time ever, November 24. So obviously there will be questions on this particular thing. One doubt I will ask you, valid doubt. It says cost or FMB, whichever is higher. Don't you think so? FMB will always be higher? Not necessarily, or it will always be higher? Not necessarily. Share prices may fall also, right? Like after COVID, so many shares of so many companies fell because they are not doing well. So it's not, that's why they said whichever is higher. So you should appreciate the lawmaker at that point of time only he thought that okay, FMB also can be lower. Kingfisher, what happened? It became some 6 rupees once, less than the face value also, never before seen. 4 rupees and all it was trading. So it can happen, that's the reason why. Not necessary is what they say. Huh. Correct. Correct. So because that is not allowed as per the provision. So that's the reason why, because they don't want anything of that sort to happen. That's why they are going to protect everybody, everybody's interest. You're right. That's the impact. Now, as I told you guys, calculation of FMV as on 31-1-2018, if it's a listed share or units, highest price quoted on 31-1-2018 for trading. Unlisted, for units you should take the NAV, and for other shares you should do what? The indexation. Indexation has to be done. Question number 10, guys. Solve question number 10. Page 54. Try to keep different types of questions so that yeah. That's not there. You can delete that. They have deleted that. Sunset clause happened. Question 10. GB2 is still there, that we'll discuss in startup. I think that question is on GB2. GB1, GB2, 2 are there. I think that is GB2 related. We'll discuss that. Comes in the startup taxation. Other concepts also sometimes will be linked. For example, 115F is one more section for non-resident exemption. That also we will discuss now only after this, because related to shares anyway. So guys, first one is what? It is a listed company. Listed, no? Yes. Second one is what? Equity oriented funds. So for equity oriented funds and business trust, what should I do? The net asset value or that indexation until that date you should take. Otherwise, highest traded, highest price quoted rather. So first one, Mr. Prasoon purchased 300 shares in A Limited on 25/17 at a cost of 400 per share. Sold all the shares of A Limited on 31/5/23 for 1,200. The price at which these shares were traded in National Stock Exchange on 31/1 are as follows: highest trading, average trading, lowest trading. So I should take 700, 680 or 660? 700. So FMB of share should be 700 being the highest price. Cost of acquisition will be what? Higher of the following: cost or lower of FMB or sale consideration. Higher of actual cost 400 and 700 and actual sale consideration of 1,200. So ultimately how much? 700. Long term capital gain will be 500 per share into 300. So 1.5 lakhs, of which 1 lakh no tax, 50,000 10% plus cess and all those things. So it would be how much? 5,200 rupees. Very, very simple. Now this they can ask in MCQ only. Direct. Second one, $200 units of equity oriented funds. Units were not listed at the time of purchase. Later they got listed. That's fine. At the time of purchase only I need to see. So net asset value. One will be listed, one is not listed. A is listed, B is not listed. For A, what should I take? Highest trading price 750. For B, net asset. They have only given everything. Just have to apply what should be taken, that's all. So for A, 750. B, 950. Net asset value. Lower. All those things you should calculate. So basically, cost of acquisition of a unit will be, so first of all here 750 or 950 as we have discussed. Cost of acquisition of a unit of fund A would be 750 rupees being the higher of actual cost, so 550 or 750 and actual sale consideration. Thus long term capital gain very simple, 900 minus 750 rupees into, that is 200 units, 30,000, that is 30,000. The another one, if you take, cost of acquisition will be 900 being higher of the actual cost, that is 550 or 900 and actual sale consideration is. Long term capital gain will be how much? 900 minus 900 best into whatever it is, 0. So one side you have earned 30,000, one more 0, 30,000 plus 0, 30,000. Do I have any tax on that? No. Why? It's less than 1 lakh rupees. MCQ, nowadays they will not ask this full-fledged, but it was there in RTP and all that, and study material also it's there. Done. So essentially guys, tax rate will be as follows. 112A, long term capital gain. How much will it be? 10% in excess of 1 lakh. 111A, 15%. Correct? 112A, it is LTCG. 112A, 111A, STCG, 15%. What are these things? Equity shares, equity oriented units, units of business trust on which STT would be paid. Then there is one more thing. So all these minute changes have happened in Finance Act 24. That's why I am doing this. We will have to do this. Other than 112 and 111A, normal cases. STCG, normal tax rate. STCG will be normal tax rate. LTCG will be what? 112. That is 20% tax at what? 20%. STCG will be normal tax rate, LTCG under 112 will be tax at 20%. Normal. This share thing is only 112A because they introduced indexation, they introduced taxation only, that's the reason. From 2004 there was no tax. Since they introduced tax in 2018, only then indexation is still 2018 only. That's like deemed indexation. So 112A, 10% in excess of 1 lakh, 111A, 15%. For what? Only for equity shares, equity oriented units, units of business trust. So they can definitely ask questions on business trust, because for business trust things have changed with respect to capital gain from next year. And in Finance Act 23, they inserted a very important amendment for business trust as well. We'll do the business trust properly. Small topic, important topic. So they can ask you the capital gain of business trust last time ever in November 24, because the units of business trust have undergone a change with respect to the period of holding, nature and all those things from the next year. Next, other than 112A and 111A, LTCG 112 tax at 20%, STCG normal rate. Then there is one proviso. There is one, this 20% will I get indexation for 112? 112 will I get indexation? Is it till 2018 as you asked? No, that you will get normal. STCG normal rates. Proviso is also there guys. This is LTCG on listed security other than units and ZCB. LTCG on listed security which is other than units and ZCB, which means for zero coupon bonds. Other than units and LTCG on listed security and ZCB basically. And security will not include units, because units are already covered here. No, units of business trust and equity oriented units are already covered in 112A and 111A. But these are other listed securities. What do you mean by other listed securities? Listed preference shares, example. Are listed preference shares covered in 112A? No. So listed preference shares will come here actually. LTCG on listed security other than units. One more example, equity share on which STT is not paid. Direct purchase method, right? Equity share on which STT is not paid. There, proviso to 112 gives an option for you. 10% without indexation or 20% with indexation. Whichever is less, obviously. You will take whichever is less only, no? It says at the option of the SSE, which means what? Whichever is less. So LTCG on listed security other than units and ZCB. So what is the taxation for zero coupon bonds? One proviso to 112. 10% without indexation or 20% with indexation. And what is the example of LTCG on listed security other than units? Examples, listed preference shares is one. Then equity share on which STT is not paid. Third example was market linked debentures. Somebody told that a hybrid, equity also, preference also, but it's not in that 65-35 ratio. Hybrid securities, correct? Now what about that? That too also was part of what? Proviso to 112. It was what? 10% without indexation, 20% with indexation. Now this also has undergone a change in Finance Act 23. Finance Act 23, it has undergone a change. Part of hybrid instruments. There are various hybrid instruments. One of the thing is market-linked debentures, because it will have some element of, not just debentures, it will have some element of equity also. Or it could be pure market-linked only debentures. Anything. Hybrid instruments basically have elements of equity and debt. Hybrid. But if it is, as I told you, more than 65%, that purely equity oriented, that you can't call hybrid. That is equity oriented. But you have 30-30-30, something like that, or 50-50, then it will be hybrid. Market linked debentures was also part of what? Proviso to 112 till 2023. In Finance Act 2023, market linked debentures was brought under the ambit of a brand new section 50AA, which we have to do now. 50AA. That is Finance Act 23. So basically what they did, they removed proviso to 112 for market linked debentures and they brought it under this. So that is not there in your material, but I'll make you draw a chart, but I'll explain the rationale behind it. What is the pre-amendment position? As we discussed, market linked debentures used to get taxed at 112A, proviso with 10% LTCG without indexation, correct? And also, what do you say, 10% without indexation or 20%, whatever it is. Now, capital gains on MLD always used to be treated as, what is the amendment? You see the rationale, just to understand so that you will not get confused. Market linked debentures are listed securities. They are currently being taxed as long-term capital gain at the rate of 10% without indexation, right? Why without indexation? They are directly telling, because it's 10% without indexation or 20% within, whichever is less, so nobody even cares about that other part. It's actually always, this is only better. However, these securities are in the nature of derivatives, which are normally taxed at applicable rates. Further, they give variable interest as they are linked with the performance of the market. That's why it's called market linked debentures. In order to tax the capital gain arising from the transfer or redemption or maturity of the securities at STCG at applicable rates, it is proposed to insert a new section 50AA to treat the full value of consideration received or accruing as a result of transfer or redemption of maturity of the market linked debentures as reduced by the cost of acquisition incurred, and it will be treated as what, guys? Deadly short term capital asset. Whatever you do, you buy it 10 years ago, 5 years ago, 4 years ago, deemed to be short term capital asset. Because many people were purchasing that to get that benefit of 10% without indexation and treating it as long term, short term, nothing now, very simple. So what do you mean by the market linked debentures, etc.? You see here only the section only I am reading, I am just reproducing the bare act here, where capital asset is a unit of a specified mutual fund. Mutual fund can be equity oriented fund. Equity oriented fund is what? More than 65% is equity. But here specified mutual fund will not be more than 65% equity, because that will become equity oriented fund. This will be obviously what? Can I say this will be the equity holding will be less than 35%, yes or no? Because more than 65% is what? Equity. So here, but it can be like 50 also, but they have defined. Let's discuss that. I'll show you. Or a market linked debenture. The full value of consideration received or accruing as a result of redemption, all that they given, and you see one dialogue here, shall be deemed to be short term capital asset. So you hold it for 3 years, 4 years, 5 years, 6 years, I don't care. It is deemed to be short term. The moment it is short term, it will go to which rate? Slab rate. Slab rate. This also, whether STT paid, no STT, I don't care only. Ultimately, if it is a market linked debenture or a specified mutual fund, automatically it goes into 50 AA. Sir, STT paid, not STT paid, nobody cares. See the proviso. No deduction shall be allowed in computing the income chargeable under the head capital gains in respect of any sum paid on account of STT. You pay STT, you will get deduction? No. Will it come under any other section? No. Market linked debenture means a security by whatever name called underlying principal component in the form of a debt security. Whether returns are linked to market returns on other underlying securities or indices and included in a security classified as a market linked debenture by SEBI. So, not just SEBI related, anything which is linked to the market, the underlying principal component is what? That will be a debenture. But they'll create a derivative instrument of it which is linked to the market, and then they'll share. More like a collateralized debt obligation. It is basically like a security receipt. Underlying asset is debenture, and on that they are linking and creating one more security. Or you see, specified mutual fund means a mutual fund by whatever name called, where not more than 35% of its total proceeds is invested in equity shares readily. Which means it's a debt mutual fund. Equity holding is only up to 35%. Equity holding is only up to 35%. Right? So, very simple. Only these two. If equity holding is 40%, it will not come here. Right? So, if equity holding is anything, the maximum equity holding is how much? 35%. This definition also has changed in Finance Act 24. I will not go to that. Right. So, basically last time ever the definition would come now is this. That's what. Let's not get confused. In Finance Act 24, it's different. You see this definition only, and your question was raised to Nirmala madam. That's why she changed it. She like 50-50 means what to do? Will it come there or here? You don't go what is in Finance Act 24. You read this and tell me where will it go. If it's 50-50, exact 50-50, now it goes to proviso. It doesn't come here. Got it? Your hybrid doubt, it will not come here. This definition also has changed in Finance Act 24. Same doubt they asked. Madam, 50-50 is there, what will I do? This definition is stupid. Because it says up to 35%. What about it 40, 37% if it's there, 40% if it's there. If it is more than 65%, then equity. Up till 65 I can have anything, no, 40, 60 I can have, 60, 40 then. So that has been addressed in Finance Act 24, but not here, right? And based on that, question number 11 they have asked. Question number 11 is based on 50 AA. We'll solve that, but before that we'll just draw one chart of 50 AA. Understood 50 AA? No need of any of these things, no need guys. You just remember it is what? Market linked debenture or specified mutual fund. What is specified mutual fund? Equity holding is maximum 35, that's all. Equity holding is maximum 35. Anything other than that, we'll have to see what to do. So, What has exactly happened is simple, guys. You see, logically, I'll tell you. If I make any investment, it could be equity investment. If it's listed more than 12 months, it will be LTCG, yes or no? Yes. 1128 will come 10% in excess of 1 lakh, chapter close. If it is less than 12 months, STCG 1118 15%. Fair enough. Now, mutual funds can be equity, it can be debt, or it can be hybrid. Hybrid means assume less than 35. As per the definition hybrid, let me clarify. As per the definition hybrid, right? So, if it is equity, that will be equity oriented unit. That automatically comes here only, we have seen. LTCG or STCG are 1128 or 1118. Then let me come to debt and hybrid. Fixed deposit, if I get some interest, slab rate. Savings bank account interest, slab rate, we know. The problem was this debt mutual funds and hybrid mutual funds, assuming that is within the definition, including market linked debenture. So, in the period of holding chart, where will it come? 3 years, others. So, less than 36 months, it would be slab rate. More than 36 months, what would have come? 112 proviso. Yes or no? Which means 10% without indexation or 20% with indexation. Now, to make it on par with fixed deposit, savings bank account and equity oriented funds, to make it on par, or not even equity oriented fund, make it on par with fixed deposit and savings bank account. This debt and hybrid instruments, as per the definition, they have converted that also into slab rate. It's the logic. Got it? So, they have converted this more than 36 months also into slab rate by deeming it to be short term. That's the logic I'm telling. They wanted to make it, create a level playing field. You want risk, go to equity. You don't want risk also, but you want benefit also. Not allowed. Understanding? Market linked debenture, what risk is there? Is there a risk? No, because underlying security is debenture, which is kind of secure. You want risk, high return, go to equity. But you want risk also, you don't want risk, but you want the benefit of that. That won't work that way. That is the logic behind it. I was trying to understand why this is what I got. So, yes, makes sense, because more than 36 months, yes, this is a product of discussion of IBS only. Chinmaya sir was discussing something, and in the class only when we were discussing, this came off, and we made one chart also like this. In one of the case studies, it's there. That's the benefit of talking to like-minded people. You'll get to know many things. So, because he's a AFM expert, we were discussing that, and then this we got to know about this. Anyway, so less than 36 months, what? Slab rate. More than 36 months, 112 proviso, what does it say? 10% without indexation, 20% with indexation. That part is now into this. 50 AA. Everything is STCG at slab rates. So, market linked debenture and specified mutual fund. Investment in equity is less than or equal to 35%. More than or equal to 65% debt. So, if it is 50-50 and all, where will it come? Ideally, normal only, which has been addressed now, but for our exam, November 24, strictly you should follow this definition. Less than or equal to 35% and more than or equal to 65% debt. Clear? So, that is the logic of this 50 AA. So, now please check question number 11, important question. We asked in RTP May 24, guys. Very interesting question. That's all. Mr. Sanjay is a resident in India, age 55 years. Had an impressive investment portfolio in various mutual funds. He redeemed his entire mutual fund investment portfolio and bought a villa in Lonavala for 2 crore. Which section automatically exemption will come? 54F, very good. Buying any other, selling any other asset and buying a house for 2 CR. Can you buy 2 homes? Since capital gain is 2, since net consideration is 2 crore here, but not capital gain. So, can you buy 2 homes? Anyway, in 54F, not possible. To spend the rest of his life there. The details of mutual funds are as under. BLR Growth Fund. Date of investment 3/4/2020. Date of redemption 5/6/23. Amount invested in lakhs 120 lakhs. Amount redeemed in lakhs 140. ABC Strategic Fund 4/5/23 2/2/24. Amount invested 4650. Invested redeemed. ABC Mid Cap Fund 115/118. SBA Growth Fund 1110/120. 110/120. The funds stated at 1 and 2 have invested 30% in equity. Which section? Yeah, of domestic companies, and funds stated in 3 and 4 have invested 70%. Equity oriented, it is equity oriented. The investment pattern remained unchanged over all the years. STT is paid at the time of acquisition and redemption of mutual fund automatically. Oh, STT is paid, so 1 and 2 will be one proviso. No, we have seen the section whether you pay STT, don't pay STT. The moment it is less than 35%, everything deemed to be 50AA. Less than 36 months, more than 36 months, I don't care. It is 50AA. You are required to compute the capital gains chargeable in the hands of Mr. Sanjay. So, BLR Growth Fund, what will I do? Is it deemed STCG? Will it come under 50AA? Will you get indexation of this? Okay, just see the time period, no? Here, time period, just to understand. Deemed short term. One second, guys. Just want to see this question. It was hold on one second. It is. You have checked the RTP? Okay. I'm checking the other one also, 1 second. Yeah, if you see, first one is a growth fund, but have they told it is equity or preference, equity or debt? Oh, 30% of the proceeds. So if you see the definition of specified mutual fund, where not more than 35% of its total proceeds is invested in the equity shares of domestic companies. So here they have given what? 30%. So what, according to you, what should it be there then? 50 AA? Yeah, but in the answer, what have they given? Indexation. Why? Is it wrong, or have they, given something else? So you see, this is the Finance Act 23 which I have opened. So it's very clear here that underlying principal component in the form of a debt. So have you opened the RTP? Is it the same? There's no change? Okay. Because ideally, what they should have given is, they should have actually given here that it's a specified mutual fund or it is a debt oriented fund. So if that they have given, then you can take the other assumption. Okay, 1 second. Oh yeah, correct. Yes, correct. That is the point. So if you see, specified mutual fund acquired on or after first day of April 23, or market linked debenture. Market linked debenture, you see, is it acquired after 1/4/23? No, here what I am asking is, specify market linked debenture, if it is acquired 10 years ago, is it short term, long term? Short term. Specified mutual fund acquired before 1/4/23, short term, long term? Specified mutual fund acquired after 1/4/23, short term or long term? Short term. Specified mutual fund acquired before 1/4/23. Now, will it come under 50 AA at all? No. Right. So, in this particular chart, here, specified mutual fund should be acquired. That is the answer. It's a good question. Specified mutual fund should be acquired after 1/4/23. Market linked debentures can be acquired any time. Can be acquired anytime. So if market linked debentures are given in the question, then it is always 50 AA. If specified mutual fund is given in the question, it is either the proviso or the 50 AA. Depends on when it is acquired, right? So in this question, the acquisition date should be checked when it is acquired, right? So if you see here, the same question, why I got confused, was given in IBS. There they had given one more chart, one more table. There they had given equity fund, then debt fund, different percent. Hybrid also was there in that. That was an IBS question. So I was wondering whether it's the same. That's why I opened the RTP. But yeah, you confirmed that it's the same. You see here, guys, ABC Strategic Fund was acquired after 1st April 23. So this will come under 50 AA. BLR Growth Fund was acquired not after 1st April 23 but before 1st April 23. Is it a specified fund? Yes. So if you see here, market link debenture can be acquired anytime. If this were to be BLR market link debenture, then it will come under 50AA. This is not BLR market link debenture, it is BLR growth fund. Since it's BLR growth fund, it is a specified mutual fund. But this was acquired before 1/4/23. So here the normal provisions will apply. Whereas these two, are they, what do you say, they are equity oriented funds. Normal provisions will apply. Excellent question. So if you see first one, redemption of BLR growth fund. Full value of consideration, redemption value 1.4 crores, less index cost of acquisition. So whatever it is, I have taken here how much? 120 lakhs. 120 lakhs into 348 by 301. Point number 1. Point number 2, long-term capital gain. Since it is a debt fund, as not more than 65% of the proceeds are invested in equity shares of domestic companies. It was held by Mr. Sanjay for more than 36 months immediately preceding. Yes. ABC strategic fund on the other hand, specified mutual fund which is acquired on or after 1/4/23. This would qualify as a short-term capital asset as per 50AA irrespective of the period of holding. So redemption value they have given 50 lakhs minus 46 lakhs. Answer 4 lakhs will be short-term capital gain. First one again I repeat, it would have been 50AA if it had acquired after 1/4/23. It would have been 50AA if it were to be a market linked debenture, even though it was acquired on 2020. So they can tweak the question and give anything in the exam. So please be alert. Next, similar question is there in IBS also with some additional data. Remember that very clearly. That's why I thought this question was wrong, because there I remember it being equity fund, debt fund, percentages they had given 65%, 50% and something like that. One of the case studies. Next. Third here, this is normal one, these two equity oriented funds. SBI growth fund, full value of consideration 1.2. So if it is under 1128, because it's an equity oriented fund, directly goes under 1128, 10% without indexation. Will you get indexation benefit? No, because I have given here. And is it also in this example, the date of investment is very important, because if the investment were to be 2017, that also can be one more iteration in this question. If the investment is 2017 or 2016, then what you should do? Now that 31/1/18 also you should keep in mind. Thankfully, on that much level they have not given. If it is 2016 or something here, please keep it in mind. You should do that iteration of 31/1/18 also. Right? Everyone with me? Yes. So in this part is easy. So here direct 120 minus 110. 10 lakhs directly, right? All those things. And here also same, 118 minus 105, 3 lakh, direct. No change, no indexation benefit. Will I get an exemption? Yes. How much exemption I'll get though? No, that is for taxation. I'm talking about exemption in 54F. How much you are investing out of that? How much are you investing? 2 crore. You please see here. In this example, guys, tell me which would be short term, which would be long term. BLR growth fund, long term or short term? Long term. Then this one, the other two, the second one, sorry, which is that second one is short term. Third one, short term. Fourth one, long term. So can I say 1 and 4 are long term? Yes. And if you see the notes as well regarding the capital gain, if 54F, if I go back, see that's such minute things they ask in the exam. There's a wonderful question. They have not asked in May 24. So I hope they ask this in our November exam, because we are ready, because you know the iterations also now. If you see 54F, what should be the asset transferred? What should you buy? Residential house. But what should you transfer? Not any asset, any long-term capital asset. So of the 4, only 1 and 4 you will get exemption. The net consideration, if you invest of 1 and 4, that only you will get exemption. House can be 3 crore, but you are, what do you say, investing the net consideration. If net consideration is fully utilized, then capital gain is fully exempt. So to what extent will you get? How much? One and 4. $1.4 net consideration, 1.2 net consideration, 2.6. $1,26,246 is the capital gain, and here last part is 10 lakh. So exemption will be how much, guys? Exemption from long-term capital gains from redemption of SBA growth fund. Will you get full amount? Yes. Right? You will get full amount. Yes or no? Why? Because how much are you investing, guys? 1.2 crore. 1.2 crore you are investing. What is the amount you will get? Obviously, you have invested out of, how much is the return you are getting? Tell me. Return that you are getting is how much? I am talking here. You are getting, first of all, from the first one you are getting how much? 1.4 crore. And on the second one you are getting 1.2 crore. Overall 2.6 crore. In that, are you investing full 2.6 crore? No. The house value only is 2 crore. Are you understanding? So how much will I actually get? To the extent of 2 crore. But unfortunately 54F is based on how much net consideration is invested. Are you with me? In 54 it is your, whatever you invest, you will get the amount of capital gain. But in 54F, the net consideration portion only, proportionate capital gain is invested. So if 2.6 crore is invested, 2.6 crore is not invested actually, only 2 crore is invested. So obviously it should be to the extent of the new house. So what are the sources for my 2 crore? Sources are 2 things. One is the source of 1.2 crore. One more is the source of 1.4 crore. What will you spend first to get maximum capital gain benefit? It's a wonderful question. What will you spend first? Are you understanding, guys? One is 1.4 crore, one is 1.2 crore. You have 2.6 crore. Which you will sell, which asset and invest first to get the maximum capital gain benefit? Obviously, which has the maximum capital gain. So between 1 and 4, yes or no? Because I am getting proportionate, right? Are you understanding, guys? I am getting proportionate in 54F. Correct? If it is a normal 54 section, I don't care only. I invest whatever you want, get the full capital gain. In 54F, unfortunately, it is based on net consideration investment. You invest 100 net consideration, capital gain exempt. You invest 50 net consideration, proportionate capital gain exempt. So, and it is always linked to the cost of the asset. It cannot, cost of the asset only is 2 crore. How can you claim 2.6 crore? Even though I invested 2.6 crore, the cost of asset only is 2 crore. Now, to maximize the capital gain, I should invest in what? I should invest money from selling that asset which has given me the highest capital gain. And which is that between 1 and 4? 4. because it has given me 10 lakh capital gain. If I want to claim full 10 lakh capital gain, I need to invest full 1.2 crore. If I invest full 1.4 crore, I'll only get 126, 246 only. It is the unfortunate point of 54F. Correct? I hope they give this question with lot of iterations. Wonderful question, right? So, yeah. Which one? Huh. That is after exemptions. After all those things, you'll see here. We'll show that it's here. So, have they subtracted it here? Right? No. When is the capital gain calculated? When is the tax calculated? After exemption or before exemption? After exemption. Right? So, after exemptions only the tax is calculated. So, once you do everything, if balance is left which is more than 1 lakh, then you get that exemption. Right? So, let's see. Now, they are only asking capital gains chargeable to tax, right? So, now you see, I will invest full 1.2 lakh and get full 10 lakh exemption. How much more I can invest? Only 80 lakhs. But from the other long term, I have got 1.4 crore. If I had invested 1.4 crore, I would have got an exemption of whatever it is remaining, but 1.2 lakhs. But if I am investing now 80 lakhs, if I had invested 1.4 crore, I would have got an exemption of 1.2 lakhs. But if I am investing 80 lakhs, how much exemption I will get? 72,141. Good question. So, what is the, one second, capital gain chargeable to tax is how much? 754. Now, I will do the capital gain calculation.
So, assuming they have other
only for long term. Yes, only for long term. 54 is a exemption which is intra-head or inter-head? Intra-head. 1 lakh is not even intra-head. It is only intra-type. Which type? LTCG under 112A. So, first I should give the exemption and see, then whatever balance payable in that, I will get the final one, right? So, here also. Now, what if my next question is, what if this happened to be 1.5 lakhs? Whatever balance left, assume it's 1.5 lakhs after subtracting everything. You have some component of short term, some component of long term. So, my next question is, I mean, they can ask me anything. Will you get the basic exemption limit for long term capital gain? Assume in the same question, ultimately all put together after all subtracting, I will get 1.5 lakhs. So, now what I should do? I should, do the slab rate stuff. And doing slab rate up to 3 lakh in the new regime, 3 lakh is nil. Now, it's coming up to 2.7 lakh. So, will I get that basic exemption limit also? First I will get 54F, then I will get 1 lakh, and basic exemption also I will get. This can be one more type of question. You have to split where? Short term. So, for that short term will I get slab rate? Will I get for long term? Will I get? It's not slab rate. But the thing is, okay, let's say, or will I get the full 3 lakh? Let's say long term was 2 lakh, short term was 1 lakh. Will I get basic exemption limit of 1 lakh or 3 lakh? Are you understanding what I am asking? So, basically I am asking, will you get basic exemption limit for long term capital gains? It doesn't come, right? Correct. So, that is the next part. This we will see that portion. Minute points. See here, this is an interesting point. Come to tax on long term gains, which we are done, page number whichever it is. So, today will be all these hidden points which we need to understand. It's a very good question. Excellent. Come to point number C. Did you get it? Page number? How much? 52, guys. Page number 52. People make mistakes in capital gain because of these things only. Hidden points. Long-term capital gains under 112A can be used for exhausting the basic exemption limit. In other words, long-term capital gains computed under 112A shall be reduced by the basic exemption limit and only the balance shall be taxed at 10%. I asked you various questions. We'll see examples. This is applicable only to resident individual and HF. Means long-term capital gain can be used to exhaust the what? Basic exemption limit of 2.5 lakh in the old regime, 3 lakh in the new regime. Example, Mr. Y, a resident age 65 years, derives taxable pension and interest income of 2 lakh and also derives long-term capital gain of 5 lakh on transfer of equity shares under 112A. In this case, tax on other income, tax on pension and interest income nil, as a taxable income does not exceed the basic exemption limit of 3 lakh. Overall, how much is there? 2 lakh and 2 lakh, no? So, what is the thing? 3 lakh. 3 lakh minus 2 lakh, 1 lakh. What is the unexhausted portion? 1 lakh. So, in my question, what did I tell you? Capital gain is some 1 lakh, 1.5 lakhs. So, can I reduce that further? Even after getting a beneficial tax, internal limit of 1 lakh, 54F, after everything, 1 lakh is still left, 1.5 lakh is still left. Can I reduce 1 lakh further? Yes, that's the beauty of it. Manner of adjusting is how it is here, manner of adjusting. In this case, the basic exemption limit available to Mr. Y is 3 lakh. And being a resident senior citizen, it is not fully exhausted. Unexhausted basic exemption limit of 1 lakh shall be reduced from the long-term capital gain by applying 10% under section 112A. How? Income from long-term capital gain 5 lakh. Unexhausted basic exemption limit 1 lakh. Balance capital gain under 112A 4 lakh. Tax up to 1 lakh, one more exemption, nil. Balance, how much? 4 lakh minus 1 lakh into 10%, 30,000. Understood? So, unexhausted portion. If there is no other income also, unexhausted will be what? 3 lakh. So, can I get it? Yes. Yes. That is one thing. You should adjust other income first and then capital gain income. Which one? Whenever 112A applies only, that will come. In this case, that everything we have taken exemption 54F. I am saying even after that, if it still something is left, here you are right. Everything is taken into account, no? In this particular question. So, in case there is a LTCG left under 112A, then you can claim it. And this is only for 112A, unexhausted stuff, not all full capital gains. It's only for 112A, unexhausted portion. Otherwise, you can take normally. Other things and all you can take normally, no problem. So, now again, few more examples. Benefit of availing basic exemption limit is not applicable to non-resident individual while computing 112A. Guys, 112A is independent of the new regime, old regime. In new regime, that is a default regime. What is the basic exemption limit for non-resident also? 3 lakh. Resident also 3 lakh, 65-year-old fellow 3 lakh, 90-year guy 3 lakh. But if you are a non-resident, unexhausted portion will not come. So, these provisions are independent of the regime that you choose. Sam 58 years, he may be 48 also, I don't care. Non-resident earns 5 lakh as LTCG covered by 112A and 2 lakh as taxable pension. In this case, entire amount of 5 lakh shall be subject to 10% because non-resident. Base exemption of 2.5 lakh applicable to non-resident individual in the old regime. Which one? That fine, that you will get. Yeah. That is normal. 1 lakh you will get everybody, but I am talking about, yeah. Then one more interesting thing. They are all hidden points. So all this will help us in MCQs. They'll only give you all these items and say compute tax. They know where we will make mistakes. That will be option number 1. Second mistake will be option number 2. Right? Yes. So it may be noted that rebate under section 87A is not available against tax on LTCG under 112A. This is also on deadly point. In the first class, you had computed rebate. Rebate is different for different fellows. It is different for old regime, different for new regime. In old regime, 5 lakh 1,000 you will not get rebate. In new regime, 7 lakh 1,000 you will get rebate. Only 112A, not other things. All the? No, 87A is the same section. No, 87A is not new regime. 87A is both old and new regime. Rebate is old and new regime. So there only they have changed the law. You see here 87A. If you see this section, 87A is what? Basic rebate section it is. Did the power go or something? 87A is what? Rebate in case of individuals. So 87A has two things. 87A, this is the normal provision for old regime. So here they have inserted this. This is for proviso is for 115 BAC. Correct? So the rebate after 7 lakh 1,000, you will get what? The difference portion you will get here. That's it. So apart from that, it is the same. So basically what I am saying is any rebate under 87A, it's not applicable for what? 112A. So Ms. Hamsa, resident individual age 37 years, furnish the following details. 112A, 1,60,000. Other income, 3,20,000. In this case, Hamsa's basic limit will be 2,50,000. Let's take the old regime. So in this case, what? Tax on other income, 3,20,000 minus 2,50,000 into 5%. Slab rate, 3,33,500. Tax on LTCG under 112A. After subtracting 1 lakh, you will get 6,000 rupees. Total tax, 9,500. When you are calculating rebate, it is how much, guys? Ideally 9,500 or 12,500, whichever is less. But I should ignore this. That's all. Basically 87A, whether it's old regime, new regime. In 87A, when you are doing the new regime calculation, when you are doing that 7 lakh 1,000 or if at all that includes long-term capital gain, that only you exclude, that's all, nothing else. So rebate will be 3,500 or 12,500, whichever is less. So in this case, 3,500. So in the question, it is imperative to see what regime they are opting for and whether there is LTCG under 112A. If it is 112A, rebate is not available. Unexhausted basic exemption limit is available for resident only. If you are non-resident, not available. Hidden points. Okay, so we'll take a break, guys, and then we'll continue. got stretched a little because we had to finish it, but yeah. Okay, let's continue, guys. Okay, so we were discussing so just to revise certain things before we go into the other areas of non-resident taxation and all those things. So general rule under 45(1), what is the year of taxation? That will be the year of transfer, right? However, I mean in LTCA also generally there will be a indexation concept. But what is the exception? Year of taxability will be some other year in those 5-6 cases. Especially 45(1)(a), taxability in the year of receipt of insurance claim in case of destruction of capital asset. Conversion of capital asset into stock in trade, it is the year when the stock in trade is sold. 45(5), compulsory acquisition, when the compensation was finally received. And 45(5)(a), JDA, where I receive the completion certificate either in part or whole. And other areas also which is in the securitization and all that. Then general rule of indexation will apply to everything except a few. First proviso to section 48, non-resident, TTBR, TTSR concept which we have done. Then for bonds and debentures, because it doesn't fluctuate, there is no indexation. Section 50B, slump sale, there is no indexation. Goodwill and any self-generated asset, there is no indexation. Bonus shares, there is no indexation as such, except that of course we know that 112A, that 31(1), that leave. Apart from that, no indexation. 112A, no indexation. 112, there is an option to take 10% without indexation. So there is LTCG on unlisted securities in case of non-resident or foreign company. Specifically for non-residents, there is no indexation, and foreign taxation also there will be no indexation, which that part we will quickly see now. Apart from that, where all have we seen FMV in Income Tax Act? 45(1)(a), destruction of the asset. If asset is given as a replacement instead of money, we saw FMV concept. 45(2), that is capital asset, stock in trade, where FMV on the date of conversion or transfer will be FVOC. Stock in trade converted to capital asset, FMV on the date of conversion will be the PGBP, and same value will be taken into block. 45(4), case of dissolution, and 46(2), that we will discuss in IFOS, dividend. 50CA, sale of unquoted shares. 50D, that is selling price if it is not determined, then FMV of the asset received or exchanged. Then all shares, all bonds, all assets before 1/4/2001, there is that FMV concept. Then special provision of 55, that is shares or bonus under 112A, FMV will be as on 31/1/2018. So that is what we saw, the concept of FMV. Just to revise everything, that's all. Just to revise, this is what we saw. Now coming to some other areas like your ULIP, etc., that also we need to do. It's all part of the deal. And something related to non-resident. Before that, we'll just quickly check certain things. So the ULIP provision I have taken from the institute RTP. For both inter and final they have given. So ULIPs which are issued on or after 1/2/21, to which exemption under 1010D does not apply on account of 4th and 5th proviso, it is chargeable under the head capital gain, which means the exemption under 1010D will not apply. For other things, ULIP will come. That part is not there because it's come in the recent RTP as such. But anyway, I can You can check that RTP also, but examples I'll show here, you can just understand it and check the RTP. Same, I've taken from the same thing, copy paste, no change. So as per the 4th and 5th proviso, it may be noted that exemption under 1010D does not apply for sum received under ULIP issued on or after February 21. So first thing is, it should have been issued on or after February 21. Exemption under 1010D will not apply. Issued on or after February 21. Amount of premium payable should exceed 2,50,000 rupees. Right? So if the amount of premium payable, if it exceeds 2,50,000 rupees, then the exemption, generally if you get any sum from ULIP, it is exempt under 1010D. But for that to apply, that exemption will not apply in the following two cases: for all the ULIPs issued on or after February 21, and most importantly, if the premium exceeds 2,50,000. The premium is less than 2,50,000, still exemption will apply. Similarly, where a person subscribed to more than one ULIP issued on or after 21 and the aggregate of the premium on all policies exceeds 2,50,000, exemption shall be denied. But if a person dies, then no problem. These restrictions will not apply on death of a person. So Nirmala Madam will not tax a person dies. But anyway, some examples to understand. Date of issue 1/4/2012. Annual premium 5 lakh. Sum assured 50 lakh. Consideration received 60 lakh. That 60 lakh is fully exempt. Why? Because the policy was issued before 1/2/21. So that 1/2/21 is the date that we need to remember. So before 1/2/21 the policy was issued, so no problem. Next, it's all examples given in the RTP itself, and the institute has given certain guidelines. CBDT, what he says, given some examples, same thing institute has copy pasted. In example 1, if the date of issue was 1/4/21, is it after 1/2/21? Yes. Consideration received on maturity shall not be exempt, as annual premium is how much here? More than 2.5 lakhs. Anything more than 2.5 lakhs, not exempt. So if the annual premium is more than 2.5 lakhs, the full amount that you received, in this case 60 lakh, will it be taxed? Yes. Example number 3. Date of issue 1/4/21. One more issue, ULIP number B, date of issue 1/4/21. Annual premium 2 lakh, annual premium 3 lakh. Sum assured 20 lakh, sum assured 30 lakh. Consideration is received on 1/11/31 on maturity, 22 lakh, 35 lakh. So in this case, guys, which one is exempt, which is not exempt? ULIP A is exempt. Why? Even though if it is issued after 1/2/21, annual premium is less than 2,50,000. ULIP B, even if it is issued after 1/2/21 and annual premium is more than 2,50,000. Hence, consideration received under ULIP B will not be exempt, as annual premium exceeds 2,50,000. But consideration received under ULIP 1A will be exempt because it does not exceed 2,50,000. Yes. Doubt? Which one? That is covered there. Future examples, we'll see. So now, because this dialogue is there, no? If it is aggregate premium, where person subscribed to more than one ULIP, aggregate premium paid is 2,50,000. Exemption shall be denied. We'll see that example. So example 4, you see standalone, ULIP A, ULIP B, ULIP C. All have been done after 1/2/21. Annual premium, and you see here, aggregate of the premium exceeds 2,50,000. So here you see 1 lakh, 1,50,000, 3 lakh, sum assured 10, 15, 30. In this, A and B, will it exempt? Will it be exempt? Yes. Why? Annual premium is less than 2,50,000. C, 3 lakh. So sum assured, consideration received on maturity, 12 lakh, 18 lakh, exempt. But the other case, C, 34 lakh, what do you think? It is taxable. So in this case, all have been purchased after 1/2/21. And whatever is, see what they are trying to tell is here. Similarly, where a person subscribed to more than one ULIP issued on or after 21 and the aggregate of the premium paid on such policy exceeds 2,50,000 in the previous year, exemption shall be denied. So that example is this. Other things you assume that there are different policies issued, but here same guy is doing it. If you see here, what is definitely exempt, if I think about it, these three seem to be exempt. So consideration received under ULIP C will not be exempt for sure. No exemption. In this case, or in this case, where there is no exemption, B no exemption. Here where there is no exemption, C no exemption. When it is no exemption, should I add that also or should I add the remaining ones? C is anyway not exempt, that you will anyway pay. My question is, the premium you will add of everything put together or the ones which are exempt? Individually exempt, but jointly may not be exempt. So assume in these questions, even if it was held by the same person. So now that I have come here, I can go back and ask the same question. So if I have A and B, B is anyway not exempt. So should I add the ones which are otherwise would have been exempt in isolated circumstances, but if I add everything, it will not be exempt? Or should I add everything, including non-exempt ones? That is why they gave the illustration to explain what they meant. But if you see the wordings, it appears that everything you should add. Correct, no? Obviously, because the dialogue only is like that. It says what? Similarly, where a person subscribed to more than one ULIP issued on or in the aggregate on such policies 2,50,000, exemption shall be denied. Exemption shall be denied. Exemption shall be denied for those which are exempt, which otherwise would have been exempt. For that, exemption will be denied. But for ones which are never exempt, that should never be taken into calculation. They also knew will not understand, that's why they only gave examples. Right? These are all issued by CBDT. That's why I am doing all this, all recent editions. This never came later, all recent editions, never came before as such. I mean, recent means in the last 1 year, 1.5 years. These are all recent. And 1.5 years, whatever changes come, suddenly it will not be asked in the next attempt. Over the next couple of attempts, they will ask. So here, consider, see, now you see, B is not exempt anyway. In the example number 3, B is not exempt anyway. A, is it more than 2,50,000? No. In example number 4, C is not exempt anyway. A and B put together, is it more than 2,50,000? No. Right? C is not exempt anyway. A and B would otherwise have been exempt if it is isolated, but I am adding and taking. Will it be taken into account or not? 1 lakh, 1.5 lakh, 2.5 lakh. Example number 5. C is anyway not exempt. That you ignore. X, A and B, if you add everything, it will exceed. So you see, consideration received under ULIP number C will not be exempt under 1010D as annual premium payable exceeds 2,50,000. However, consideration received under ULIP A and ULIP B in aggregate or ULIP C alone shall be exempt. ULIP C alone, ULIP X alone will be exempt. So now what can I do? The assessee at his option can choose between X or A and B to avail exemption under 1010D. It's an option. Because standalone, I can add to X and A, I can add A and B. I can add A and B if I add, is it less than 2,50,000? Yes. X and A if I add, it will anyway go more than that. So either I should just claim exemption for X, or I can add A and B and claim exemption. Yes, up to 2,50,000. So This though no exemption for sure. No exemption for sure. Now here in this I can combine and claim one exemption. For the remaining I have to pay. If I take only X, or I have to take like A plus B, because if I add everything it is going more than 2,50,000. If I add X plus A plus B, it is going more than 2,50,000. So, but it's like a basic exemption limit it has become now. I can take 2,50,000, but I should make the combination in such a way that it is 2,50,000. Do you really think in direct tax code all these will be simplified? No. That's what I am saying. So, procedural aspects they will simplify. So, now tell me what should I take according to you which will give me the maximum benefit? 12 lakhs plus 18 lakhs will become 30 lakhs. If I take this benefit of AB, if I combine and then take 2,50,000, then I will pay tax on this, no problem. This anyway I have to pay. This is no longer in the discussion because the premium is more than 2,50,000 individually. Here individually it is less than 2,50,000, but in aggregate it is more than 2,50,000. But I can take like a basic exemption of 2,50,000 provided I can combine two. Would I just take exemption on X or will I take under A and B? It is better to take A and B because if I combine the sum consideration, it will be 12 plus 18, 30 lakhs. As against this, 25 lakhs. So, what should I take? A and B. Wordings, if you see, A and B, if you take, it will be 30. Better because it's 2,50,000. Wordings, if you see, it will be like add everything, you will feel. That's why we added everything here. No. Adding everything only which are otherwise exempt in isolation. That only you should add. And that too now because of the illustration they have only given. This is not my illustration. Copy pasted from the whatever the CBDT has given and what ICA has given. Same from them only I have copy pasted. You can find it there also. So there what they are trying to tell, they are trying to explain this is how you should calculate. So C anyway is immaterial for my decision making. From X, A and B, I should choose 2 or 1 as the case may be. Because if I combine X and A anyway it is taxable. X and B it is taxable. Should either be X or A and B. What will I choose? A and B. So I will take exemption for what? This. Sorry? Yeah. No, but generally when you pay the premium it's a cost, no? If it includes GST, they should take everything all inclusive. Because when I am paying a premium and there is no credit available, then you should, that is the contentious issue, no? Now, why are you charging GST on life insurance? So, when I am dying, I should pay you 18%. That's money that for me only, no? If I die, for my family. So, that is the question which is being raised to Nirmala madam. Please delete all that GST, it's an additional burden for us, for anybody for that matter. Right. So, it includes everything. Always in income tax we have discussed, everything includes GST, assuming there is no credit. If you get credit, exclude, that's all. It's a general rule. Yeah, so ultimately when I am computing the capital gain, how do I compute? All amount received for the first time including bonus minus aggregate of the payment, whatever I have made, will be the capital gains. That's fine. You see the example here. Mr. Somnath invested 4 lakh per annum in ULIP of ABC Limited from 1/4/21 for 10 years. Policy was 50 lakh. Mr. Somnath received 45 lakh on 25/9/26 from the policy. On 31/3/31, he once again received 25 lakh from such policy. Will it be taxed twice? Obviously, he is receiving twice, no? First time is receiving 45 lakh. How many years he would have paid policy premium? 21, 22, 23, 24, 25, some 5-6 years he has paid. Then again 5 years he has paid. Again 5 years he will pay and he will get 25 lakhs. So, for the amount received in previous year 26-27, 45 lakh. Amount of premium paid 1/4/21 to 22, 22 to 23, 23 to 24, 24 to 25, 25 to 26, and the next year also you would have paid. 6 years you would have paid anyway, because it's paid everywhere on, always on 1st April 21. 21, 22, 23, 24, 25, 26, 6 years he has paid. So, this long-term capital gain under 112A. Yes. Why 112A? 112A covers what all? Equity shares, unit linked insurance plan. It is linked to what? If nothing is given. Unit linked, is it debt linked to debt? It is always equity oriented units. When I say units of ULIP, it is equity oriented units. Equity oriented units, where will it come? 112A. But there are of course various plans, correct? But as per this capital gain, the moment it's a ULIP, automatically it comes under 112. So under 112, one more provision comes. What is that? ULIP, right? No. Specified mutual fund, this is not a mutual fund. These are specifically done only for the insurance plans where as per IRDA also, you should have a separate fund where the money will go there and you will invest only in those as per IRDA. So this will be a proper thing. It will not be a specified mutual fund as such. This was the same doubt asked in Finance Act 24. After you write the exam, you open the memorandum of Finance Act 24 and see there. Same question. One is that hybrid they have asked. One is ULIP they have asked. It's creating confusion because of that definition of 35%. That's why they have changed that definition in Finance Act 24. But for our examination, let's stick to that. Okay. ULIP also will come under 112A. Then next, 25 lakhs have received later. How many? What is the premium I have paid that time? Extra 4 years, no? 6 years already taken here, remaining 4 years. 25 lakh minus 16 lakh, 9 lakh will come there, that's all. So, ULIP question also may come, guys, because it's all these examples they have given recently. Though ULIP is there since forever, but from 1/4/21 all these things change, right? So, that's why. So, we'll come back to the taxation part. So, 1A is the same thing. Transaction should happen to recognize. This is what, guys, it is equity share of a company, unit of equity oriented fund, which is at ULIP, and unit of a business trust shall be liable to tax at 15%. If the following conditions are satisfied, yes, recognized stock exchange and STT. But guys, this STT will not come if consideration is received in foreign currency, and one more thing, it's there in a recognized stock exchange in IFSC. So, for IFSC, STT will not come. But can you still claim a 15% reduced tax rate for shares traded in IFSC? Yes. In case of an individual HF being a resident, short-term capital gain shall be reduced by the amount of basic exemption limit not exhausted by any other income. Means what? 111A. And only balance short-term capital gain shall be chargeable to tax 15%. For a non-resident SSE, adjusting of basic exemption limit is not applicable, same that we discussed. SSE is not entitled to claim deduction provided under Chapter 6A in respect of such short-term capital gain. So, one more deadly point, you are not getting any Chapter 6A deduction. However, rebate under 87A shall be allowed. Other cases, it's 20%. Anyway, now coming to non-resident little bit, because guys, whether we like it or not, they will give a lot of questions on non-resident also. For example, you see, we did this 11, right? You see then 13, for example, is a question on non-resident which was asked in November paper 2023. Question 13. We will come to that, right? So, basically they will ask non-resident taxation combined with capital gains, right? So, a little bit of non-resident taxation also we need to do in this. They will combine. Non-resident if he sells equity shares or units in equity oriented fund or units of business trust, so equity shares, units in equity oriented fund, units of business trust. Either in IFSC at recognized stock exchange or other than IFSC with STT. So, we did know already, if it is denominated in foreign currency or Indian currency but paid in foreign currency, denominated in Indian currency but paid in Indian currency. So, if it is paid in Indian currency, foreign currency, no STT will come. No STT will come. What all is exempt? Section, in 47 it is exempt, no 111A, no 112A also for foreigners, deadly. It's exempt. Anything paid in foreign currency is exempt. It may be denominated in foreign currency or Indian currency, doesn't matter. It is denominated in Indian currency, paid in Indian currency, then no STT will come, but you will get the benefit of 111A and 112A. This is the combined reading of what? International taxation and capital gains, right? Because there is a benefit for them, right? There is a benefit. Under 47 7AB, there is no tax if you denominate in foreign currency. Then, but 11A and 112A benefit you will get. This is for IFSC at recognized stock exchange. Other than IFSC, if you do with STT, means in the normal share market you are trading, 111A will come, 112A also will come. You will pay STT also, but you will not get slab rate benefit, either 2.5 lakh or 3 lakh slab rate benefit you will not be getting for non-residents. So, there will no be, basically you will not get that unexhausted slab rate limit, unexhausted portion. Unexhausted portion, you know. So, this is like a combined variation of this. So, if you see here, same thing is given. In any foreign exchange and where consideration is received or receivable in foreign currency, consideration for that transfer. So, condition of payment of STT is not liable there. But if you see, but other things will be there. What is that? So, here this should be foreign currency. That is this section, no? Recognized stock exchange and IFSC and consideration is received in foreign currency. If it is rupee denominated bonds that we have already seen, rupee denominated bonds not in IFSC but sold outside, will you get any tax? No tax. We have already seen rupee denominated and government security. That is full bindas, nothing. So that's the thing, guys. Apart from that, if they do preference shares, debentures, units of debt mutual fund, anything for that matter, 111A will not come anyway, 112A also will not come, then normal rates, normal tax rates. So this is the combined version of that if you do it. Right. So apart from that, some hidden points. 111A is not applicable for preferences debentures that we know. Apart from that, it is also not applicable for buyback of shares, sale of delisted shares. It was listed, then it became delisted. So as of today, it's unlisted shares. It is unlisted because it is delisted. So if they give an adjustment of unlisting or delisting, buyback, etc., 111A will not come. Sale of right entitlement also, sale of entitled right shares, basically right shares, not through the market thing. Right shares can be issued by private companies also, not just public companies. So those things STT will anyway not be paid. Which one? Buyback from the open market, yes. Buyback personally, no. Buyback can happen through various modes, no? I am talking about buyback which is not through the open market. So basically, as far as STT is concerned, STT is paid on purchase and sale, both. 112A also will come, 111A also come based on short term or long term. STT is paid on purchase, not on sale. 112A will not come. 111A will come, because as per 112A, it should be paid both on purchase and sale. If it is paid on purchase but not on sale, means it was listed, then it became delisted. At the time of selling, 112A also will not come, 111A also will not come. Then purchase also not there, sale also, this is purely like private company shares. 112A, 111A. So this example is what? Listed first. You can write down this if they ask any, these are all adjustments I am doing. Sale of, at the time of purchase it was listed, then it got delisted, then shares sold. 112A also will not come, 111A also will not come. Here, purchased unlisted, later listed, then sold. This is private company shares. This is normal. So you can write this down, guys. Any example, STT and all, if they ask, please note this. Shares and debentures, is it capital asset or stock in trade? For FII, it is capital asset. Though it is stock in trade, it is capital asset. I told you the logic. For others, assume listed and unlisted. If SSE opts to treat it as stock in trade, income will be business income. So it's all up to what he opts. If it's a listed thing, if SSE opts to treat it as stock in trade because he's running the business of share trading, it is not an indulgence of his passion. He's not employed elsewhere and is not doing this, right? He's Rakesh Junjunwala. That's his business. So what obviously it will be stock in trade. He opts for it. He should clearly mention that this, you can't opt 1 year like this, 1 year like that. No. Should show that, boss, I am doing the business. So if everything should be supportive of it. Like he should be doing this business regularly, or if he has a company and all, then it's fine. Company will be, the MOA will be clearly mentioning all those things. But if it's a person, individual, his vocation, profession, or whatever you call it is share trading. Not some side hustle that you're doing. So, if SSE opts it as stock in trade, yes. Unlisted shares and all, if you are doing short term, long term, whatever it is, capital gain. This was issued in a 2016 CBDT letter. They said that is what it is. If it is more than 12 months, guys, if it is more than 12 months, means you are trading this for over 12 months. But still, can you treat it as a capital asset? Like initially you were doing stock in trade, that's one part, that's fine, that is normal. Like you are trading some shares, you have held it long term and you have opted it as a capital asset. My question is, if you have opted it to be a capital asset and not stock in trade, can AO change it? He'll ask you what other things you are doing. No, I am retired, I am doing this only. I have held some shares for a long time, it's been more than 12 months and I am doing this. So what do you think? So can the AO change his stand? Can the AO say, no, actually I will treat it as stock in trade, business income. Don't pay lesser 10% tax, pay 30%. So again here AO has no standing. These are all CBDT circulars. They said whatever the SSE tells you should follow. So AO has to accept it. But the beauty is SSE cannot change the stand next year and all that. The moment you take this into account, you should go ahead. And later, if you want to change, you have to prove that you actually change your line of business, because that will come to me in when I do the assessment, scrutiny. Like suddenly you are having your new lines of business, then you have multiple business, then fine. But if you are into share trading only, you can either do it as stock in trade or you can do it as capital asset. Once you take a stand, you cannot change. If you change and if you get a scrutiny notice, you should be in a position to justify properly. Otherwise, AO can do a best judgment assessment thing because you didn't give me proper details, best judgment. Correct, it will apply if you actually convert it. The thing is, if you have a capital asset, then you convert to stock in trade, or if you have a stock in trade, what about the reverse thing? Stock in trade convert to capital asset? We saw what? Capital asset to stock in trade. What about reverse case? I had stock in trade, then I converted that to capital asset, you've seen. What about reverse? Capital asset converted to stock in trade. Is stock in trade converted to capital asset? Is it transfer? What is transfer? In the definition we saw one thing. What is transfer? By the time today we go home, capital gain. Yes. See, what is transfer? Transfer was what? Conversion of capital asset into stock in trade. It is very clear. I am asking reverse now. Since you asked me question, I'll ask you. Reverse if I do. Stock, now I am doing stock in trade. Suddenly I'll tell today, no, it's capital asset. PGBP it will come, no? Yes, PGBP. It will come in PGBP. Yes, so that amount will come in PGP. So yes, those provisions will apply, but I need to show everything in my return and justify. Ideally, I cannot change my stand, but if I change, justify. That's all. All the provisions I have to put, I have to write all that and justify. Less than 12 months, you leave that. That we'll see later. So this was again clarified by Arun Jaitley in 2016. That because people were doing whatever they felt, 1 year stock in trade, 1 year capital asset, then they'll claim business loss. Then again capital, they said, no, you cannot do. And all these changes came after so many years. 2016 is like very recent if you think about in the context of income tax law. Yes. All this we have done. I'm just doing the final points, whatever it is. One important MCQ, guys. Mr. V bought a share of Varisu Private Limited on 1/1/1999. 10,000 shares he bought at 70 rupees per share. FMB as on 1/4/2001. These are all MCQ questions, anything they can ask. FMB 1/4/2001, 100 rupees per share. All this I sat with my guru VG sir to frame all this. VG sir became famous how? I asked him also when I met him. Today is just one phone call away. If I have any doubt which is not there in the commentary, one phone, I'll just message him, he'll call me. That's how sweet he is. He'll only call me. Right? So, VG sir was at age 24 when he started teaching. He went to the CA Institute, Delhi to teach. 8 students were there. So, he was figuring out what all questions may come in the exam, and he told the students. They told this fellow, what 24-year-old kid, what he'll tell. But the 8 students were there anyway, so they wrote down. 60 marks came from whatever he told. Next batch became 100. Right? He was telling. Then at one point of time, I'm talking about 20 years ago, he did not even have space to fill in his classroom. So he hired a convention hall with 700 people capacity. And the thing is, he was telling me, he showed pictures also. At class at 7 a.m., queue was at 4 a.m. Queue to enter the hall. So 700 people was the hall capacity, 1400 people came. So he started morning batch, evening batch. So then after a few years he was doing that, his son was around 7-8 years of age. The son told him, what are you doing? Morning, evening you are taking. Why not rest of India? That is the reason why he started the first ever, virtual classes, satellite classes. 40,000 rupees, guys, in 2012. I couldn't afford it. 40,000 rupees. Right? So when sir tells certain things, no, it will come. So we were discussing almost 3-4 hours we were spending on this, seeing what all possible things can come. Yes, I wish he continued teaching. He stopped off 2-3 years over now. He's made enough money, and he's like, I've trained lakhs of students anyway, so there's no point. Now he's having a good retired life. Yes, but wherever I get stuck somewhere where in commentary also it's not available, I'm also not able to understand. So I just message him the full doubt. He'll understand, and ideally I don't want to disturb him, so I don't call him. He'll call me off directly. So that's the relationship I share with him. Very gem of a person. So anyway, so we were discussing, this is how it is. So if you see 10,000 shares, 1/1/99, 70 rupees per share. On 1/4/2001, FMB is 100 rupees per share. Obviously. What will I take? Cost or FM, which Mr. Vijay gifts it to Mr. Joseph. On 1/1/2017 he gifts. And FMB as on 1/1/17 as per rule 11 UA is 150 rupees per share. This was a private limited company. Shares are listed in the stock exchange on 21/3/2018. 2019, 2019. FMB there is 200 rupees per share. Now I sold the shares at 300 rupees. My question is, like, what should I take? Should I take, what is the FMB, what is the cost? Selling price though very easy, 300 rupees per share. And Joseph is the person to whom gift was given. So period of holding, is it from 1199? That's the question. And what do you say? Cost of acquisition is what? It's the main question. Cost to previous owner. Cost to previous owner is some 70 bucks. But will I, since it's before 2001, will 100 rupees per share come? And will FMB as on 1117 come, or I should ignore? This is like a combined thing of everything. So what will come? And moreover, is received a share of 70 rupees, and when he is got a gift, FMB is 150 rupees. Why I wrote the FMB? Because if you are receiving anything which is more than the FMB, you will have to pay the gift taxation also. Gift is for the receiver or the payer? Receiver. So if Joseph is a relative, no tension, you can give 56 to 10 will not come. But if Joseph is not a relative, then 56 to 10 will come. Correct? So assume Joseph is a relative, 56 to 10 will not come. So what will be, when he is selling, what will be the cost? Yes, that also we have to think, no. 1/1/2018 will come, no. 2018 will come. Sorry? It's listed now on 21/3/9. So what will you take? Will you take that or not? Correct? And what will be my, what do you say, period of holding? It will be till 36/2020. And if you remember also, if it is not listed, there is a rule, no? What you should do? Yeah, you should bring it up to the indexation. That is one part that you need to see. So what will I take into account? Cost will be 10 lakh only. Lower of selling price or FMB. And FMB I should bring it to indexation. Cost is 10 lakh. That's fine. As selling price 30 lakh. I sold it for 30 lakh. FMB is what? The cost. Why is the cost 10 lakh? FMB on 1/4/2001, 100 per share. 100 into 10,000 is 10 lakh. So 10 lakh into 272 by 100, 27 lakh 20,000 will come. So ultimately capital gain will be 2,80,000. That's fine. But if the beauty here is, if I am not a relative, if I am a relative, no tension guys. For relatives you can give a gift anytime. As a relative, if I give a gift, no problem. We'll see that in IFOS after we finish this. Now, if you are not a relative, at the time of gifting only, I am issuing you shares and you are getting it for free at 150 rupees. At 50 rupees would be taxed anyway. I will tax that 50 rupees. 10,000 into, right, how much? How much will I tax? How much is this? 150 rupees. Will you take full 150 rupees tax or the difference, or on full 150? That we'll see in 56 today. I have not done that, so it's not fair for you to, for me to expect you to understand that. Leave it. Leave it. Apart from that, now, the moment I paid, let's say I have paid 15 lakhs tax from my hand. What cost will I take now? Will I take from the previous owner 10 lakh, or will I take the 10 lakh plus the tax that I have paid? Plus the tax. So then the cost of acquisition will change. So you should be alert in the exam. So I know I am taking you through little higher level, but any question can come. We are not just doing like this. You have seen this question which has come anyway. That's what it is. So any share etc. when I buy, I can also look at. So now come to this indirect, the international taxation one point, guys. So now take you to one thing. page 3.2 in international taxation book, page 3.2. There is one section for NRIs. Only for NRIs, not NR, NRI. You studied full capital gain and went, you skipped international taxation. They gave a question on international taxation. 115F. Where an NRI has transferred a long-term foreign exchange asset, anything, and within a period of 6 months out of the date of such transaction, invested the net consideration in any specified asset, LTCG shall be exempt. Whole net consideration, entire LTCG. Net consideration partly invested, proportional LTCG, like 54F. Where the new asset is transferred or converted into money within 3 years from the date of acquisition, LTCG exempted earlier shall be deemed to be income. That is lock-in period. It is a foreign exchange asset. In foreign currency, you should have bought. Basically, if it is listed, unlisted, you can buy shares also. Long-term foreign exchange asset. A non-resident acquired shares on 1/1/2009 for 1 lakh in foreign currency. These shares are sold by him on 1/1/23 for 3 lakhs. He invests 3 lakhs in some specified assets on 31/3/23 and sells them on 36/23 for 3,50,000. So here the entire LTCG of 2 lakhs, 3 lakh minus 1 lakh shall be exempt as the entire net consideration is invested in the specified assets. But if you sell it within this, then whatever was exempted earlier will be taxable. Very simple. Now the question here is, let's not get into what is specified asset, they'll give it in the question itself. So such a simple provision, it's actually nothing but 54F only, similar to 54F, but it's only applicable for a NRI. This point they had never tested. November 23, in the previous year question, they asked. Now, it could be long-term foreign exchange asset. It can be listed, unlisted, whatever it is. So, in the exam, if nothing is given, you have to assume both. For listed and unlisted, both we have to compute. Correct? So, check question number 13, guys. Question number 13. Mr. Adi. For this particular section, 115F, should I buy in foreign currency or Indian currency? Very clearly mentioned. Now, in the exam, they may listed, unlisted, if they don't give, then you should think about what to write. But what if they don't give whether it's foreign currency or Indian currency? If you assume foreign, 115F. If you assume Indian, no 115F. And I am not even making it up, exam question. Question 13. It's easy, don't worry. It's like volume is there, I understand, but constant revision, you will be able to do it. So, that is the only problem with direct tax, nothing else. Question 13. Mr. Adi, non-resident Indian, age 45 years. Subscribe, page number 58. Mr. Adi, non-resident Indian, 45 years, subscribed unlisted equity shares of a Indian company 2008-2009 for 6 lakh rupees. These shares were sold by him on 5/3/23 for a consideration of 9 lakh rupees. Brokerage paid for sale of the shares was 15,000 rupees. Now, have they given foreign currency, Indian currency? Nothing. So, if foreign currency 115F, if Indian currency 115F is not there. Compute taxable gain. Assuming he has invested March 2023. Cost inflation index they have given. Specified assets 3,50,000 they have given. Specified asset is 3,50,000 overall before 31st. Actually, it should be, guys, ignore the effect of first proviso of section 48. Sorry, question little bit here and there. Ignore the effect of first proviso of 48. Means they are telling don't sit and do TTBR, TTSR, all that. That much not needed. Ignore the effect. Ideally speaking, they are giving a hint now. When they are saying ignore the effect, it can be both now, no? Because if they say it's not applicable, then you can say Indian currency. But they are saying ignore the effect, which means it's already there, but for this problem, ignore. That's why dual answer as per suggested answers. First one, computation of taxable gain, assuming it is what? Convertible foreign currency. You can take one assumption and write that answer, no problem. Full value of consideration 9 lakh. Brokerage paid 15,000. Net consideration 8,85,000. Will you get indexation benefit? No. 6 lakh. Long term capital gains. Was it held for more than 24 months? Yes. Unlisted shares. What is the period of holding? 24 months. 2 years. So long term capital gain is how much? 2,85,000. Now exemption. What is the specified asset that they have told? 3,50,000 is a specified asset. What is the net consideration? 8,85,000. If you invest the full net consideration, you will get 2,85,000. But if you invest only 3,50,000 in the net in the asset, specified asset, what? You will get proportionate. Since they have given the term specified asset, obviously I have to use 115F. So 3,50,000 into 2,85,000 by 8,85,000, 1,12,712. What is the taxable capital gain? 1,72,289, assuming it is what? Convertible foreign currency, foreign exchange. If it is not purchased in convertible foreign exchange, if it's in convertible foreign exchange, obviously you will not get the benefit because proviso to 48 will come. But in this question, they have told no need to do that TTBR, TTSR because they have not given any details with respect to that. On the other hand, if it is normal Indian currency, then obviously anybody will get the indexation benefit. So for him, full value of consideration 9 lakh, brokerage 15,000, net consideration 8,85,000, cost of acquisition 6 lakh into 331 by 137, 14,49,635. So long term capital loss, since it was held for more than 24, 564, 635. Both we should show. Previous year's question paper it is. Just try second question. I don't know if the answer is correct, but try the second question, guys. MCQ, sorry, MCQ second question. There only it is. I have not tried the answer, whether it's correct or not. Ideally, it should be correct, but just check. Forget the answer, but try to solve that. April 23 question paper. MTP, sorry. D as the answer. You're getting D. Others? D, C. So what is the house property? Sold a residential property. Full value of consideration how much? 3 crore and 4 crore. House property was purchased 25 months back. Means long or short? Long. Index cost of acquisition is 1 crore and 1.75 crore respectively. Cost of acquisition indexed 1.75. So what is any expenses are there? They're not given. So 1 is 2 crore is a capital gain. This it is how much? 2.25. Everyone got till here? Mr. Vishal purchased 2 residential flats, one in Delhi, one in Agra. Can he buy 2? Yes. This is 54 or 54F? 54. He can buy 2 because the capital gain is 2 crore, less than or equal to 2 crore. So if it exceeds 2 crore, then he cannot buy. Both of them invested 30 lakhs in bonds of NHI. Can you do that also? Yes. So basically, he has bought 80 lakh, 75 lakh. That is 1.55 lakh. Then also, how much he has bought? Bonds? 30 lakhs. So will he get up to 50 lakhs? He'll get, no? Yeah. So he has done it in March 24. This guy has done it in April 24. Is it allowed? 30 lakhs in April 24? Both of them, okay, both of them invested in all these things. Okay, can you do up to 6 months? That you can do. Both of them invested in 30 lakhs in NHI and 30 lakhs in bonds. Can you do both put together? Up to overall is 50 lakhs. Fine, fair enough. So basically it is for Vishal, it's very simple. He has already bought 2 homes, 70 lakh, 85 lakh plus 50 lakh. All put together, he has invested more only. Correct? Can he do it? Yes. So what is up to what limit will he get capital gain exemption? 2 crore. So that nil, Vishal, no problem. Now this guy, 2.25 crore is the capital gain. He has invested where? One in Mumbai, other in Pune for 80 and 75, that's fine. Both of them invested. He has only invested in, has he invested in one more house? Yeah, Mr. Vishal purchased 2 residential flats. Guha also purchased 2 residential flats. One in Mumbai, 80, 75. For him, unfortunately, only one. See, this question is on that 2 crore. Since the capital gain is more than 2 crore, 2 homes are not allowed. So what will you took both? Yes, the C, that's the problem. He took both and he got D. You should take only one. See the level of depth they are asking. That's what. So if we don't do like the way we are doing, it is not possible to answer questions, right? So okay, now tell me, this is very simple. Now out of 80 and 75, what will you choose? Makes sense, 80. Plus this side I can choose 50. 80 plus 50 is 1.3. 2.25 minus 1.3. 95. So generally we will only mug up 54 means 2 homes possible. 54F, 1 house possible. That 2 crore will miss out. So the examiner knows exactly that. In MCQ they will ask these questions. But to be little alert. It's easy only, but yeah, alertness. Try third question, guys. Question number 3. Question 3 MCQ only. 59 page number. Which question is this? 55 to AC. That is your 31st 1 2018 case. Higher of cost or lower of FMV or sale, whichever is that, lower of FMV or sale, whichever is less, and that and cost, whichever is high. Directly apply, you will get the answer. Please solve. You get? Yes, easy. So how did you solve? Purchased 3000 shares at the cost of 2000. So what is the share cost? 2500. FMB as on 1 is, so basically cost 2500 and higher or lower? Lower of FMB 1800 or what? Sale consideration 3200. So what is the lower? This and this, whichever is high. So 3200 minus 2500, 700 into 300. How much? 2,10,000. So option D. So basically when I say 2,10,000, these two are ruled out. This or this will come. So I need to understand the loss of that other fellow will be how much. So if I compare the loss, what will it be? This guy 600 ULIP, 1,900 is the cost. FMB 2,400 and we sold it for 1,700, correct? So this or this, whichever is lower, this or this, whichever is higher, 1,900. 1,900, 1,700 minus 1,900, 200 rupees loss. 200 into 600, 1,20,000 direct. It actually won't take time. So because we know the logic, becomes very simple. So anything and everything they can ask, guys. Should be always very, very alert. Anyway. Buyback, leave it. So done. So apart from that, some other points, some other MCQ questions which they can ask you. Let's discuss. Yeah. So in the exam, look out for these transactions as far as STT is concerned under 112A. Sale of equity shares listed in the recognized stock exchange, will you get STT? Yes. Units of equity oriented mutual fund at a recognized stock exchange, will STT be applicable? Yes. Unlisted shares which are now offered to public through an IPO, initial public offer. So will STT come there? Yes, because it's being, it's a IPO. Shares which are gifted and subsequently listed, that Vijay case, will STT come there? Yes. Unit of a equity oriented fund sold, mutual fund, will STT come? Yes. Then non-resident who's selling the asset in the IFSC, in a recognized stock exchange in IFSC in a foreign currency, STT will not come, 112A will come. So I am just giving example, look out for these transactions in the exam, anything they can ask, right? And if it's a non-resident Indian buying some specified assets, then 115F will come, right? We just saw now, not about STT, but just 115F will come. Now one hidden point again, guys, under 112A, there are what? Equity shares, listed, unlisted, both. Listed shares means which are regularly traded under 112A, or it could be penny stocks which are not regularly traded under 112A. Apart from that, there are something called unlisted shares. For unlisted shares, will 112A come? No. For penny stocks, will 112A come? Yes. Yes or no? Because what does the section say? Listed. Listed can be regularly traded or penny stocks. But there is one more dialogue we saw in 50 CA, that is for unquoted shares. For unquoted shares, FMB to be taken, if you remember. Unquoted was what? Both unlisted as well as penny stocks. Because unquoted share definition was something which was not regularly traded. So there is listed penny and unlisted. 50 CA. So my question to you is, when a penny stock is sold, Or if they give a question saying that a share which was listed but not regularly traded is sold, what will apply? 50 CA or 112A? This is like the highest level of MCQ. What will come? With example will do, but what will come? MCQ question. 50 CA versus 112A. Sale consideration will be 50 CA. Cost of acquisition will be that 31/1/2018 dialog. Capital gain will be 112A. But sale consideration will be 50 CA. Example. Cost of acquisition was 10 lakh. FMV as on 31/1/18 was 20 lakh. What should I take? This or this, whichever is higher, 20 lakh. Actual sale consideration 30 lakh. But since it is an 50 CA asset, unquoted shares or rather penny stock, unquoted, there it is 35 lakh. Normal provision, what will I do in capital gain? I will do 30 minus 20. But in this question, I should do 35 minus 20. You understand, guys? Because it is a unquoted share. So if they ask in the question, a share which was listed in the stock market but not regularly traded is sold, compute the capital gain. And they have given the data, cost of acquisition 10 lakh, FMB 31/1/18 20 lakh, actual sale consideration 30, FMB as per 50 CA 35 lakh. Which one? Huh? No, that's not listed, no. Penny stock is listed, but yeah, it is not regularly traded. Why? That is as per 31/1/18. For that only, nothing else. This is I am telling I am selling it later. When I am selling it later, for 31/1/18, what should I see? Whatever has been traded recent. For this one, for this 50 CA FMB, what is that? Which is that the calculation. That after the calculation, they will only give you 35 lakhs. Correct.
So it might not be 30, it might be an early date also.
Correct. You are right. So what I am trying to tell is ultimately, if they give you sale consideration and 50 CA value, they will not ask you to calculate, don't worry. They will only give you. What will you take? 50 CA. Whatever the value may be, take 50 CA, because this is a peculiar case. It applies, both will apply, 50 CA also, other thing also. So on 31/1/18, always, definitely, when you are computing that, that's very clearly given, you should take the highest traded thing. Since these things are not regularly traded only, it's traded some 20 days ago, you should take that for the calculation of 31/1/18. Perfect. For 50 CA, calculation is different, and they'll only give you that. Generally, I have not seen where you have to compute for 50 CA also. They'll only give you, don't worry. So it is 35 lakhs. So in this example, I should take 35 minus 20, 15 lakhs. And for the first 1 lakh, nil, 14 lakh, 10% without indexation. Various MCQs. In 2019 on MCQ, they had asked, actually, in the exam, same penny stock only, unquoted share, sold for 20 lakh, FMB was 50 lakh. 20 lakh, FMB, cost was 10 lakh, okay, cost was 10 lakh. It was gifted to the wife. Actual question this is. Husband bought the unquoted shares for 10 lakh, gifted to the wife. At the time of the gift, it was 50 lakh. Immediately, the wife sold it for 20 lakh. FME was 50 lakh, but she just sold it off. She didn't wanted the money, 20 lakh. Question now is, you should take, cost was 10, selling price 20, FME 50, it's an assumption. Should you take 50 minus 10 or 20 minus 10? 50 minus 10, because same, normal, 50 CA, that will come for sure. But now the question is, will the wife, for her, will gift taxation apply? No, relative. Relative, you can do whatever you want. Now one more thing, will clubbing apply? Clubbing. I am taking you to areas which you have not gone, I understand, but this is an examination question in 2019, right? So capital gains, it's all chilled out, but these are the highest level of question that they can ask. This will be like one question in 1 or 2 attempts. So I am just combining everything and doing, so don't get worried. It's just like a higher level question. So a simple question, will clubbing come? So that one of the MCQs, that initially when MCQ was launched that time, they had given this apparently, which I have collected, which is there. What do you think? Yes, we have done clubbing now for that only. Clubbing will apply. Why? Because it is, you may gift it, that's okay. But ultimately, that benefit, the income, is you will only be receiving because you are selling it off. So yes, it is converted to that money now. Yes, clubbing will apply for sure. 56 to 10 will not come. So resident under 112, resident LTCG is 20%, he can claim the 2.5 lakh benefit. Whereas non-resident, he cannot claim any 2.5 lakh benefit, that's fine. Listed shares or debentures, if it has gone through the market, STT 112A. Off market, if I am dealing, because STT is not calculated there, then the proviso will come. Off market transaction, 10% without indexation, 20% with indexation. Proviso to 112. Unlisted shares. Unlisted shares, what? 20% without indexation, 10% without indexation, 20% without indexation. So unlisted shares, what is the rate? Same, right? So, but for the, what do you say, non-resident guys, non-resident, will he get first proviso benefit? Will first proviso will come, that TTBR, TTSR? For unlisted share, that is only for listed. That one part we'll see later, leave it, because that will be one more extra thing I need to teach in that, leave that. Okay. So ultimately, first proviso, I am talking now about the applicability of first proviso. First proviso to section 48 is what, guys? Yeah, that TTBR, etc. That TTBR, TTSR, according to you, is it a mandatory thing or it's optional? TTBR, TTSR, for always if you have to do it in foreign currency, right? That's why. Second proviso is about indexation. So if the first proviso comes, second proviso will not come. Yes or no? Second proviso is indexation. First proviso is TTBR, TTSR. So TTBR, TTSR you are following, will indexation come? No. If you are doing indexation, will TTBR, TTSR come? No. Wherever STT is paid, automatically it will go to 112A. Will you have to compute TTBR, TTSR? No. So we have already discussed 112A is what? Listed. If you are buying and trading shares in the listed stock exchanges, then there is no concept of TTBR, TTSR as such, because you are directly dealing there. Then and there you are finishing it off, right? That's what. So first proviso to section 48 is for non-residents, foreign companies, also debentures, bonds, shares, whether it's listed or unlisted, it is not applicable to units. It is not applicable to mutual fund. It is not applicable to business trust. It's mandatory. It is not an option. And it is applicable for both STCG and LTCG. If you are going through 112A, means what? Listed shares where STT is paid, then first proviso will not come, already discussed. And the money should be foreign currency only. That is why TTBR, TTSR. No, Indian currency means why will I care? It should be in foreign currency. So, second proviso of indexation, if first proviso is applicable TTBR, TTSR, second proviso will not come. If 112A is applicable, listed, then second proviso will not come, right? So, for example, in 112A, listed share STT is paid, 112A will come, first proviso also will not come, second proviso will also not come. TTBR, TTSR will not come, and second proviso is what? Indexation will not come. On the other hand, if I am in 112 proviso, if I am doing listed securities and ZCB, that is not forming where STT is not paid, then 10% without indexation, 20% with indexation. However, there is one benefit, that is why I am coming to now. If it's an unlisted security, only unlisted security for non-resident, ideally it is 20%, but for a non-resident there is a benefit of 10%. But TTBR, TTSR also will not come, indexation also will not come. This is one exception for non-resident. This is one exception for non-resident. A specific section is given 112(1)(c), where they will say for a non-resident, what will not come? TTBR, TTSR, both. I mean, that will not come. Indexation also will not come. Got it, guys? This is the entire thing with respect to non-resident taxation. You want to write it down or something, or whatever, just quickly, quick, because this is an important thing. Tomorrow there should be no confusion with respect to that TTBR. You can take a picture also, actually. Take a picture or whatever. The online people can take picture and send, doesn't matter. So, non-resident, foreign company, foreign debenture, bonds, shares, listed or unlisted, units, it is not applicable, mutual fund not applicable, business trust not applicable. It is mandatory, it's not an option to this guy. STCG, LTCG, yes, anything, both are covered. If 112A comes, what will not come? First proviso. What is first proviso? TTBR, TTSR, yes. Otherwise, under 112A, what is that? Index. So, that indexation, that will definitely be the picture. If listed shares, because for that your entire first proviso will not come. Will indexation come? Second proviso also will not come. So, no need to worry only about it. On the other hand, if I am going with the second proviso, indexation, then if I am using indexation, then there is no chance of the first proviso, TTBR, TTSR, because in TTBR, TTSR, indexation will not come. Similarly, one interesting thing is the proviso to section 1112 talks about listed security and ZCB, which does not go through STT route. So, for that the option is what? 10% without indexation, 20% with indexation. However, generally for non-resident and for everybody else, unlisted securities, if I am selling, it is 20%. But for non-resident, specifically one small deduction, that is, it is 10%. But there is no first proviso, no second proviso. So, based on that, again, if they ask you MCQs, listed equity shares, coolly you study, there is no tension, nothing to worry. Listed equity shares, non-resident important MCQs. In the exam, look out for non-residents. Non-resident is selling listed equity shares on a recognized stock exchange. Very, very simple. Directly it will come under 112A. Will first proviso come TTBR, TTSR? No. Indexation? No. What is the tax rate? 10%. On 1 lakh 0%, remaining 10%. Next, listed equity shares, he will buy it and then eventually sell it in foreign currency in an off-market transaction. First proviso, TTBR, TSR will come because it's foreign currency. Second proviso will not come because the indexation is not allowed in the first proviso. Third one, 112A will not come because it is not a listed listed security. I mean listed also, but it's not in the market. STT is not paid basically. So when listed security, no STT, 112 proviso will come, which speaks about 10% without indexation, 20% with indexation. Since it's a non-resident, indexation anyway is not allowed. Hence 10% no indexation. Everybody with me, understood? So it is 10% no indexation. So these are all non-resident MCQs. Highest level. Third, listed off market, but now Indian currency. The moment Indian currency comes, where is the TTV or TTSR? Nothing. Which means when first proviso doesn't come, second proviso will come. You will get indexation, obviously. Indexation you will get. Is it listed in the stock exchange where STT is paid? No. So 112A will not come. 112 proviso will come. 10% without indexation, 20% with indexation. Yes, NR you will get, no? You will get indexation benefit for NR because first proviso will not come. That's why, that's the only reason. So first proviso is only for non-resident. Third, unlisted now. Unlisted equity shares. Unlisted equity shares. I told you special provision 1121C. TTBR, TTSR also will not come. Indexation also will not come. Direct 10%. Special provision only for non-resident. Unlisted equity shares sold by promoter in an IPO. Same. Correct? 112A. Units of equity oriented mutual fund or unit of business trust where STT is paid. 112A. LTCG at 10% in excess of 1 lakh. Units of equity oriented mutual fund or business trust, no STT. 112A will not come. And it is obviously, it's a business trust, it's Indian currency. So first proviso will not come. Second proviso will come. That is listed 20% with indexation, 10% without indexation. Which one? Huh? Yeah, STD, that's why 112A comes. 112A. That's 112A. Next, listed bonds and debentures. Listed bonds and debentures. Whether it's Indian currency or foreign currency. Is it a share? No. Is it equity share? No. So will 112A come? No. 112A will not come. Will first proviso come? Yeah, foreign currency, yes. Then second proviso? No. Yeah, so that is what you need to take, foreign currency. Next, unlisted bond and debentures. Unlisted bond and debentures. For anything other than shares, so directly bond and debentures they are talking about unlisted. So that beneficial regime, 1121C, 10% will come. First proviso also will not come, second proviso also will not come. Securities. Other assets, normal, 112 at 20%. Beyond this, whatever they can create also, it's not possible. Right? These are all the adjustments in the exam with respect to non-resident. FME in income tax, all that we saw. Same things I am going here, guys. Just quickly goes through. Yeah, this is all the taxation rates you have seen, short term. Examples are given, all the summary is done. There is one more concept. If they ask you anything relating to segregated portfolio. So it is there in page 74, yours will be around there somewhere. So the term segregated portfolio was introduced to enable investors to exit a debt scheme which is in distress. Segregated portfolio, which page did you get it? 69, page 60, 61, 61. So the term segregated portfolio was introduced to enable investors to exit a debt scheme which is in distress. Segregated portfolio shall mean a portfolio comprising of debt or money market instrument affected by a credit event that has been segregated in a mutual fund scheme. The main portfolio shall be the scheme portfolio excluding the segregated portfolio. So in any case, any sort of a distress situation where there are two events happening, and if anything, I can exit. There's an option given to the investor to exit the scheme, and there are specific points given. It will be as per the terms of the issue itself. So that time when I am doing it, there will be a main portfolio, but there are certain investments which I want to exit. That will be in a different separate portfolio within the main portfolio. That is called as a segregated portfolio. Now the thing is, when I purchase money, invest money, they will invest in both. One is the main portfolio and some units in the segregated portfolio also. Now eventually when I have to sell the portfolio, that will include segregated portfolio also. So how will that component be taxed is what this section talks about. Cost of acquisition of units in a segregated portfolio. So here, this one. Cost of units in segregated portfolio is equal to cost of units in total portfolio into NAV of assets in segregated portfolio by NAV of assets in the total portfolio. Very simple. So the total portfolio NAV is 1 crore. But in the segregated portfolio, that particular NAV is 20 lakh. So I would say 1/5 of my investments is segregated. So in the total portfolio, I would have invested 10 lakh rupees, or 10 lakh rupees in the entire portfolio I would have invested. In that 20% is segregated as per this calculation. So what would be my cost of acquisition of segregated portfolio? 2 lakhs. 2 lakhs. Very simple. Cost of acquisition of units in the total portfolio into NAV of assets in the segregated portfolio divided by total. That will be the cost here. Cost of units in the main portfolio, obviously, if 1/5 is 2 lakhs, remaining 8 lakhs will be other one. So period of holding will be very simple. Period of holding will be whatever you held it in the main portfolio. Very, very simple. So in case they ask you, it is one simple provision. Yes. Now, in 2016, there was an income declaration scheme. It provides an opportunity to a person who does not paid any tax in the past to come forward and declare undisclosed income, black money, or assets acquired out of black money and pay tax. Total, they are told 45% you pay tax, 55% no questions asked. Now the question is, I will come and tell these are the assets, sir. I have a car which I use for business, I have a building, I have money, I had some shares also, sir, which I bought for so and so, but it's actually Benami in somebody else's name. This is the share value. All items, this is the gold also I have, sir, undisclosed. The question here is, what would be the sale consideration? Because I am disclosing everything now. You see, FMB as on 1/6/2016 shall be deemed to be the undisclosed income for the assets for which taxes will be paid. IDS is applicable only from 1/6/16 to 39/16, 3 months, 4 months. Period of holding shall be considered from 1/6/16. So, I am bringing it into business now. Black money and assets, I am bringing it into business. When I am bringing it into business, period of holding starts from that day. Sir, I held it for 10 years, I don't care. First, on the FMB, you will pay tax of what? 45%. And that FMB will be cost of acquisition in the going in the future, yes or no? So, I had bought asset worth 20 lakh and accumulated for so many years. On 1/6/2016, that had become 1 crore. I will pay tax on 45% tax on 1 crore. Remaining is mine. I paid tax now. What is the period of holding starts here? Next time I can sell that whenever I want, no problem. Period of holding begins from here. Whatever previous one, forget about it. That is grandfathered. That's the term used, grandfathered. Clear? Very simple. For an immovable property, yes, same thing. Period of holding shall be from the date on which the property was acquired. Immovable property alone, different. It is evidenced by a registered deed. Evidenced by a registered deed. One more simple point. Just like, I told you in the example where if I feel that FMB have to compute, so the assessing officer may refer valuation to a valuation officer. If he feels that there is a variance, you give me the FMB as per your valuer, I feel it's okay, chapter close. Otherwise, I may also refer. If the FMB of the asset exceeds the value claimed by more than 15% or more than 25,000, whichever is less. By more than 15% or more than 25,000, whichever is less. If asset is 10,000 rupees you are claiming, I am claiming it is 20,000 rupees. So, it's 20,000 or 25,000, whichever is less. Variation should be only 15%. So, this as only once they have asked in the MCQ about this, when can I go to valuation officer? 15% or 25,000, whichever is less. ZCB already discussed. Cases where indexation benefit is not allowed, I have given everything here. Depreciable asset 50 already discussed in depth in PGBP, no need to see that again, same thing is good. That's all guys, capital gain is done, easy. Last part was of course your non-resident taxation, which requires couple of revision, but then that's about it. So, it's an easy chapter, no doubt about it, very easy, but you need to study it accordingly. Cool. So, we'll take a break now because I don't want to start anything. After the break, we will be doing income from other sources linked to capital gain, because we need to take off there only. Like if I gift something to you, will it be taxed in your hand? Or if I sell the goods to you at inadequate consideration, will it be taxed? Yes. So, and you have solved enough questions also, good enough. Right. So, do you have some confidence in capital gains now? Yes. PGBP anyway done, capital gain. Now, other things, of course, all the important areas we will be solving. Now, these are the actually heavy duty stuff. Assessment procedure also will take time, it's okay, but at least we'll finish IFOS and other areas. So that, in the remaining days, whatever is all the important areas, we'll finish it in the depth that is required for the exams.